Good morning, everybody. Welcome today. Welcome to Market Fluidity 2.0. I know a lot of people have been waiting for this. We've added some new content. We're going to mostly talk about this. There's going to be some psychology. There's going to be chart traffic, and there's going to be some new analogies too. Let me just make sure it's being recorded. It's being recorded. All right, perfect. All right, so just want to make sure if you guys can see the screen, right? No problems with the screen? All right, perfect. Perfect. So basically, if you're new in trading, one thing you need to really realize is that the charts will always do the same thing over and over and over again, right? It's your ability to not recognize that is going to cause you to fail at the end of the day. Let's start this market. Oh, this was a nice poster here. So starting on, what we're going to do is we're going to start off with what kind of psychology you need with trading, or if you are coming into trading, what your background is and what you're really expecting out of trading, right? So the number one question you need to ask yourself is that why do you want to trade Forex, right? Like, what's the reason? Is it because you see something online and you want something and you think you can get that through Forex? Is it because you're generally passionate about it? Or is it because you wanted to treat it like a side hobby, right? These are things you really need to ask yourself. Because when you come into trading, right, the thing with trading is that it's highly addictive, right? It's really addictive. So you need to know that, okay, how are you going to really try to trade it, right? Most of the times I tell people that, hey, you know what, when you come into trading, you need to treat it like a part-time job, right? Because let's say you have a full-time job, right? So you go to work, you come home, and then you have those set amount of hours, right? So you always need to have around, I'd say, 3 to 4 hours where you can dedicate to the charts, right? Because when you start to do that at the same time every day, you'll start to see that the market kind of does the same thing every day. This is really important because if you don't stick to these rules, what's going to happen is that while you're working, or while you're, let's say, if you're self-employed and you're at your job, you'll be looking at the charts too. So now one thing you need to realize is that the charts do not move the same at different times of the day, right? That is why we really stress upon the fact that, hey, you know what, when you make a trading plan, make sure when you're looking at the charts, it's almost at the same time every day. Because let's say you have a full-time job, and then after that job, you have a part-time job, right? So your part-time job is going to be at the same time. Just like you're going to go to the gym. Let's say some people go to the gym in the morning. So you'll only go to the gym in the morning because now you're going to have that routine. Your body is going to get used to it, right? That's why most people, when they see us stream the New York session, you'll see that we stream sessions at the same time, almost the same time every day. We end them at the same time every day too. So now, once you get in the habit of doing that, your mind, it adjusts to those charts, right? Because you're going to be seeing the same time. So now, most of the examples here in the webinar are going to be almost at the same time. It's going to be around 6:30 a.m. Eastern, between maybe 11 a.m. Eastern, or some examples are going to be during Asian sessions. There might be some in London too. So yeah, we're going to look at that later. But coming back to psychology, the next thing you need to really ask yourself is that what are your goals, right? Is it that you want to become financially independent, or you want to become financially free, as what they say on on social media? You really need to ask yourself that what your goals are, right? A lot of people, they say, hey, my goal is to, quit my job. I want to leave my job in a month, and I'm going to start to trade Forex. I can tell you this right now, it's never going to happen. It's not going to happen. In a month, you cannot leave your job. In a month, okay, let's in the first 2 weeks, you start with $1,000 account or $500 account, and in the first 2 weeks you run it up to like 4,000, 5,000, right? Like, a lot of people here have already done that, right? They have ran their accounts up, but what happens in week 3 or week 4 or week 5, right? There's a very, very big chance that you lose it all, or you lose a considerable amount, right? So when you say, hey, I want to quit my job in like a month or 2 months, even 3 months, that's not going to happen. If it does happen, it's not sustainable, because when you go from 0 to 100 in a small amount of time, that speed is not sustainable. So you really got to know that, okay, maybe if your goal is to supplement your income, your primary income, maybe start with small things. Maybe start with saying that, hey, like, you know what, maybe my goal is to cover 1 or 2 bills from Forex, right? That's how I started. I know my mentor Ted, he started with, oh, hey, like, if I can pay my gas from Forex, it's awesome, right? Because let's say the first 2-3 months you're like, hey, you know what, I'm just going to pay my phone bill. Maybe that's $50 or $100, and you're like, okay, the first month I'm going to aim to pay my phone bill. So first 2-3 months you pay your bills, you're like, okay, you know what, this is awesome. Now from Forex, my goal was to pay my phone bill, and it's actually happening, right? So maybe for the first 3-4 months you start to do that, and then the 5th and 6th month you realize that you're making enough to not only pay your phone bill, now you can maybe pay your cable bill or your rent, right? So I think that's very, very important, because then that's the time you realize that, okay, you know what, this Forex thing is probably scalable. I can probably start to work at it for the next 4 or 5 months, and maybe I can pay my rent from Forex. And that's when the change starts to happen. It's not going to happen in a month or 2-3 months. It's going to take you 6-7 months to get to the point where you can say, okay, you know what, I'm making enough, or I've scaled this out far enough that now I can maybe, leave my job, because now my rent is being paid and I've saved enough money, like bills money, to last me for like 5-6 months, right? So it's a process, right? It takes time, but the most important thing is you got to treat it as a hobby. This is very, very important. If you treat Forex as a means to escape what you're already doing or what you're maybe stuck in, it's not going to work. It's not going to work at all. Because if you go down that route, what's going to happen is that you're going to have a lot of pressure, and that pressure is going to be undue pressure to perform, right? And when you do things in haste, or when you do things under pressure, they normally don't work out. So that's why always treat it as a hobby, right? Because if you treat it as a hobby, you won't be pressured to succeed, right? Maybe let's say you start with the $500 account, and you treat it as a hobby. In a month or 2 months, it grows to, let's say, 800-900. That's awesome, right? Now your hobby, you say, oh man, you know what? I literally printed money from my hobby, right? Think about it. When you're trading, you're literally printing money, right? You are defying all the odds of, hey, you need to work X amount of hours or X amount of days to make money, but here you're just literally printing, right? So if you go outside and you tell somebody, hey man, you know what, I printed $10 or $15 on the internet in like 10 minutes or half an hour, it's going to blow their mind, right? They're going to turn around and say, holy fuck, man, like really, you printed money online? So that's a hobby, right? That's your hobby. You start small, right? You keep it disciplined, and then it starts to scale out, right? That's very important. Next thing in psychology is like how to adjust Forex in your life as a student, employee, or let's say if you're self-employed, right? This goes back to the first point we made, or this second point, that you need to have certain hours to trade, right? Let's say, hey, like you have a job and you go to your work at like 8 or 9, right? So maybe like, the time you can get is early morning. And if that early morning is your New York session or Asian or whatever the case may be, you need to set those hours, right? Like I know a lot of people here, they, just before they join, well, after they join, no, before they join, they won't want to wake up in the morning, right? Let's say they won't want to wake up at like 5 or 6 in the morning, or they won't want to like, you know, spend extra hours at night to trade the Asian or whatever the case may be. But slowly those things changed, right? Like I personally know some people who start to wake up early and now they're like, man, you know what, this waking up early shit, this is pretty cool. You know, I can wake up at 5 a.m. and try to trade, maybe win 1 or 2 trades and fuck, call it a day and go to my job. Isn't that amazing? Right? But it all goes back to the fact that you have to be willing to set those hours, right? Let's say you come home in the evening, right? And if you really truly are passionate about Forex and you're like, okay, you know what, this is my hobby, you're going to spend those extra hours adjusting to those times on the charts, right? It's very important. The number one thing is that you need to have certain hours, maybe not every day, because you cannot trade every day, right? If let's say you have a busy life, like you have your job and you have kids, you won't have enough time to trade every day. So in that case, you need to set certain days, like maybe Monday, Thursday, Friday, or like Tuesday, Wednesday, Thursday, or whatever, right? So you need to have those days set up. And that's the fact when you say, okay, you know what, this is my hobby, and these are the days I'm dedicated to my hobby. Because maybe down the road, this hobby is going to pay me back big. That's how you got to look at it. And it's not going to happen in a month. It's going to take you a couple of months. I'd say like 6, 7 months. It takes to like kind of like maybe understand, okay, what's happening. Right? It's very important. Psychology in trading is the hardest thing. Psychology is the only thing that's going to hold you back because everybody knows how to trade, right? But it's the psychology, and we're gonna keep talking about psychology in like all the examples too. The last thing is risk management, right? Risk management is, if not the number one, but the second thing after psychology is risk management. Right? Like really knowing how much are you risking, like really, because most times what happens is when people take positions, you don't really understand the amount of risk you have on. Because let's say if the price goes against you, you add another position and then you add another one. Now you might have your stop loss set, right? But just by typing I, tell me once it hits your stop loss and you look at your balance, you're like, oh fuck, this is more than I wanted to lose. That has happened to me. That has happened to a lot of people, and it still happens to a lot of people, right? So risk management is number one. Like whenever you enter a trade, you should understand, all right, when I'm entering this trade, what am I willing to lose? Like how much am I willing to risk? Right? Most people know that, but then, you know, subliminally they start to add positions and then they realize, oh, you know what, this was more than I wanted to lose. Right? And that goes back to the point as like what your goals are. Because let's say if you have $1,000 account and you're taking a $1 lot trade, would that make sense? That won't make sense because that's a high risk. We're going to talk about lots a lot too later on. But that was a little psychology part. If anyone has any questions regarding psychology, they can take them now, because after this we're going to move into, you know, what Forex is, pips and lots. Pips and lots, Mr. Mix-a-Lot. Okay, no questions? Perfect. Oh, we have some latecomers coming in. Okay, awesome. Let's go to the next part. Okay, so what we're going to do is we're going to try to answer all the questions as I move along. Like I know a lot of people are going to have a lot of questions as we move along, but you got kicked out? Impossible, you can't get kicked out. How does coming back every day at the same time works for swing traders? Good question. When you are swing trading, you're mostly looking at one entries, right? You're mostly looking at basically you're trying to take one entry per day, like if you're swinging, right? Because let's say if you're swing trading based on the weekly and the daily, what's going to happen is that you're actually, we're going to talk about swing trading later on too, but the way it helps is you're basically managing your positions while you're in swings, because you're looking at the overall weekly time frame and the daily time frame. And then on the smaller ones, let's say the 4 and the 1 hour, if the market is trending, you're looking at smaller retests to understand that, okay, what if the price is really continuing where you want it to continue. What to do when you are on a losing streak. When you're on a losing streak, you need to understand is how many trades you're taking, right? We're going to talk about that in the trading plan section, but losing streak only happens if you're over risking or if you're over trading, right? Over trading is like when I consider over trading when you're trying to take more than 1 or 2 trades a day, right? Because if you're taking more than 2 or 3 trades a day, you're opening yourself up to more risk, right? Which means you're opening yourself up to more losses. Because if you took 2 trades and then maybe you won 1 trade and you lost 1 trade and you try to take a 3rd trade, now you're risking a potential loss or a win, right? Because in your mind, you're like, okay, I'm at break even now. I got to go into profits. So now you're going to force, subliminally, you're going to force a trade to get into profits. Or let's say your account is at $995 and you want to get around $1,000, right? You're going to overtrade to get that $1,000, and most often than not, your balance is going to end up at like 950 or something. Because you tried to get that round number, it didn't happen. You forced a trade, and it became less. Yeah, exactly. So you have to stop trading. You have to stop after 1 or 2 trades. It's really hard. It's really hard. There's no PDF on it. There's no webinar on it on how to stop over trading. The best way to stop over trading is to just stop. Just to be mentally strong enough to just stop. It's hard, but you got to do it, man. All right. So we're going to start with what is Forex. I haven't really done the basics, like what the pips are and lot size are. So I think this was a really good opportunity for me to do that. So we're going to start with how is Forex traded, currencies, correlations, pips, taking positions, stops, profits, what these mean. We're going to go over basic price action. Like a lot of people still have issues with different time frames, how to use different time frames, and how, like, smaller time frames build up like the overall larger time frames. We're going to go over candles, how candles are formed, what wicks means, basically how to read candles, when are they opening and closing. We're going to go over zones, high time frames, low time frames. We're going to have market timing. I think market timing is really, really important, because I still get a lot of messages from a lot of people. They say, hey, man, like I tried to enter at 4 p.m. Eastern, right before the New York close, and, I got stopped out. So that's really important, that you really know when you're trying to take positions or when you're looking to trade. Because when you're looking to trade, you need to see if the market is really open. You need to see if the market is really rocking and rolling. Right, so that's something very important we're going to talk about. We're going to have a guest speaker here. We're going to talk about advanced price action here too. It's going to go a lot into what candles do when there's ranging areas, what candles do when there's consolidation, when price reaches zones, what to expect, how to read rejections, how to read continuations. There's going to be a lot of talk done on like wick fills, the difference between range fills and wick fills, booby trap handles. This is just a name I made to simplify a concept. We're going to talk about fake kangaroo tails, because, like, sometimes you see a kangaroo tail and you think, okay, you know what, price is going to go in my way, but in reality it doesn't, right? So we're going to talk about that. We're going to talk about there's a name called the fuck you candles, which just go completely the opposite way and it catches you from the blind side. So we're going to talk about a lot of breakouts as well, and how to place stop losses and how to take profits, or like where to take profits. That goes into your trade management as well. We're going to talk about chart traffic, what it means to look left, what does congestion mean, if you have empty spaces, and how to really gauge moves while you're looking left or when price is in momentum. That's very important. We're going to have some guest speakers. We're going to talk about EMAs. Some people don't really use EMAs, but what we're going to do is we're still going to add it in just as confluence, right? Because I think EMAs can provide a very, very strong confluence when you're trying to trade momentum. So we're going to do that too. Lastly, we're going to talk about trading plans, and then we're going to have some question and answer session. Okay. Let's see here. I have a question. Say you take a trade and you hit stop loss, but then the market gives you a second entry, but you have exceeded your number of trades for the day. Would it be overtrading? Yes. You need to really ask what you just said there, that you have exceeded your number of trades. That's it. You've exceeded your number of trades. That's it. You have to follow the rule, no matter what happens. Because when I hit on Twitch, I see a lot of opportunities to enter, right? But I don't, because I look at my trades, I say, okay, I've exceeded it. That's it. That's done. All right. So let's go. Let's start with what is Forex, right? Everybody knows this. Forex is a $5.2 trillion market, right? It's open 5 days a week, but does it really mean that you have to trade 5 days a week? Right? Because sometimes on some days the market just ranges. Let's say you're trading Euro JPY, and what happens in Euro JPY is that in Euro JPY you have good news, good moves on Monday and Tuesday, right? Then on Wednesday market starts to range. So right, so now you had moves on Monday, Tuesday. Wednesday is maybe not a trading day because market is ranging. And then Thursday, Friday, you have some moves here and there, right? So that's why it's open 5 days a week, but it's not important that you should be trading 5 days a week. Because sometimes, when you see in the webinars, if you guys have been exposed to Twitch sessions, you will know that some days I don't really take a trade, or some people don't really take trades because market is just ranging. So you have to understand this market is built for you to take trades, right? The whole platform, MT4, C-Trader, whatever platform you use, it's designed in a way for you to take trades, right? This does not mean that you should be trading every time, because it's like a big casino, right? When you walk in a casino, you see all these lights shining bright, and these sounds and music and the sound of money, right? That's enticing you to go and gamble, right? Forex is the same way. When you look at a platform, you see candles moving, you have the ability to look at the 1 minute candles. Man, I can assure you, if people could only look at the 4-hour candles, they would not take more than 4 or 5 trades a day. I can guarantee you that. If you had the ability to only look at the 1-hour candles and above, no 30-minute or 15-minute, 5-minute, people will only take 1 or 2 trades a day. Trust me, because that's the only candle they'll see moving. The 1-hour candles, the 4-hour, and daily, and they will get really boring. So the platforms are designed to give you the ability to look at the 1-minute candles, right? The 5-minute candles, the 15-minute candles. Now, sometimes they move so fast that it's enticing you to take trades, right? That is why discipline is really important, because most people get sucked into the 5-minute and the 1 minute, and that's where the 90% people sit, right? 90% population of Forex traders, they sit in that 1 minute to 15-minute zone, right? The 10% sits in the 1 hour, 4-hour, and the daily zone. Does this make sense? Because if you're in the 1 hour and above zone, what's happening is that you're being really disciplined, and you're maybe like, you know, being very cautious of what you trade. Because if you're only looking at the higher time frames, you're maybe taking 1 or 2 trades a day. But if you're looking at the smaller time frames, the 1 minute, 5 minute, 15 minute, you may be taking more than 2, 3 trades a day. That's where the 90% sits. That's why 90% are never going to make it, right? So you got to put yourself in the 10%, right? The ones that look at the 1 hour and above, and maybe take entries based on the 15 minute and 30 minute, right? So we're going to talk about that in a lot of examples too. So Forex market is open 5 days a week. Currencies are traded against currencies, right? Because like a lot of people, like when they came in, they say, oh, like, you know what? So if you have stocks, so stocks is like, you know, USD goes up and USD goes down. Rural, no, like, no, you're trading currencies against other currencies. Let's say you have USD JPY, right? This is a currency. So USD JPY, so USD is traded against USD JPY. That's why you have the price of it as 111 dot, let's say 0.15. So that's what's happening here, right? So prices can go up and prices can go down in a very, very simple format here. So we're trading currencies against other currencies in the Forex market. That's why it's really, really huge, right? It's huge, it's volatile, and you have opportunities to make and lose a lot of money, right? Because when you look at the stock market is considerably smaller than the Forex market. I think stock market is like some billion, some 100 billion, something like that. But this is trillions, right? So it's considerably larger. It's considerably volatile, right? So that's why you have a lot of opportunities to make or lose a lot of money. So that's why, you know, like I have some guys who came from stocks into Forex and blew their minds. They're like, man, this thing is wild over here, right? This market is so fast. Now, in order to trade Forex, you have brokers or brokerages, right? Brokerages give you the ability to look at the market as it is, right? Let's say you go to the gaming arcade, right? So you go to the gaming arcade through a company to play games. This is the same thing, right? You go to a broker to place orders in the market, right? Like the broker allows you to trade in the market. So essentially saying, let's say you go to your bank, you give money to the bank, and the bank says, okay, so we're going to put this money in an investment, like, you know, in an investment vehicle, and you can watch it grow. You're like, okay, perfect, you got the money, you're handling it, okay, awesome. But over here, what's happening is that you have the ability to control your own trades. Right now, it's the same thing. You're giving money to the broker, and then the broker gives you tools to trade in the market. Makes sense? So that's like a small rundown of like how you're actually trading in the market. So now, when you're trading in the market is just like a little school, right? In school, you have classes, and then you have classes at different times of the day, right? So in the Forex market, you have what they call is sessions, right? Sessions are basically your Asian and Sydney's session. They almost open at the same time. And then you have your London market, the European market that opens, and then you have your New York session, right? Now, when sessions open, in between these sessions, there are like dead zones, right? Because when you notice you have the Asian Open, after Asian Open, there's going to be a dead zone where market is going to consolidate, right? That's when there's no activity, because you got to realize is that when Asian session opens, that means people are going to work in Asia, right? Like they go to the banks, they go to the institutions, hedge funds, here in Asia, and like, you know, that's where you see a lot of volatility in the market. Now, when Asian session closes, that means people are closing down for the day and going back home. That's why you see there's a lot of consolidation, because there's basically no one to take orders, right? There's no one working there. And then you have the London Open. Same thing happened. People come into work, they go to the banks, institutions, hedge funds. That's when there's a lot of volatility when London opens. Right, and then you see London dying down because, you know, it's lunchtime there, and then New York opens, same thing happens, right? They come into work, there's a lot of volatility, like a lot of orders are taken. So that's how sessions work. So that's why it's really important that you really understand that what are the times in the market when you should be there present, right? When there's a lot of volatility, when there's a lot of action, when there's a lot of volume, right? That's your biggest opportunity, maybe to enter positions for swing trades or to make like small scalps here and there. Okay, so we're going to move on to the very basics, like how currency pairs are traded, right? And basically, currency pairs, what they do is they move in price ranges, right? So what happens is when the price is moving, that movement is measured in pips, right? That's how the movement is made. So like, let's say, for example, you have USD JPY, right? And USD JPY goes from 111,450 to 111,650, right? So that's an increase of what, 250 points? 200 points, yeah, I'm sorry. Increase of 200 points. That's also called 200 micropips or 20 pips, right? So 1 pip is 10 micropips. Some people use micropips, some people use pips, but for simplicity, we're only going to use pips, right? So 1 pip is 10 micropips or points. That's how it's measured, right? So now, even if we look at Euro USD and price moves from 1.30240 to 1.30100, that's a change of 14 pips or 140 micropips, because we're counting the last 3 numbers right over here, and we're counting them also right over here. The last 3 numbers, that's what you count, right? So if it's a change of, let's say from 240, it changes to 340. So that's a change of 100 points, right? Or 10 pips. See? Who uses micropips? Yeah, we used to use micropips when we started. We used to use micropips back in the day, right? So I'm pretty sure like a lot of people know now, if you are in buys, what's going to happen? If you're in buys and price goes up, your pips, they become positive. Make sense? Very simple. If you're in buys and price goes down, your pips become negative. That's really important to understand, right? Your pips become positive and negative. And then if you're in sells and price goes up, your pips become negative because you're expecting price to go down. If you're in sells and price goes down, your pips become positive. Makes sense? So now there's another thing called spreads, right? How do brokers make money? Brokers make money through spreads and commissions. Excuse my bad handwriting. Spreads and commissions, right? So sometimes, like, you see spreads on, let's say on USD JPY, the spread is going to be 14 points, right? So what's 14 points? 14 points is 1.4 pips. Okay, for simplicity, we're saying USD JPY spread is 14 points, which is equal to 1.4 pips, right? This means that if you enter on USD JPY, right, the broker is automatically going to enter your price like that at 14 points, right? So what's that going to be? So let's say if you enter a buy at 650, your position is probably going to be entered, like 14 points above, because broker gets this spread as soon as you enter. That's why when you enter positions, it's always in negative, right? Because that spread accounts for, like, your ability to take positions in the market. Same thing happens with commission. Now on standard accounts, there is no commission, but on standard accounts, you have a higher spread, right? Let's say instead of a 1.4 pip spread on standard account, this is going to be maybe, let's say 2.2 pip spread on a standard account. But on ECN account, you have a small spread, but then you have a commission, right? It depends on the broker how much commission they charge, but that's how it happens. How is there 10? Oh, 100. Probably there's going to be more too later, right? So commissions are charged on ETN accounts, but they also happen on smaller spreads too. I'm sure a lot of people here, they have ETN accounts, so they also pay commission, but they have less spread, right, as compared to the standard accounts. All right, this was the very basics here. Oh, let me see. I think someone is having issues. Okay, I don't think anyone's having issues joining. Okay, let's head off here. All right, how is money made in Forex? When new people join in, they ask me this question all the time. Okay, so like, what does the lots mean? Most people don't understand lot sizes. They don't, well, they understand lot sizes, but they don't comprehend it, right? The what it actually means like in the long term. So let's say for the sake of simplicity, you have a 0.01 lot and price moves 10 pips, that's equals to $1, right? In the same way, if you have 0.02, which is 2-cent lot, that would mean if price moves 10 pips, that's going to be $2, right? In the same way, if you have a change of 15 pips, so that's going to be $1.5, right? And as you go up the lot sizes, let's say you go to 0.10 cent lot and the price moves 10 pips, that's going to equate to $10. Makes sense? So now from this point, if you go above to like $1 lots and price moves 10 pips, that's going to equal to $100 lots. So now you have to take this into account, right? Now you have to understand that the price is only moving 10 pips, right? But the outcome is increasing considerably, right? So the point I'm trying to make here is that when you come into trading, what you have to do is you need to understand that, okay, your job is to acquire pips, right? Your job is to acquire pips, because if you can get confident in maybe catching maybe like 15, 20 pips every day, if you can get confident, your lot sizes are just going to increase naturally, right? Because most people, they're not as confident in betting wins. Maybe the thing is that they're using small lots, because sometimes what happens is that you use a small lot to catch like 15 pips or whatever, you catch those pips, but then in your mind you're thinking, oh man, I caught this move, it was a nice move, but I had a very small lot size, so now I'm going to increase my lot size and I'm going to try to catch another move, right? Now you don't understand that you caught 10 pips or 15 pips or 20 pips. That means that you are in the top 10% people who won a trade, right? That's something you need to realize, that you won a trade. It does not mean that you should be focused on how much money you won, but you should focus on that you won a trade. It doesn't matter what lot size you had, right? But you caught pips. That's what it means when you get confident in winning, right? I tell people this all the time. There's a guy here, he messages me every morning with his analysis, and he basically wins one trade every day, right? Maybe he's going to win 2 trades in a row. The third day, he's going to lose a trade, but the fourth and fifth day, he's going to win a trade, right? Because when you can get confident in winning trades, not looking at the money, but just winning trades, then your lot sizes then naturally go up. That's how you start to compound, right? Because let's say in a week you take 6 trades and you win 4 trades or 3 trades, you know the next day that you can probably increase your lot size, because now you're getting confident in winning trades. Okay, let's take a look here. What's going on here in the chat? Here we go. All right, let's go to the next slide here. So we're going to talk about leverage. Leverage is basically, I think, like a lot of people, they confuse high leverage and low leverage. Some people think that, hey, you know, if you have a higher leverage, it's better. But the reality is, if you have a higher leverage, that also means that you have a higher risk to lose a lot of money, right? Because leverage means, I think, for simplicity's sake, I think leverage is directly proportional to how much you can risk in the market, right? Because let's say you have 10 to 1 leverage, or if you have 100 to 1 leverage at a time, maybe you could only risk 7% or 10%, right? Because you won't be able to add on more positions, because having a leverage is like having like a bandage on. Because what's going to happen is that once you get to 10% risk at one time, the broker does not allow you to take more positions. But in the other way around, if you have 1,000 to 1 leverage, you would be able to take on more risk, right? You would be able to take on maybe 40% risk at one time, right? So that's what's the difference between a higher leverage and a smaller leverage, right? When I started with the 500 to 1 leverage. That's I think that was a little too much. I think having a bigger leverage, it is what allows people to, like, risk more than they actually want to risk on one trade. Because if you have a smaller leverage and if you're new, I think that's the best, because that's the best way to apply low risk and also to exercise, like, maybe trying to get confident in getting winning trades with lower leverage, because you cannot risk a lot. And once you get confident in winning trades, maybe then you can go up your leverage, because now you're like, okay, you know what? I'm confident in winning trades. I can have winning trades. So if I go to a higher leverage, I can probably risk a little bit more to make a little bit more money, because I'm consistently winning trades. Make sense? Let's see here. I just want to make sure that people can still join. Should be able to join. We can have around 600 people, so that's not a big issue. Okay, let's go to the next slide here. Let's see. Now, taking positions, profits, and stops, right? So whenever you're looking at the market, the first time you look at the chart, the instant decision you make is, okay, whether the chart is moving up or whether the chart is moving down, right? That's the first thing you look at. But the second thing that people should look at, that they don't look at, I hope you're taking notes. The second thing you should look at is, okay, if you say the chart is moving up, you need to understand, all right, if it's moving up, where will my stop loss be, right? At what point should you say that, okay, maybe my stop loss should be at this certain point, that if the market does not do what I want it to do, it should take me out instantly. Make sense? Most people move their stops. Most people move their stops. Most people, like, they remove their stops. Some people remove their stops, and then they message me, hey, I got fucked today. No, you let yourself get fucked because you moved your stop, because you didn't really do the step 2 that, okay, if I say price is going to go down, this is an area, if price gets here, it's no longer heading down. So you should already identify where your stop loss is going to be. The same thing goes with take profits as well. Like, you should already identify that, all right, when I take this trade, this is the point. Okay, let me just do some meditations here. So when you take a trade, let's say price went up, came down, and it's doing some moves here. So now when you take a trade, let's say here for a buy, right, you need to understand that, okay, I'm taking a buy over here, and maybe this is where my stop is going to be. Because if price goes through this place, it's going to continue moving down, and there's no reason that it should go back up, because you're taking a buy here. Number 1, you're identifying it's going up, and number 2, you're identifying where your stop loss is going to be. So you're identifying a stop loss area. And number 3 is you're identifying where you're going to take profits. Because a lot of people, they message me saying, hey man, like, I'm in this trade, where do you think I should take profits? You should already know that, right? So we're going to go through a lot of examples here to give you some ideas where your good take profit targets should be, where your stop losses should be. So we have a lot of fun stuff planned out here. Right, we're also going to talk about a lot of trading stops as well, how to put trading stops, mostly how I use trading stops based on candles. All right, so we're going to move on to how the market actually moves. So now we covered what Forex is, what currencies are, what pips are. Pips are basically measurement of price, right? So when price moves, the measured value is called a pip, right? We looked at what lot sizes are. We looked at, like, what stop losses and take profits are. So now we're going to look at how market actually moves, right? Now, market moves in three ways, right? The number one thing is consolidation, because when you're looking at a chart, like let's say on Sunday, when Sunday market opens, it's going to open later on, but like let's say some people are going to trade New York. So on Monday, when you look at the market, you need to realize is that, okay, is the market consolidating, right? Consolidation means, like, let's say you're looking on the 1 hour time frame, or you're looking on the 4 hour time frame, and you see that candles are only moving up and down, like in between a range, or they're trying to, like, wicking up and coming back down, but they're not really closing above or below the range, right? So that's the number one thing. You need to understand, okay, if the market is consolidating, you stay out of it, because consolidating market is a no-go, right? This is where you try to lose money, or like this is where all your money is lost, because let's say if the market is ranging, right, and you have a candle going down really, really fast. Now, candles going down really, really fast, it goes through support, and what happens? Like, your impulse comes in, you're like, holy shit, this is going down, I want to take a sell. So you take a sell. You take a sell, and instantly what happens is that the candle starts to go up, you become the wick, and candles closes back in the range. And then candles starts to go back up again, right? Has this happened to you? It happened to me a lot of times. Sometimes it still happens, right? Because that impulse comes in, and you're like, okay, I'm taking sells. This is where you need to wait for candles to close, because essentially what you're doing is you're waiting for candle to close below the area. That a little bad voice. Okay, yeah, right. So, and same thing happens when price starts to go up. You realize, okay, we're starting to break up, but the candle hasn't closed. If you're not waiting for the close, what you're going to do is you're going to take a buy, right? You take a buy, and then price starts to pull back down, and then your buy is in a drawdown. You close your buys, and then what happens? Price goes back up, does a retest, and then continues to go up. Right? So that's why you really, really wait for candles to close, because that's when you will understand that, okay, you know what? If this is breaking up, maybe now it's not consolidating anymore. So when price is consolidating, you stay out of it. You stay far, far, far away, right? And like, it's what they say, that in Forex you get paid to wait. Like, you're actually waiting for something to happen that you've seen before. Right? So market moves in consolidation, and then the market moves in an uptrend. On which time frame do we wait for candles to close? How's it 30 minutes? We're going to talk about time frames and examples. We're going to answer all the questions. Don't worry. All right, and then you have uptrends, right? Uptrends are really easy to spot. I would say, like, let's say if you're looking at a chart and you have a big 4-hour candle, basically, so then you can say, like, you know what, there's a lot of movement happening, right? Uptrends are basically prices moving up. It's creating a resistance, and then it comes down. It starts to create a support, right? So when it starts to create a support, then you can say, okay, you know what, price made a high over here, it's creating a support, and now it's a very, very high chance that price is going to continue moving up to retest this high. And then what's going to happen is price is going to continue moving up, or do a little retest, and then continue to move up, right? So it's very important. Yep, exactly, Matt Lopez. Higher highs and higher lows. But what happens is, what happens is with most people, what they do is that if price is making a higher high, let's say price makes a higher high right over here, right? And then what happens is the price starts to come down. What happens is that people are not going to wait for price to create a support. They will take a buy. Price moves down more, they'll take another buy. Price moves down more. That you have to wait for price to make a higher low, which means you have to wait for price to create a support, right? Let's say if this is the 1 hour time frame, maybe you're looking at the 30-minute or the 15-minute to create a support, right? Once price creates a support, then you know, all right, now price made a high over here, and now it's creating a support. If it's creating a support, there's a very high chance that price is going to continue moving up to retest this high. This is when you look left to see that, okay, we're trending up, and so we're going to retest the highs. Now in the opposite spectrum, you have downtrends, right? Downtrends are the same thing here. Like price moves down, it creates a low, it creates a lower low. Price moves up, it creates resistance on 30-minute or the 15-minute, and then continues to move down. And the same thing happens if you're trading on the daily, the 4-hour, and the weekly, right? Let's say the 4-hour made a low, price moved up, 4-hour created resistance, and then it starts to go down to fill this range. It happens in all time frames because candles move the same in all the time frames. But for simplicity's sake, I only look at, let's say, the 30-minute and higher, because when you're looking at the 15-minute and lower, what that means is that the 15-minute time frames, they can have a lot of like fake confirmations, right? The confirmations aren't that strong. So that's why 30-minute, 1 hour is the best, 4-hour is the best time frame for confirmations, because that's where you see that, okay, like, you know what, levels and zones are going to be respected more. Someone asked, support will only show some consolidation. Yes, that's exactly right, because when price is moving, what happens, right? Price moves in 3 ways: uptrends, downtrends, and consolidation. So let's say price is moving up and then it starts to consolidate, right? Because it got tired, starts to retrace, creates a support, and then starts to move back up again, right? So price moves in waves. So you're right, Matt Lopez. So what price is going to do is going to have some sort of consolidations. I'm just going to quickly check here. All right, we're good. Just making sure that no one's, trying to get in the candle. Get in. Okay. What time frame would you want to see the support former when trending? Okay, yeah. So we're going to go over all those questions too later. But basically, you're looking at the 15-minute and the 30-minute to create supports or resistances to understand that, okay, maybe this level is being respected. So for simplicity's sake, market moves in 3 directions, and it's your job to identify when there's consolidation, when there's an uptrend, and when there's a downtrend. We're going to go over a lot of examples here, so we're going to go over all these situations as well. Now, the next thing, the most important thing, is candlesticks, right? What are candlesticks? Now, one big misconception is that institutions can watch your charts. Institutions don't watch candlesticks. We are retail traders. Only we have the ability to watch candlesticks, because that's what we see, right? Because candlesticks are basically formed. Okay, so back in the day, I had a friend here. What he used to say was that they used to trade Forex based on prices, right? So what they used to do was that they used to look at price. So let's say they'd look at price at 1 p.m., right? At 1 p.m., they would say price is at 150 for simplicity's sake. Price is at 150. And they would see that, okay, in that 1 p.m., price went up to 160, and then by like 130, price was at, they would say price was at 140. 140, let's write 140 here. And when this hour closed at 2 p.m., price was at 100. right? So when a candle is forming, what you have to understand that is, let's say from 1 p.m. to 2 p.m. price went from 150 to 100, right? So there was like a decrease in price. So this decrease is the bearish candle, right? It's the bearish move because price went from 150 down to 100. So what happened? Price opened over here. Price went down to 100. They had a candle. And in this 1 hour, price also went up to 160. So that 160 is a range. So now candle closed with no wick because during 1 to 2 p.m., price could not go below 100. Because if it went to, let's say, in this time frame, let's say price went to 90, but it closed at 100, then you can say, okay, now we have a wick now. So this is what they used to do. This is how they used to draw candles back in the day. They'd look at the price, and then they would draw a candle, right? And that did not allow them to overtrade because they were manually making candles. So now we're gonna go into the anatomy of candles and how candles are basically made, what they mean, what wicks mean, open and closes. I think that's very, very important. Okay, so number one thing, you have a bullish candle, and bullish candles have wicks to the top and the bottom, right? So what happens here is when a bullish candle is formed, this means the candle started at the bottom. This is where the open was, and the candle closed at the top. This is where a close was, right? And then you have these wicks. These wicks are basically ranges, right? So when a bullish candle has a lower wick, this means this lower wick is a liquidity wick, right? This means that price gathered momentum to make a lower wick, and then it started to go up. So when it went up, it created this top wick too. So now when you're looking at wick fills, or when you're looking at wicks at ranges, so that means the price created a range for the next candle, right? Because now when the next candle is going to form, what you're going to realize is that, okay, maybe the next candle, what it might do is that, it might create a lower wick, and then it might start to head up. Make sense? Because this current candle, it created a range on the top for the preceding candle to fill it. Make sense? So that's how candles are formed. Like this candle started at the bottom, opened at the bottom, closed at the top, and then you had these ranges here. It formed a wick, and then this wick was formed for the next candle to close. So now, if you're looking at the bullish candle and you're anticipating that, okay, now price is going to move up, and if this is a higher time frame, I hope you make notes on this. If this is the higher time frame, what you can say is that, okay, as long as price stays below the low of this candle, it will continue to move up, if this is the 1 hour or the 4 hour time frame. This happens, I would say, 60 to 70% of the time, right? If you guys have seen Twitch sessions or some simulation sessions, I always stress on keeping the stop below the previous 1 hour or the 30-minute candle, because that's a strong confirmation. Because if the 1 hour candle is rejecting an area, that means that area is strong enough to be rejected, and price should not go below that area to continue to move up, right? Same thing happens when you have a bearish candle. You have a bearish candle right here. A bearish candle has a wick to the top, and a bearish candle has a wick to the bottom, right? In this case, the opposite happens. This candle opens at the top, and then it closes at the bottom, right? So now while this candle was forming, it tried to move down to make a range, and it tried to move up too, right? So this move up is basically called liquidity, like it's grabbing liquidity, right? So now a lot of times what's going to happen is that when you have a candle formed like this, which has like a nice wick range, what you can basically visualize is, now let's say if this is a 30-minute time frame, or let's say this is a 1 hour time frame, right? Now I know what some of you guys are thinking, that, okay, maybe the next candle is going to create Maybe it's going to create a wick to the top, and then there's a high chance that it might fill this candle and create a wick to the bottom as well. Makes sense? But now at the same time, we're doing the same principle here too, that you're saying that, okay, if it's continuing to move down, maybe I can have a stop above the previous candle, if that's a 30-minute or the 1 hour, because that time frame is that strong. Because if the 1 hour candle is rejecting a zone, that means that's a strong rejection, right? But when you look at the 5-minute time frames, and if they reject a zone, I would not look at that as a strong confirmation because it's a smaller time frame. 30-minute or the 1 hour would work the best, right? Because those candles are strong, strong candles. It's like saying that, hey, like, you know what? These candles, they mean what they say, because that's what they're trying to move. Why candles sometimes are not filling wicks? Sometimes candles don't fill wicks because maybe they're at a support, maybe they're at a major zone. That's why they don't fill wicks. Sometimes, like, you know, you have candles that form maybe something like, you have a body like this, you have a wick over here, and then you have a big wick like this, right? So it's really important that you look at the strength of the candles too. What I mean by strength is that you're looking at the bodies of the candle, at how strong the bodies are, right? Because if you're looking at, let's say you have a wick over here and you have a wick over here. So now if you're looking at this body, this is a strong bodied candle, right? This bodied candle means that there's strong bullish momentum, especially if this is on the 1 hour or 30-minute or even the 4 hour. Then you know there's strong bullish momentum, and the next candle should continue to go up, right? So let's say we're disregarding this candle here, and we're only looking at this candle right here. So now when you have a candle like this, and you're looking at the body, you're saying to yourself, hey, wait a minute, if price is moving down and you have a candle closing like this with a small body, this means that there's the pressure to go down is dying, right? Even though you want to sell, even though you think this candle, the next candle should fill the wick, the pressure to go down is dying because this body is getting smaller. So it's very important you look at the candles this way, that how strong did the candle close or how weak the candle closed. For a candle to have a wick, that means at some point of its creation, or was that color of sometimes, no, it has to be a lot to enter something. Yeah, exactly, right? So that's very, very important. Also, the size of the candle matters. They say size doesn't matter, size does matter. Like, you know, now you can say it's all about how you do the motion in the ocean, but in this Forex motion, in this Forex ocean, the motion of the candle matters. The size of the candle matters. You know, it's just very important. See, we got to look at candles in a very simplistic form. How's my pace right now? Pace good? Not too fast, not too slow? Good pace? Oh, perfect. Oh, awesome. Thank you. Awesome. All right. Let's go to time frames. Time frames. So I messed up here. This should be 6 4-hour candles to make the daily candles. So before someone starts to roast me, I admit my mistake here. So, you know, let's just come. Time frames. You have all these time frames to trade, right? Remember when we said that that the platform is built for you to take trades? This is what I mean. Like, you have the 1 minute time frame, the 5 minute time frame, 15, 30, 1 hour, 4 hour, daily, monthly, weekly, so many time frames. But now what you got to realize is that what are the most important time frames, right? What are the most important time frames? The most important time frame would be your 4 hour, your daily, right? 1 hour as well. Before swing traders start to roast me, I'll say weekly as well, right? But the most important one, I'd say, would be the daily time frame. Because when you're looking at, let's say, the New York session, right? You're looking at where the daily candles are moving, right? And based on the daily candle moves, you're taking a trade. I would say that if you're looking at 5 minute or the 1 minute, like I know a lot of people, they look at the 5 minute and 1 minute because they say, hey man, like I can look at these smaller time frames, and what essentially I can do now is I can take a lot of trades, and then I can win a lot of trades, and then I can win a lot of money. That will happen for the first 2 days, and then you're gonna get nothing. Trust me. Small time frames are your enemies. I say the small time frames are put there on purpose to fuck you up. Because when you're looking at a small time frame, you see all these candles moving, and you're like, oh man, look, 5 minute creating support, 1 minute creating support, buy. Oh no, it goes down. Because in reality, you weren't waiting for the higher time frame to close, right? The 1 hour or the 4 hour. It's very important because sometimes what's going to happen is that the candle is going to be bullish, and there's going to be 5 minutes left for the candle to close, the 1 hour candle to close, and people are going to try to take a trade. And what's going to happen is in those 5 minutes, the whole candle can flip. The entire candle can just, it can just close in a way where you're like, oh shit, now what do I do? Right? That's why time frames are very important, that you need to choose specific time frames. I would really advise people to start looking at the 30-minute to 1 hour to 4 hour time frames and start to see that, okay, where can price be going? So we're going to talk about where price goes and how it goes later on in the examples. We're going to clear up a lot of confusion here too. But these are time frames you need to look at. You also need to understand that the smaller time frames build the overall larger time frames. Makes sense? Like the two 15-minute time frames, they build the 30-minute time frame. And then two 30-minute time frames, they build the overall 1 hour time frame. Makes sense? Because let's say you have a daily candle, which is like this, it has a nice wick, and now you're expecting the next daily candle to form something like this, right? Now it looks really easy on the daily time frame because you have a clean candle. But if you're looking on the 1 hour time frame, the candles are probably going to look something like this. Price came down, price went up, and price closed somewhere here, right? So this move down is this daily wick, right? And then what's going to happen is it's going to consolidate, price is going to move up, and then it's going to come move down, fill this wick on the daily, move down to make a wick, and then go up. Makes sense? So now you're looking at the overall 1 hour time frame in the market structure, but the overall daily looks much cleaner, right? So we're going to talk about this later on here in the examples. Okay, time frames are really important. Make sure you know what time frames you're looking at. If you're trying to take 1 or 2 trades a day, I would really, really, really encourage you to look at the 1 hour time frames and the 4 hour time frames, because you can get some really good moves on 1 hour and the 4 hour, and that way you can also eliminate a lot of your overtrading problems as well. Okay, let's go to now. The most important thing is now, what is momentum and what is volatility and volume, right? So volume is caused by sudden changes in the market. Sudden changes in the market means when there's market opens, market closes, there's news, breaking news, speeches, right? Because when there are like extreme changes in the market, that means that, hey, there's a lot of volume in the market, because there's a lot of, I'd say that there's volume and volatility, you can relate that to adrenaline being pumped in the body, right? Which makes the body moves in the same way it makes the market move. Or when you take pre-workout and you go to the gym, now you have a lot of energy. That's what it means to have volume in the market, or volatility, when there's a lot of movement, there's a lot of orders, because that's when you see, let's say you have the London Open. When London opens, there's a lot of orders coming in and out of the market, right? So that's when you realize, okay, like, you know what, London is open, there's a lot of orders, so now there's a lot of volume in the market, right? Also when there's Asian Open, or when there's New York Open, or when there are news events, those big news events like CPI, NFP, interest rates, you know, like GDP news, PMI news, you know, home sales, like all those things, they cause volume in the market. And that's where the money is made, like when there is volume pumped into the market, right? Now, what is momentum? I always say that momentum is not seen, momentum is felt, right? It's a name given to the movement of the market, right? When there's a lot of volume, when there's a lot of momentum. Let's say guys say that, hey, like, you know what, you need to go to the gym every day, right? With intensity. So you go to the gym every day. Now, when you start to go to the gym for the first week and the second week and the third week, now you have some momentum, right? You have momentum that you're going to the gym every day. Same thing happens in the market. When you see price moving really fast up and down, or let's say you see price that's constantly making higher highs and higher lows, that's when you say, oh, listen, market is in momentum, right? And the momentum is, let's say, bullish. So you say, okay, market is in momentum because there's a lot of volume in the market. There are a lot of orders coming into the market, which is making market move. And then you turn around and say, okay, now the market is in momentum. Make sense? It's very important because more times you come to the market at the same time, you will realize, okay, maybe this is the time when market is in momentum. Because like if you look on the webinars, or if you come on the Twitch stream, we always come at like 6:30 or like, you know, around 7 a.m. Eastern, 7:30 a.m. Eastern. We're going to say, okay, you know what, this is a time when there's going to be a lot of, when market is going to be in momentum, because a lot of volume comes into the market in pre-New York, in New York's session, like when it opens. So that's the thing about momentum and volume. Let's see if anyone has any questions in momentum. We're going to talk about momentum later on as well when we do the examples. Okay, no questions? All right. Let's move on to market sessions. This is also very important when you're building a trading plan. Market sessions, okay, and market timing. All right, so market timings are basically the times when there's a lot of volume in the market, right? When there's a lot of volatility in the market. That happens when market opens, that happens when market closes, and that happens on news events. You really have to understand, like, there are a lot of people still who don't really look at, the Forex factory, or they don't really look at when there's a lot of news and stuff. So this is really important that you should know what time are news coming in, what time are markets opening, what time are the markets closing. We're going to do a little rundown here. First of all, you have the pre-London session. This is when there's a lot of volume in the market. Pre-London starts after the Asian close, right? This is when the London markets are starting to open up, right? When it's starting to open up, they're processing what orders happened in the Asian session. So they start to process those trades and start to open up. So now then you have London open. This is when your banks start to open, your institutions start to open. This is when your hedge funds start to open. So that's why you see a lot of, like, you know, wicks, a lot of, like, you know, large candles. You see a lot of volume in the market. And like, you know, this is when they say the market is rocking and rolling. After London Open, this time is pre-New York time. Like, it's between 5:30 a.m. till 8 a.m. Eastern. This is pre-New York, right? So now pre-New York and London overlap is the most volatile time of the market, because now you have to realize is that London Open is affecting euro, it's affecting GBP, It's affecting CHF. I know I'm missing a few more currencies, but these are the main ones. And then when you have London, when you have US Open or the New York Open, it's affecting US dollar, it's affecting CAD, it's affecting gold, right? So now when all these currencies are open at this time, you understand that, okay, you know what, there's going to be a lot of volume in this session. But if you're only looking at London, right, you can see that London may only affect these three currencies right over here. And then you have the slowest one, which is your pre-Asian, and you have your Asian session, right? So now, the reason I have these times here is so that when you're building a trading plan, you understand that, okay, maybe a certain time suits me best, right? I can look at myself and I can tell you this right now, that when I'm trying to trade, I think this time right over here, it suits me the best because I can wake up early and now I know I have 3 to 4 hours to look at the market, right? And when I can look at the market in this time, what's going to happen is that I can probably train my mind to know how market moves at this time. Because trust me, market will not move the same in pre-New York than it does in London, you know, or when it does in Asian. Market does not move the same way because in Asian, you have a lot of consolidation because there's less volume in the market, because there's not much happening. Because in Asian, you only have JPY open and you have AUD and New Zealand open. Sorry about the mess here I'm making, right? So there's less volume. But it does not mean you cannot trade the Asian. There are a lot of people who trade the Asian session and they do it very successfully, right? So even if you only get this time to trade, I still think this is a very good time to, like, you know, really train your mind to the movement of the market, because you'll get 1 or 2 pushes. You know, same goes for pre-Asian. This time also suits me best because I'm home and, like, you know, I can still trade. But so the rules for setup, support, resistance are the same. Yeah, the rules are the same. We're going to go over all of that later on when we talk about examples. So we're gonna go over all of that. So would be best to trade New York, London rather than forcing Asian because that's like 1 a.m. our side. Yeah, sure. Yeah, that's fine too. If the time works for you, then that's awesome. Because trust me, like a lot of people, they look at the Asians session and they think to themselves, okay, you know what, the Asian is pretty slow, so we're gonna probably, like, you know, skip it. But truth be told, I know a couple of guys who are very, very successful. They're making a lot of money and they only trade the Asian session because they've put in the time to look at the Asian session and they've understood the way it moves. That's the important key, that you understand how a session moves. Because like a lot of people, they know a lot of rules, but they don't know how a session moves. That's very important. Trust me, my most profitable session used to be Asian session, right? Because what would happen is that I would trade, back in the day, I was trading all the sessions. So I would trade the Asian, I would make money, and then I would go trade the London. I would lose money. So this was a no-no because I was waking at midnight, like, you know, in the middle of the night. And then I would trade the New York. And in New York, it used to be 50-50. So what I did, I looked back at my trades and I realized, okay, you know what? I don't need New York and I don't need London if I can only make money in Asian. So I started to do that. And then with that, I started to look at New York session later on. And then it took me a couple of months to actually identify that, okay, maybe in New York during certain times I can catch a move because that makes sense to me. So you have to keep watching it to make sense. Rakil, by the way, New York and UK session, which one do you think will be more volume? New York and London overlap has a lot of volume, but if you're new coming in to market fluidity, I would really advise you to pick a time and only focus on that time. Yeah, we're going to look at the how to make a trading plan too, but the most important thing is that you need to pick a time first, right? Like a lot of people are going to be a lot of a rush to trade. They're going to be in the pressure to take a trade, but trust me, the best thing to do is just to sit back and watch how the session moves, right? This also goes into the fact that, like, you know, like a lot of people, what they do is they say that, hey, like, you know what, I'm only gonna look at London, and after they're done looking at London, they'll still be looking at charts maybe at this time right here, and then they'll turn around and say, oh, you know, I'm just looking at charts for practice. No, that's bad. When you're only trading London, you're only looking at the London charts for practice. You're not looking at Asian, you're not looking at pre-Asian, or you're not looking at New York. No. You're only looking at this time here, the London time. That's the only time you're looking at to practice or to trade. Right? This is very, very important. What would you do if you work in shifts and you can only trade this, and you cannot trade the same session all day? Yeah, we're gonna go over that too. That's more of a private conversation, so we can do that later. Let's move towards some more fun stuff. Next thing we're gonna go over is zones, support, resistance, zones, ranges, strength of zones. So we're gonna go over that here in a bit. Let's start that with zones. Right? Now, supply zones are basically, you can look at it as like, you know, something where something is supplied from, right? So if someone is supplying you with something, that means they're selling you that stuff, right? So that's a selling zone, or you can also call it as a resistance, right? A demand zone is where something is in high demand. You know, when something is in high demand, that means you're buying into it because it's high demand, everyone loves it, so they want to buy it. So that's what's attractive to buy, and that's called the buying zone, which is also called support. Right? So for simplicity, you can say that support, resistance are basically, you know, supply and demand. They're just different names given to the same concept. Okay, the strength of the zone. The strength of the zone is measured by the amount of candles stuck there. This is very important, okay? I hope people make notes. The strength of the zone is the amount of candles either stuck there or by a force a candle is rejected from it, right? So let me give an example here. Let's say you have a candle like this and you have a big wick at like a zone, right? A candle can be like this too, and you have a big wick there, right? And this could be your entire zone, right? So when this happens, sometimes this means that this is a strong ass zone, right? Especially if this is a 1 hour or a 4 hour candle, and the candle does this in a price level, you're looking left at the price, right at the price, and you're like, okay, maybe this is a strong ass zone, right? So this means that, okay, pricing can continue to move up because it got rejected really heavy. Or when you have price that comes down and it starts to consolidate, then you know that, okay, price tried so many times to break, right? It tried 1, 2, 3, 4, 5 times to break. It could not break. Yeah, it could not break. So what happens? It starts to go up, right? Because you had a lot of candles consolidating. This means that this was a strong zone. It could not break, right? So that's how the strength of zone is measured. So now if you have the 1 hour and 30-minute candles that's been stuck, so that's going to be a very, very strong zone, right? If you have, let's say, the 4 hour or the daily candles rejecting a zone, that means it's an extremely strong zone and it's most likely to continue the opposite way, right? Now, when you're looking at the weekly and monthly, like I know some people here, they trade on the weekly and monthly. Not a lot of people, but some do. That requires a lot of discipline. That's a lot of willpower. I think I have a lag with the speech and what's appearing on my screen. Oh, maybe it could be your internet. All right, so that's how you measure strength of zones. Strength of zones, you basically measure off your 1 hour and 30-minute time frame. We're going to have a lot of examples based on that too later on, so we're going to go over it. All right. Now what we're going to do is we're going to talk about zones and ranges, right? Some people don't know the difference. Some people do know the difference, but it's always good to have a little recap, right? So now let's say you have resistance, okay? And then you have support right over here. Now, in this support and resistance, you have, you know, candles. These candles are going up. You know, candles go up and candles come down. They're going down and whatever, you know, these candles are doing these things here. And then you have candles going down, and then candle goes down more, and then candles go up like this, right? And then candles just start to go up. So now you have this zone here. The zone is basically a collection of prices, right? So when you look right, you see prices here to the right. Let's say the prices would be 111 and then 121 for simplicity's sake, and 131 and whatnot. In other news right now, PMA holding a meeting, thinks she's resigning. Oh, perfect. Okay, so you have a range of prices. Now, a lot of people, what they do is that they will draw their resistance, and what they're going to say is, oh, hey, look, my resistance is at 121. Why is your resistance at 111? You know, it doesn't matter because it's a zone, right? All these prices are in this zone. That's why sometimes, you know, I draw zones that, okay, this is the zone where candle can possibly come into and reject and continue to go up or down based on the fact if it closes above or it closes below, right? So those are zones. Same thing here, right? The zones is a collection of prices. So don't get caught up on the fact that, hey, my support is at 90. Why is yours at 90.5? It's all the same thing, right? And then you have the distance between the zone. It's called the range. This is where you take your trades between ranges. Okay, so what's this question? When the zone is broken, do you wait for the candle to close above the wick or just above the previous body? You wait for the candle to close considerably above than the previous candles, like the bodies, right? If it's above the wicks, that's perfect. But sometimes, like, you know, the wicks get in the way too. So then you got to judge it based on what's happening, right? Because every situation is very, very different. It's very, very subjective. But most times they're all the same, right? So now let's say you have this range. You have this range. So now let's take an example that you're trying to sell from resistance, right? You're trying to sell from resistance. So now you have this big range. And let's say that this range is, oh, let me just get a pen. Let's say this range is 20 pips, 20 pip range. So now your chance of getting 20 pips from resistance are way higher than your chance of getting pips when you try to take a trade between the range. Now we're going to talk about this ranges more in our examples too, but what I want everyone to understand is what a range is and what zones are, right? Ranges are the distance between two zones, or the ranges are the distance between support and resistance, right? And the zones are the collection of prices in a support or a resistance area or in a supply or demand area. That's what your zone is, right? So a zone can be 5 pips, zone can be 10 pips, right? Because you're measuring the zones. If you go to the higher time frames, let's say you look on the weekly and the daily, you have larger zones, right? Because the zones are bigger. But if you look on the 1 hour or 30-minute zones, those zones are going to be much smaller than the high time frames. Make sense? So the important thing is ranges. That you need to identify you have a big enough range to catch a trade. So if those 30 and 15-minute candles in this picture, you are waiting for a bearish close at resistance and you take the trade, yes, exactly. And we're going to go over all those examples too here later on. All right, so let's go towards support and resistance, right? So a support is a level on a chart that acts as support in a way that it's supporting the price from not dropping. Makes sense? Now you need to understand that, let's say a support is like a floor, right? A support is like a floor and price is like a bouncing ball. You know, so ball comes down, it sees support. Let's say this is a 1 hour or the 4 hour support. It sees support and it bounces. That's what support is, because that support is supporting the balls or the price's downward movement. Now, when this support gets broken, it's going to move to the next support, right? You look left and you see the next support. And this support is going to be stronger than the support it broke. So then it's going to bounce off the support. It's going to move up. And then this support becomes resistance. Makes sense? So then it's going to bounce from this resistance and it's going to come back down to support because it's a bouncing ball like price, and that's what it does. Right? So now resistance is also an area on the chart that resists the price from going further bullish. Makes sense? Like it's resisting price to going through it. That's what resistance is. Entry, every next level of resistance reached, it gets stronger and stronger. Why it gets stronger and stronger? Let's take a look at that. Let's take a look at that, because when prices, let's say you had, actually let's go to the chart. Let's go to the chart. Okay, let's say we have this chart, right? But before we look at this chart, let's take a look at an example, right? Let's say you have a box here, right? And let's say this is your weekly support. Let's say this is your weekly resistance, right? And then right over here, you have daily resistance, and right over here, you have daily support. Then you have 4 hour support, and then you have 4 hour resistance here, and then you have 1 hour. We only go towards 1 hour, and then you have 1 hour over here, right? So as price breaks this resistance on the 1 hour, it's going to go to the next resistance, right? So what time frame is that going to be? The 4 hour, right? And that's going to be stronger than the 1 hour. And then once price breaks this, it's going to go towards the daily, right? And then the daily is going to be stronger than the 4 hour. Makes sense? And then after it breaks the daily, it's going to go higher towards the weekly. And that's going to be stronger than the daily. That's why they say when price breaks the support, it's going to go towards the next support. And that support is going to be stronger than the previous one. Same thing works for resistance. Okay, remember this. When price breaks resistance, it's going to go to the next resistance. It does not mean it's going to break it, because that's stronger than the one it already broke. Sometimes, you know, price just starts smashing the fuck through supports and resistances. That's just a lot of volume in the market. And because the price is moving in heavy momentum, right? So let's take a look at this chart. Let's try to look at the candles and the stories candles we're trying to make, because we're going to talk a lot about the stories candles are trying to tell us, and that's how we're going to, like, you know, start to look at the charts. Okay, so same thing here. Like, you know, let's start from this move right over here. You can see the time. This time is 3 a.m. Eastern, right? 3 a.m. Eastern is your London session, right? So price moved up. London, like, you know, there's a lot of volume, there's a lot of momentum, starts to move up, but you're constantly looking left, right? It starts to move up. It comes back in this area right over here, right? So now when you're looking here, you understand that, okay, we had support at this point, But the 15-minute candle, so since we're good traders, we're waiting for candles to close. It closed back in the range. So when it closed back in the range, you understand that, okay, now it's back in this range. This was support, so it's going to stay in this range. But there's a lot of volume in the market. There's a lot of momentum in the London session, right? So what did it do? It pushed it through this resistance you had at 147,600. If you look at the price, it pushed it through. And when you're looking left, you're seeing how far can it be pushed to, and you see this resistance area. And then look what the price does. The price falls back down, and then this next candle goes back in this range down here, which was support previously. And when you look at the price, it is at 147,500. So now you have a support form, and then you have a resistance form, right? This is a very good market structure. This is the way you should be studying market, because once you have this support form at 147,500, in your mind, you know, okay, this is a strong support, because when New York session comes around, look right here, 9 a.m., 9 a.m., right? Now, let's take an example that, let's say people trade New York. And when they come into New York, and when they look at this chart over here, and they look left, they see that 147,500 was respected during London. So when price comes back to this level, they can know that, okay, this was respected as support. It broke down, and it came up for a retest. So now there's a high possibility it's going to continue to move down. Where it's going to move down, it's going to move down to the next support it has. But you know, since there's a lot of momentum in the market, it moves down to the next support down here. Right? This is a very crude example. We're going to move on to more examples here in a bit. Let's see this. Do you draw your support resistance based on the wicks or the bodies or the traffic zone candles? We draw them over the wicks, right? We draw them over the wicks because you got to ask yourself where. Okay, this is the 15-minute time frame. You can see it right here, 15. So now you need to ask yourself, where do wicks happen the most, right? Where do you see most wicks formed? Mostly wicks are formed at support and resistance areas. Can we agree on that? On support and resistance areas, that's where wicks are formed. If you look at this, you have support, and you can look at this. This is where support was as well, right? So now if that was support, and you're looking and you're like, you know, now you're trying to look left, you see that this was the price here, 147,500, right? But does this mean 147,500 is the exact price? No, because there's going to be price over here, there's going to be price over here, there's going to be price over here. So all these prices, this is like a zone of prices. You know, this is like the zone of prices. This is all the range of the zone. Yes, it's a sign that support and resistance holding. Yes, exactly, right? So wicks are formed at support and resistance zones. So we're going to go over a lot of examples here too later on. Okay, let's go to the next slide here. So when you're looking at supply demand zones, just for the sake of simplicity, just understand that supply demand zones, support resistance zones, they're all the same thing. They're just different names given to the same concept. All right. So we're going to take a short break, but before we take a short break, I can entertain some questions on psychology, and I can entertain some questions on time frames. If someone wants to come on as a guest speaker, they can come on with their, like, you know, content or whatever they want to talk about. But after questions, we're going to take a short break here. Oh, we have 102 people here today. On the previous chart, would you wait for after that large candle broke up? Which, this candle here? What would you wait for? Basically wait for candles to close, because sometimes, you know, when price is moving high, because okay, let's say that oh, 6 a.m. candle, yeah, um would you, let's see here, all right, would you wait for after a large candle breakout? What would you wait for? Okay, when this candle breaks up, where's the arrow? Oh man, oh man, where's the arrow? Okay, so when this candle breaks up and closes, you're looking left and you see, okay, this was resistance formed, right? So basically what you're waiting for is consolidation, because now what you can see is that this was, we had a bearish candle, and then you had another bullish candle, this one, which did not close above the previous bearish candle. And then you had another bearish candle, right? So now what you're thinking is that, oh, hey, maybe this price here, this price level, 147,700, is maybe important, because now price is not being able to break above it. So when it can't break above, it's probably going to break down. Makes sense? So, because when you're looking at this information, even if you look left, you see that we had some issues at this price level. You know, so if we had issues once and price came down, we're probably going to have issues again, because market is going to repeat itself. It couldn't break up, so where it's going to go, it's probably going to break down. You talked about trading as a student. What tips do you have for university students in the UK trying to trade Forex as a hobby? I would say if you're trading, if you really want to focus on trading in UK and anywhere else, this goes for anybody, I would say take a small course on economics, right? And how markets move, how trades affect economies, or how decisions with interest rates, they affect economies. That's something really important that you need to know, because you really need to know what makes prices move fundamentally, right? Like things like interest rates or sales report, retail sales. I know in January we called NFP in January and February based on the fact that, okay, like, you know what, retail sales were down for Christmas because businesses moved towards online sales. Makes sense? So if retail sales are down, there are less employment opportunities, because retail sales are down. When the retail sales are down, less customers come in. When less customers come in, companies hire less staff. So that means NFP should be bad. Right? So that's something you really need to focus on or study on, that what really makes markets move. Do you suggest to keep support resistance zones drawn on the charts for days? Or yeah, so every time I come to the chart, I remove all my zones and I refresh my zones. I remove all the zones and I only look at the most recent zones. We're going to talk a lot about that later on here in the webinar. Okay, going back to true ECN versus standard, what would you say true ECN is better for scalping due to low spreads and better execution? Yes, I would say true ECN is better for scalping. I personally like it because it's less spread. Spread is low, so you know, I basically like it better. Taking from okay, this Constantine. When price broke two zones, the London session, which zone would you know to take the trade off? Okay, so I guess you're talking about this big move that happened, right? So now what you got to see is that you had resistance here, right? So when this candle closed, you're waiting for the next candle to close too, because this is actually a bad example because in the 15-minute chart, because these two candles are one 30-minute candle. So you're basically waiting for the 30-minute candle to close. So if this was a 30-minute chart, you would see a candle close above over here, and then you could base a better judgment based on how it's forming. So we're going to look at more examples there. I'm sure you'll get to this, but the overall approach should be determine bias via daily. Based on bias, take trades in the zones. Yes, the number one would be determine a bias. The number two would be determine a place where you're going to put your stop. We're going to go over that as well in the in our examples here. Okay, awesome, perfect. So we're going to take a 7-minute break. It's 11:21 Eastern. 11:21 Eastern. So we're going to be back at 11:26 Eastern. Big time. I'm just going to get some liquid in me, and then we're going to go towards, we have higher time frames versus lower time frames. We have examples on continuation through zones, new analogies. We have like what happens when price rejects zones. A lot of examples on like chart cosmetics and looking left and chart traffic as well. So there's a lot of exciting. The exciting stuff is coming now. The previous, what we just did, that was all theory, but this is mostly now practical stuff is going to come on now. It's 11:22. Okay, perfect. So we're going to be back at 11:28. We're going to go on mute, and we'll see you very soon. Welcome back. I really needed that break. needed to severely hydrate myself. All right. Let's move along. Next, we're going to talk about higher time frames versus lower time frames, and how the lower time frames overall they make your higher time frames. I think it's very, very important, and most people don't really understand it. Well, they do understand it, but when you're looking at the market, you're not taking that into consideration. And I think that's the number one fallback you have, that you're not taking your high time frame and lower time frames in consideration, right? So let's take this for example. So let's say you have the daily time frame, right? You have the daily candle. It moved like this, and then it moved like this. Now, a lot of people, they must have like, heard me talk about something called visualization, right? So now let's say you're visualizing the next daily candle. So now when you close your eyes, you're visualizing the next daily candle to go something like this, right? What would this mean on the smaller time frame? On the smaller time frame, this would mean that, candles came down, they made a low, and then they went back up. They went back up, and then they started to consolidate. And then what happened? Price, when the new daily candle started to form, price went up, it came down like this, and then started to go up. Okay, break and retest on the 4 hour, exactly, right? So on the higher time frame, you might see clean candles like this and like this, but the smaller time frame is where you will start to learn market structure, right? Because this wick up on the small time frame is going to be a move up. Like some candles are going to start to move up to create the wick on the higher time frame. And then once they start to go down, because this moved down right here, this is the wick of the previous daily candle. See, it filled this range, continued to move down, went back up to the same area it broke before and closed. So there you have the close. Right? So it's basically you're just visualizing how the candles are moving and how the smaller time frames are gonna make up the overall larger time frame. Okay, let's go to some chart examples here. Raja, can you explain what you and Ted always talk about the 4-hour candles, like how they move in different hours? So how the 4-hour candle move in the first hour and second, etc. So move to expect. Okay. Basically, let's say that you have the daily candle, right? You have the daily candle. So now daily candle, it's going to move. It's going to start to move a lot in, let's say, the New York session, right? And then it's going to start to die down, and then it's going to start to move back in Asian session, right? Let's just disregard when the daily candle opens closes. This is just for simplicity. And then it's going to start to die down, and then it's going to start to move in London session. So now okay, there are intervals when the daily candle is going to have some volume, right? New York, Asia, and London, right? So now when you're looking at the 4-hour candle, this is the same thing. So now maybe the first hour, so now the 4-hour has 4 1-hour candles, right? So maybe in the first hour, there's no volume, right? Because maybe this is, let's say this is the 7 a.m. candle. There's no volume. And then you have the 8 a.m. candle of the 4-hour candle. And you realize, okay, you know what? This is a New York open, so there's going to be a lot of volume. So now we might see some action happening in the 4-hour candle. So then you're going to start to see the 4-hour candle move. And then there's going to be 9 a.m. hour. There's going to be more volatility. And then the last candle, now you have to see that it was volume in one hour, there's volume in the second 1 hour, so now maybe there's going to be less volume in the third one, right? Because this might be the closing of the 4-hour candle as well. Does the daily candle start at 000 GMT? Yes. You have to look at your broker and you need to see when it starts. Yeah. So that's the thing here with the 4-hour candles, right? So you really got to be cognitive of the time as well, because let's say if you're looking at the 4-hour candle between maybe like 1 p.m. and 5 p.m. when there's no volume, you might see that the 4-hour candle doesn't go really far. But if you're looking at the 4-hour candle during New York Open, then you know there's going to be volume in that 4-hour candle. So it goes back to the fact. Is it being recorded? Yes, being recorded. So it goes back to the fact that, okay, like what session you're looking at on the 4-hour candle, right? Because the more you look at it, the more you're going to start to understand that, okay, maybe the first half of the 4-hour candle wasn't as volatile, so maybe the second half might be volatile, right? So every situation is different. It's subjective. So that's why we encourage people to post charts every day of what they think is going to happen. And then, like, that's how you keep improving and learning. Okay. So let's move on to some examples here. Delete this. Oh, let's just do this. All right, daily versus 4-hour. Okay, so this is the daily chart, right? We see these candles here. This was a bearish candle. The next one was also bearish. The one after this broke out, right? So this would be your breakout candle, the one that broke out. So now when you're looking left, now since price is moving down, you're looking left to see, okay, how far can the price go, right? You're looking left and you see the supports. You're like, okay, maybe price can come up till down here, right? Any break below is bonus move. So let's look at this on the 4-hour and see how this looks on the 4-hour. Now you see how simple this looks. On the 4-hour, you're going to start to see more information. Wouldn't be 1300 resistance first? 13. No, because look at where this candle started. It started down here. So this was support. So it's going to come down to here. So we're going to look at the 4-hour here. There we go. There's the 4-hour chart. Yeah. So I guess this is what you were talking about here, because now when you look at this information, we're going to focus on this information right over here, right? The daily candle came down and it pulled up, and the next daily candle, it went down to fill this wick. And the one after this pulled up before heading down. So this is the information we're going to look at on the 4-hour, and we're going to try to make sense of it, and we're going to try to study the market structure. This is what I do in my pastime. I'm going to have nothing to do. Okay. All right. So check this out. Daily candle, this was the move down. 4-hour candle went up, right? And then you have all this consolidation happening, but what you're looking at is that it's creating support on the 4-hour, right? It's creating support on the 4-hour. This wick down was the wick of the daily candle. This move down was the wick fill of the small daily candle we looked at. And then we had a pull up on the 3rd daily candle, and that was the one that pushed it down. But now we're looking at the smaller time frames. We look to see that, okay, the 4-hour candle actually broke the support. Even on a daily, we just see something like this. Let me just draw the daily candle here pretty fast. So on the daily candle, we see something like this, and then you have a candle like this, and then you have a candle going like this. There you go. A very bad drawing, but makes sense, right? So if this is the daily support, you can see the support forming very nicely on the 4-hour, right? right over here. So if you're a swing trader and you're taking entries based off the 4-hour, you're probably waiting for this support to be broken, or you're probably expecting this resistance to be respected right over here for price to continue moving down. In a way, you could have taken the trade on the smaller time frames, like 1 hour and 30 minutes, if you're attempting to catch 15, 20 pips. Yes, that's true. That's absolutely true. So let's move on to the next example. What you're going to notice is throughout these examples, I'm going to be talking about a lot about candles, because it's very important to actually know what the candles are doing. Let me just turn the volume down just a little bit. There we go. All right. Hope that's not too loud. Okay, let's go to the next example here. Okay, so we have another daily chart. So from this information, what we're going to focus on is we're going to focus on this area right over here. Like what's happening here. Now, if you're looking on the daily candle, on daily chart, it's pretty easy to see that, you know, price came down and the next daily candle, it pushed up. Yeah, it's the same songs every day. Yeah, these songs actually put me in a really, really good mood to trade. And you know, when they're playing in the background, I can relate to that trading day, and, you know, and I just get excited. I'm just, okay, perfect. You know, this is awesome. So daily candle pushed up. So now what you're looking at here is that, okay, when the daily candle pushed up, this means that this is a very strong price level, right? Because if the daily candle reverses an area, that means that has formed support, right? Because now when you look at this bearish candle here, it tried to come down, but it closed above that area. This daily candle also came down, but it closed above that area. So now it's created this support. On the daily candle, it looks perfect, right? It created this support. So once support is created, once daily candle couldn't break down, what's going to happen? It's going to break up, right? So you see it broke up here, and then it started to range a bit here. So now we're going to look at it on the smaller time frame, on the 4-hour, because on the 4-hour, now you will see more of the market structure. And then on smaller time frames, you know, that's where you try to take your entries. So let's look on the 4-hour. This is the 4-hour right over here, right? Oh, Smith is punching the keyboard. That's writing over there from Smith. Okay, so if you remember the daily candle that kind of went down like this, this was the move right here. This move down that pushed the daily candle down like this. And then you can see how this candle here, this 1, 2, 3, 4, 5, 6 candles made up that one bullish daily candle which we had. Is it so it's always better to take into consideration the most recent broken zones rather than old zones? Yes, exactly. Because the most recent zones are going to be the freshest zones, right? That's where most rejections happen, on the most recent zones. Because now when we looked on the daily time frame, we had clear support, right? Candle was something like this, and then we had clear support on the daily. But on the 4-hour, you see more information here, because the 4-hour candle had to come down, and then the next candle went bullish. And if you know about fake outs, that next candle closed above the support it formed right over here. Makes sense? So if this formed above that support previously, this means, okay, the support is being respected and it should continue to move up now. So then, like, you know, you had this next candle, and the candle after this, it filled the weight. We're going to go over a lot more examples here later on. Right? Then overall daily time frame had respected support. So the 4-hour candles had to just, you know, jump around and continue the bullish momentum. One thing I like about this is that there are a lot of examples, and we can cover all of the angles here. I tend to draw my zones for the week and leave them till next week. The market is always changing, so you have to adapt. Yep, that's absolutely true. Weekly zones, I keep them as it is, and I wait to see what comes. When those bear candles close near the bottom of the range, it doesn't mean sells, no. Because overall, you're basically waiting for the daily candle to close then, if you're only looking at the daily and the 4 hour. See, you waited for the daily to close, it closed with a rejection, just gave you a nice idea that, okay, we could probably take buys to go up. And then if you're being cautious, you're waiting for this candle to close. And then now, ideally, you say, okay, if price is moving up, I can maybe have a stop below this daily candle, because since it's respecting support, it might be strong support, right? Right below this here, and the next one should continue moving up. You don't take sells in the 4 hour because we're in daily close, correct? Yes. So you're waiting for the daily to close. When support determined on daily, yes, exactly, right? But the smaller time frames, they'll basically give you like a lot more information, right? Because let's say if this was a 5-minute time frame, right? So you see a bearish candle, you say, oh, bearish candle, it might keep going down and whatnot. So that's why it's really important to look at the overall time frame and trade based on that. Every day you draw a 4-hour zone. Can I take a breakout trade if the early candle has closed but the 4-hour has not? Again, it depends on what the chart is doing. We're going to go into some examples here, but it always depends on what charts you're doing, because when we start asking questions, what if this, what if that, there are a lot of subjective questions. Trust me, you can come up with questions every day at all times, but it all depends on what you are seeing in the moment, right? Because every day is going to be different, and if you're analyzing every day, you're going to have different perspectives and different approaches to the market. So we're all going to learn over time, as we go. So let's go over to the next example here. What we got 4-hour versus the 1-hour time frame, right? So this here we have the 4-hour chart, and then we have the 1-hour chart, right? So what we're going to focus on is that how to catch this move down, right? Because now when we're trying to tell a story, what we're basically looking at is we're looking at support being formed on the 4-hour, and then we're looking at this resistance zone here being formed, right? Because if you look left here, you can see that maybe this candle was coming down. This candle was coming down, the 4-hour went down, it formed support, it started to go up, and then you had this reversal, and then it started to form support here again, and now we have resistance, right? So once you have a move down and then price is starting to range, can you trade in this range? No, you can't trade in this range. You wait for breakouts, right? Your breakout happened on the 4-hour, and this was probably like a retest to continue down. But now we're going to look at the 1-hour time frame, and we're going to see how can we catch this move down. We wouldn't take trade top of the range. No, David, I'm going to answer all your questions before you even ask them. So just go with the flow. So we're going to go on the smaller time frames to see how we can catch it. Let's go to the 1-hour. All right. So now we are here on the 1-hour. So now if you look, this was the entire 4-hour range here that was consolidating. Makes sense? But on the 1-hour, now you see a lot of information. Now you see a lot of candles, they're moving, like you have some consolidation here on the 1-hour. Maybe this time here was a time when there was a lot of volatility, right? So now when you're looking at the candles, what you're saying to yourself is now, okay, if you're looking at the 1-hour candle here, you see it's starting to form support based on the next one and the next one, right? So you form support, candle from resistance. You had this candle, it formed a kangaroo tail. Then you had this bullish candle. Now the thing is, this bullish candle, it did not close above in a way that you can say, okay, it's going to continue to move up. even though it was a bullish candle, right? Because just this bullish candle, it has to, I think it'll kind of close above these wicks here so that you have a strong confirmation, okay, we're starting to go up. Makes sense? Because now when you look at the next candle, you have support and then you have resistance here. So now if you have sell stops, you're catching this move. But if you're waiting for this 1 hour candle to close, you know that, okay, it's closing below these candles here to the left. Make sense? You're looking at individual candles. This is very, very important. So when price is coming down, you're looking left constantly. You're looking left and you see, okay, this is where 1 hour had support previously. And this closed below it. So now you can say, okay, like, you know what? Based on the 4 hour, there is some room for it to continue moving down. Makes sense? So now let's go back to the 4 hour. See this move down? The price started to, you know, move up and then it continued to move down. But if you look on the 1 hour, this candle right here on the 1 hour was the liquidity graph on the 4 hour. You look left, see the wicks match up. I hope I could have people here on the mic and then do some quizzes with them. Quizzes would be fun. But we're gonna have some quizzes planned too. All right. 4 hour versus the 1 hour. Okay. So now, oh, someone's gonna get the mic. Okay, perfect. So now let's take a look at this consolidation area here, right? Some people call it consolidation, some people call it ranging, some people call it goat shit, right? Because candle goes down, candle goes up, candle goes up, candle goes down, candle goes up, candle goes down, candle goes up, candle goes up, candle goes down. Can you trade this on the 4 hour? No, not at all. But when you look on the smaller time frames, you start to see some more information. So that's what we're going to do. We're going to now look at it on the 1 hour time frame, and we're going to see what information can we find from it. There we go. Now, let's take a look at this information here. Right? This is not analysis. This is just a way to read candles. Okay? This is just a way to read candles. Right? So we're going to start. We're probably going to start from right over here. Right? Price went up, closed above these candles here to the left. Okay, closed above. This means, okay, momentum is up because, you know, we had a strong bullish candle closed above these candles to the left. There was only one wick here, so this means, you know, now we're preparing to go up. Next candle went up, strong bullish candle, and then you have another bullish, and then you have a smaller bullish candle. A smaller bullish candle now, it would mean, is that, you know, the momentum is dying down. Plus also, if you look at the wick it's making to the down, this is a smaller wick than this wick. Now, when candles form wicks like this, let's say, with the bigger body, this means this wick, I look at it as like a rocket ship. As if there's a flame underneath this candle pushing it up. So now the flame is dying down on this recent bullish candle, and the next bearish candle we have right over here. Right? So now price starts to go down. When price is moving down, you're waiting for price to form support, because now essentially, like, you know, price was in bullish momentum and price made a high. Remember we talked about price making highs and then coming down to make some sort of support? That's exactly what's happening. Price made a high, it broke this resistance zone, and now price is coming down, so you're waiting for price to make support. Where will price make support? Check this out. Right? Bearish candle formed. This gives us no indication that price is starting to go up. We have another bearish candle formed. This also gives us no indication price is moving up, right? Now we have a bullish candle formed, right? and this is the 1 hour time frame. So 1 hour has made support. So now essentially what you can turn around and say, okay, now maybe you can have a stop below the 1 hour candle because now price made a high. So price is going to come up and it's going to retest that high. Right? And if you have stop in, let's say, if you have a stop in profits, you get this bonus move up. One question, may I know why the first resistance you're explaining is not at the top of the wick? The first resistance you're explaining. This one right here? No, it's not at the top of the wick because when you're, remember what I talked about candles? I'm going to explain that. Man, you guys need to take notes. You guys need to take notes. When we were talking about candles, we were talking about, let's say this is a bullish candle here. So price opened down here. It closed over here. It tried to go up, but it couldn't close here. It closed over here. The close matters, right? The same thing happens on this candle you're mentioning. Price closed here. See the close? Price, well, actually price closed down over here, right? So it tried to go up, but it didn't close over there, right? So this is resistance. Let's see here. Would you try to enter at the support in the current case, or would you wait for the first bullish candle? Yeah, we'll wait for the bullish candle. You wait for confirmations so that you know where to put your stop loss, because if you are entering on this bullish candle, right, and it's not closed yet, you don't know whether this is going to close bearish or bullish, because you don't know. You can take a chance, it can work out, but you just don't know, right? So you have to form a system, right? So now when you're waiting for this candle to close bullish, then you know, okay, the candle has closed bullish, 1 hour has formed support. So now number one, bias is bullish. Okay, number two, where will your stop loss be? Okay, stop loss should be below the 1 hour candle, because now as long as price stays above this area, we should continue to move up to retest this high it created, right? And then price went up, and then started to come down. It came down to the same support, right? So what happened here? Same thing. Price made a high, right? 1 hour from support, price went up to retest that high and went down again. Like, and the cycle continues. It's not going to be like this all the time, but it's just to give you an idea. So now we're going to look at more time frames. We're going to look at the 5 minute, the 30 minute, and the 15 minute. All right. So this is the 1 hour time frame, right? We're going to look at the 1 hour time frame, how, like, the candle is coming down, and basically we're going to start with support here, consolidation, and then the move up, right? We're going to look at it on the smaller time frames, because on the 1 hour time frame, what's going to happen is that if you see this bearish candle, you can turn around and say, oh, look, we've formed a bearish candle which is stronger than this bullish candle, so the next candle can come down and fill this wick and continue going down, right? But when you're looking left, oh, let me just remove this. But when you are looking left, you see that it broke out of this resistance, because if the 1 hour candle, this one went up and then this one rejected the price and went down, this means this is resistance, because this level is resisting the 1 hour candle to go up, right? In the same way, when the 1 hour candle comes down to the same area, it looks left and sees, oh, wait, we rejected this area before to go down. Now it should reject this area again to go up. Makes sense? So now we're going to look at smaller time frames, and then you're going to see some more information here. Losing my voice, man. God damn. All right, let's go to the 30-minute time frame here. There we go. We got the 30-minute time frame. Okay, now this is where you're going to learn about like candle closes, right? So basically, we had support on the 30-minute, right? We had support on the 30-minute. 30-minute candle formed bullish. Now you look at yourself and say, okay, 30-minute candle formed bullish. So now what we can do is maybe the next candle is going to continue to move up and we can have a stop below the previous 30-minute candle. Yeah, perfect. You take a buy, you know, the next 30-minute candle, look at the way it's closing. It closed above the previous bullish candle's open. Makes sense? It closed above, which means the next one will continue to move up. It moved up. It broke this resistance here to the left, if you're looking left. And then it kind of started to consolidate above it. See this close? It's closing above this resistance, right? And then the next candle formed bullish, and then we continued to go up, and then we had this consolidation here. So now we're going to look at this in more detail on the 15-minute chart. Right? This is just an exercise to get yourself accustomed to looking at all different time frames and visualizing the higher time frame. This is how I exactly learned how to read market structure. Okay, see, so now this is the 15-minute time frame. See, now we have a lot more information. Now I'm pretty sure like a lot of people are understanding this 15-minute versus the overall 1 hour, because now you have a lot more candles to deal with here. Look at this, a lot more candles to deal with, right? And then looking left, you see the same area being respected, right here. Same area being respected. Price tried to go down, but it could not close below this resistance, closed above it. Makes sense? It formed bullish, and then we had another like big wick rejection. Momentum was up because we broke this resistance. We made a high, did a retest to continue to go up. Here, okay, are you going to sim at the end? No, I'm not going to do simulation in the end because there's a lot more left. I think there are like 2-3 hours more left here. But we're going to try to squeeze in a simulation on Saturday, next Saturday. Because I'm going to give this week for everyone to just, digest more information, come up with more questions, and we're going to have a document placed in the drive where everyone can, put down their questions, and then we can go over that next Saturday as a refresher webinar. So now let's look at the next one. Is going to be the 5-minute time frame. It's going to be a lot more information. See this, the 5-minute time frame. Not even like, what can you do here? If you're looking at the 5-minute time frame, with every candle closing, you're going to start to confuse yourself. Trust me. With every candle closing, you're going to start to confuse yourself. That's why it's really important to only stick to the 1 hour and 30 minutes, and maybe the 15-minute at times, because you want to see clean candles. Because when you're looking at the 30-minute or 15-minute, you're waiting for the candles to close. And that's giving you more opportunity to catch bigger pips. Because if you're looking at the 5-minute, man, good luck, bro. Because with every candle closing bearish, like let's say like this, the next minute you're thinking, oh, it's going to drop. So you take sells, but it pulls up. You see? Let's go to the next example here. So now we have a lot of consolidation area here. Like I know a lot of people don't really look at consolidations, but I look at consolidations on the smaller time frames to study market structure, right? So now from first glance, this makes no sense, okay? When you see this happening, you don't have to even try to make sense of this. Trust me, if you try to make sense of this, what's going to happen is your mind is automatically going to show you a trade that does not exist. Does that make sense? If you try to make sense of this, you're going to try to squeeze in a trade that does not exist. So when this happens, you just stay out. you just stay out of it. You don't try to be a rocket scientist to solve this problem, because this problem is there to misguide you, right? Or this problem is just here that the market is consolidating. It's really easy, right? Market is consolidating for a big move. So basically what you want is a breakout down or a break up. Will we get access to the simulator to practice? Yes. Yep, I will give the codes out next week, from Monday. Yeah. Okay, so let's look at the smaller time frames here, and let's see what information we see. See this? This is a smaller time frame. This is a 30-minute. This is a 15-minute. See this? If we drew these lines on the 1 hour and just look at it, look at this mess. This is where you stay away. What the fuck is Netflix name? I'm really interested. Yeah. So this is goat shit. This is where you stay away. You don't really try to take a trade, right? And then some people, what they do is to try to go in the 5-minute time frame. Let's look at the 5-minute time frame. See this? This is where traders come to die, right? This consolidation. Let's go again. 1 hour, 30-minute, 15-minute, 5-minute. Nothing. Makes no sense at all, right? Maybe you can catch this move going down, targeting this support, but then again, you are building bad habits, right? So that's very important that once you see that, okay, the high time frame is consolidating, you try to, stay as far away as possible. Okay, let's go to the next example here. I think this is the last example for this 1 hour, 30-minute, 15-minute, 5-minute stuff. So what we're going to do over here is we're going to look at this support being formed, this area being respected, and then this continuation. And then we'll see what's happening here, right? So when you're trying to tell a story, you're trying to see same thing that we talked about. Okay, so this is the 1 hour time frame. Now, 1 hour came up, it created a high, right? But now what you're doing is you're also looking at the time here, right? What's this time? This time is 12 p.m. and then this time is 3 p.m. I'm pretty sure not a lot of people are trading at this time of the day, 3 p.m., because this is consolidation time, right? You need to be very aware of these times. So now when you're coming on to trade, let's say you're coming on to trade for, so now you had this resistance and you're coming on to trade for London session. See this? 4 a.m. London session, and you come on, you see this bearish candle close, and now when you look left, you see that there was resistance there. So now you wait for this 1 hour candle to close. It closed bullish. So again, what do you say? That, okay, previously price made a high, now we're at support. The 1 hour candle formed closed bullish. So maybe we can have a stop below this candle in the anticipation that, okay, as long as candle stays above the previous 1 hour, we should continue up to fill this range. Make sense? Yeah, wick fill too. But if you're holding longer, then you can expect to fill this range, right? And then you get bonus pips as price starts to go up. How many pips below the support? No, I'm talking about stop below the candle. Below the previous candle, because it's forming support on the 1 hour, right? So we're going to go over more examples here too, right? So now the candle went up. We had this bullish candle. There's no confirmation for sells yet. And then maybe if you're waiting for this candle to close, you see that it closed bearish. So then, it started to go down. In the same way that, you had a low here, so price may come down to retest that low. So now let's look at it on the smaller time frame. This was the 1 hour time frame, so we're going to look at it on the 30-minute, 15-minute, and 5-minute. There we go. See this? So this is 4 a.m. when we're coming down to take the trade, right? And this is resistance, and then this is support here. Makes sense? On the 30-minute. So now either you're entering on this 30-minute candle, or you're waiting for support to be formed here, right? So now if you're looking at the second support form, what you're looking at the candles, right? So now let's look at this bearish candle right over here. Look at this candle, man. This candle closed wherever it closed, right? Okay, whatever. And now you're looking for the next candle to close. When this candle closed, it closed bullish, rejecting the support area. So now when you're trying to enter a buy, you're saying, okay, as long as price stays above the previous 30-minute candle close, the current one should continue to move up. And it continued to move up to fill this range. Makes sense? This won't, if you're having a hard time understanding this, it will take a couple of practices. It takes a lot of practice to truly grasp this concept. This is a perfect example of what happened if you don't wait for candles to close. The bearish candle is a bit, yeah, exactly, right? So you're always waiting for candles to close, because sometimes, price is gonna go your way, you know that, but the candles haven't closed in that. Let's say the candles haven't really closed in that aspect where you can say, okay, should continue to go that way, right? So that's the thing. So you always got to wait for candles to close in a way that you can say, okay, you know what, this makes sense. I've seen it. I can probably have my stop loss at a certain position too. Okay, so now this was a 30-minute. We're going to look at the 15-minute. Let's go to the 15-minute. See, this is the 15-minute. Now look at the mess we have on the 15-minute. Look at this. Now, if you're looking at this on the 15-minute, you're probably thinking, oh man, what did I get myself into? Right? So this goes back to the fact that if a smaller time frame doesn't make sense to you, you go to the larger time frame. If the 15-minute makes no sense to you, you go to the 30-minute. If the 30-minute makes no sense to you, go to the 1 hour. Because then you start to see clean moves. You start to see clean candles. Look at these two clean candles here. 1 hour closed bullish from support. You can have a stop below the 1 hour candle, expecting the next one to continue up to fill this range. So now if you look at it on the 30-minute, you see some mess here. And then when you look at it on the 15-minute, you see a lot of mess here happening. Make sense? So now on the 15-minute, you can basically say that, okay, you know what, we were consolidating because you're talking about market structure. We were consolidating, price moved up. And then we had some consolidation over here, and then price continued to move up to fill this range here, right? So now we're going to look at the 5-minute time frame. Let's look at the 5-minute time frame. Let's see what's happening. Now when we look in the 5-minute, holy, look at this. So now this part on the 5-minute, this area here is basically this consolidation right over here, right? And if you notice this part here, these 1, 2, 3 candles, this is basically this consolidation right over here, right? So 5-minute, a lot of mess here, but a lot to learn. Look, price went up, it started to consolidate. 5-minute formed support, and then it started to go up. But if you look left, that move up was the fill of that range. This session is like slapping me up. Wake up. Yep. That's the thing, because you have to be aware of candles are doing, right? You really need to be aware of candles are doing, and you really need to be aware of what the fuck is going on in the market, right? It's very, very important. And the only way you learn that is by looking at candles, but it takes time. Most people don't want to put in the time. They always want to rush. They always want to it's just, rushing doesn't work. Trust me, rushing doesn't work. It just takes time. All right, let's go to the next section here. Oh, we got 101 people here. The first Disney movie I watched was 101 Dalmatians with the Cruella, you know? Cruella de Vil. Yeah, Cruella de Vil. Then they had 102 Dalmatians because the dogs gave birth to another one. Okay, let's go next. All right. Okay. This is pretty exciting topic here. We're going to look at rejections in zones. Like what happens when price comes into a zone and it starts to reject it, right? So when rejections happen, when there are a lot of candles forming in a zone, right? So a lot of people, they've probably heard about this. They've seen this shape here, right? Oh, you know, the price go up, boom, 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 consolidate and down. But most don't know why it happens. Okay, what's a lot? Yeah, we're gonna go over that. But most don't know why it happens, right? What happens was that price starts to trend, it trends up, and then starts to consolidate, right? It starts to consolidate. So when it starts to consolidate, there's a high chance that it's going to continue moving down because now it has this empty space to fill, right? Rather than continue to move up. But it also depends from situation to situation, right? But in this zone, when price is consolidating, I think it's very important to look at the 15-minute candles and to see if they are actually going to break the zone or reject the zone. I mostly look at the 15-minute and the 30-minute candles because they give a lot more stronger confirmations, right? And normally it always works. But it's also not important to focus on how many candles, but it's also important on the market timing, right? Like particle pips, you mentioned what's a lot. It goes on to say, like, let's say if you wake up at, let's say, London Open, right? You're up at London Open and you say, okay, London Open is consolidating. Now, you know, if London Open is consolidating from, let's say, 8 a.m. GMT to like 8:45 a.m. GMT, then you know that at any given moment, it can break out of that consolidation. So that's where market timing comes into play. We're going to go over market timing here as well in the next few examples here. So those are rejections in zones. We're going to go over rejections in zones. Someone told me that rejections in zones and continuation through zones are two very important topics. Okay, when candles are not able to break through a zone, 70 to 80% of the time, they will go the opposite way, right? So now let's look what's happening over here, right? You have a candle coming down right here, and it's starting to form this weak bearish candle with a long wick, right? Because the previous one was strong bearish candle. It's starting to form this weak bearish candle with a long wick. But if you look further, now you see that the next candle is trying to reject this zone here. You see this price area? So maybe this price area is a very important price level because you're looking at the 30-minute time frame, right? So now you can expect to say that, okay, you know what? Maybe we could see a move up, but you need a stronger candle confirmation. So let's take a look here. Let's go next. See, what about now? We still don't have any confirmation. There's no confirmation yet. Sometimes you get confirmations, sometimes you don't get confirmations, but that's just how the price moves. So let's look at the next one. See this? Now you have a nice confirmation. Makes sense? Because now you have a candle that's rejecting this area, and you waited enough to see what you want to see. So you saw a bullish candle. So now you can turn around and say, okay, you know what? Raja Bank said that when you have a bullish candle at support, you can have a stop below support, below the previous 30-minute candle, and expect the next candle to move up. Make sense? That's right, right? But how often will this work? That's what you got to ask yourself. How often will this work? Because if you are going to go with the strategy, you need to know how this will work 70 to 60% of the time. And that's the edge you need in the market to be profitable. right? And then there is 30% of the time it will not work. But that's just a part of the plan. 30% of the time, it may just not work. So let's say you do take a trade here. Let's say you take a buy with a stop below 30-minute candle, because in the previous examples, we've seen it work. So it should work here now too, right? So let's remove this next candle and see what we got. Oh, look what happened. The next candle came down, stopped you out, But then here's the thing. Here's what, what's this? Okay, so here's the thing. Here's what happened. The next candle stopped you out, right? So as it's stopping you out, as it's going down, as a retail trader, as you got stopped out, you're thinking, oh my God, we are going down. Because number one, candle is moving down right now. Let me just draw this candle here. Let's see here. Okay, so this is how it's forming, right? The candle is moving down right now, and you're like, oh, we're going down. Take some sells. You take sells. But as you're a new trader, you realize that, oh fuck, okay, the 30-minute candle hasn't closed yet. But if you are if you're a mature trader, you're thinking, okay, you know what? It's moving down. I'm probably gonna wait for this candle to close, the 30-minute candle to close, right? So what happened? You wait for the candle to close, and look where it closes. It closes above the support zone. This makes sense? It's still closing above the support zone. Yeah, and then you waited for the next candle to close, and it's still closing above, so this means that it couldn't break down. If it couldn't break down, it's supposed to go up. This price action is really messy because you got wicks to the downside, you got wicks to the upside, you got some big move, you got some, malnutrition move over here. So the point we're trying to make is you have to wait for candles to close when they are near the zone. So you enter in buy here again. It depends on what the 15-minute is saying. Because essentially, if you're trying to enter buys, your target is this high right over here. This high here. This is your target. Because price made a high, price went down and formed support. So if it forms support, 70 to 80% of the time, it should go back up to retest that high. Make sense? Yeah, so after a loss, I say always wait for candles to close, the 30-minute or the 1 hour for close, because on average, you need an hour for your emotions to just die down. If you took that loss, Raja, would you personally walk away since you closed back in the range? Would you consider entering? I would consider entering again. Yeah, I would consider entering again, because I would still say, because I normally give myself 2 chances in a trade. 2 chances, because if this is support, I got stopped out from this candle, but then if the candle closed above support anyway, and then the next candle closed above support, so now I have waited 1 hour. Look at these 2 candles. These are 2 30-minute candles, so 30 plus 30 is 1 hour. So I waited 1 hour for them to close, and I realized, okay, you know what? We still got to go to this high because we couldn't close below this support. Right? So there's still a chance to take buys and go up to this high. So I'll give myself 2 chances in 1 trade idea. What is the time of that candle? This candle that went down is around 8:30 a.m. Right? So 8:30 a.m. Eastern, that's like around New York session. So if you look, we had a pre-New York move down at like 6 a.m. We had consolidation till like 8. And then as 9 a.m. came in, this is New York Open and New York Equities Open, we again had volume in the market and price started to move back in momentum. Yeah, it could be the news because it's 8:30. It's 8:30, so it could be news because normally U.S. news comes at 8:30. Wouldn't that be a break and retest? Retest right at the bullish candle? Which one? This one? Or this one? Down here? Here, down here? Which one? Yeah, that one. Which one? Up here or down here? Down. This one? Yeah. Yeah, exactly. But I'm not focusing on break and retest. I'm just focusing on like how rejections are made in zones and how you can, like, you know, try to anticipate moves, rejections in zones. But we're gonna go over break and retests too. Would that thing work on the higher time frame? Yes, candles move the same way in all time frames. In all time frames, and every situation is different. So after these webinars, what we're going to do is, like, from next week, I would anticipate everyone to post charts so that we can get better at our analysis. All right, let's look at the next one. Price is starting to go up, like, you know. So what's happening now is you see this bearish candle, but it's not really breaking down, right? So basically now you're seeing that, okay, now price is starting to consolidate, right? Let's look at it right here. So price is basically starting to consolidate, right? So you keep waiting. You go to the next candle, you see a bearish candle right over here, and then you see bullish one. So the good thing to notice is, like, see how these candles, they're closing, they're not really closing strong bullish or strong bearish. Make sense? It's not happening like that. And now you see this one here. So now this candle is really interesting, because now when you're looking at this candle, you see this candle as the bearish candle, which closed below this candle. It closed below this candle. It closed below this candle. It closed below this candle, right? So this bearish candle, man, this closed below 1, 2, 3, 4 4-hour candles, and it formed all this big range, right? It formed all this big range. And now when you're saying, okay, your bias is down, you're looking left to see, okay, where can we head off to? Maybe we can head off to down here, because, you know, we had to move up here. So maybe we can head off to down here. And go next one, and then see it close down and came back down, and then you're looking left to see where is it headed, and it's heading here. So now the idea of being fluid is that once you see that we are approaching support, the worst thing you can do is keep holding the trade. That's the worst thing you can do, because when price is approaching support and it's a 1-hour support or above, you better believe that that shit's gonna bounce off from that support. So when it reaches support, you're clever, you're sharp, you see it approaching support, you take profits. Or if you don't want to take profits, you take profits on some positions, and then you put stop loss at break even, because, hey, you know what? If it starts to go down, that's bonus pips. But when it comes to support, you identify it and then you exit the trade. Make sense? But the key here is to notice that how this bearish candle closed. It closed stronger than this candle, this candle, this candle, this candle. So this motherfucking candle closed. This is what we call like a gladiator candle, right? Closed below than all of these candles to the left. Because price went up, it started to consolidate, and basically price is just waiting for just one candle to close above or below than all the other candles. Make sense? So now let's see what happens next, because we took profits at the support here. See, now we had another bearish, and now look what happened. What's happening now? You waited for this candle to fill the wick, whatever, and now since you were already out of the trade, you see this as support. Now you're just waiting. You see this 1-hour candle, it formed bullish. So now what does this tell you? That it's starting to form some sort of a support. Because if the 1-hour candle is rejecting a price, look at this one. This closed over here, it rejected this price. You had a bearish candle closed down here, and then you have a bullish candle rejecting the same price, but it closed bullish. It closed above the previous candle. Sense? So you're constantly looking at where candles are closing. Constantly. That's what I'm constantly looking at. That's why it's important to wait for candles to close. Because, man, trust me, like, I know what you're thinking that if this bearish candle went down, and when this candle was going bearish, let's say like this, right? So it's like this. So you're thinking, okay, it's going down, it's going down further. But as a new trader, what you are not looking at is that you're not looking at what's happening to the left. Look at this, man. 1 hour candle, 1 hour created a support here too, which is why when this current 1 hour candle was heading down, it rejected it. And if you're a veteran trader, you know that, okay, you know what? It's coming down this area. I'm going to be fluid. I'm going to wait to see what price does when it comes down here. And it closed bullish. It rejected it. And you understand, okay, you know what? Perfect. Now it's time to go up possibly. Hope this example made some sort of sense and cleared up some issues people might have. Oh, we have 105 people there. Yeah, the limit is 600. Tell everybody to join. Yeah, it's very elementary, but it's like, it's so simple that I don't know why people don't take note of this. So simple, right? Because, like, when you come to trading, you think, oh, it's got to be hard, it's got to be complex, it's got to be some rocket science. But it's very, very, very simple. You're only looking at candles, man. Like, price only, man, trust me, price only goes up or it goes down. That's it. Or it goes sideways. Imagine price went diagonally, and then price went this way, and price went this way and this way, and went sideways and up and down. Man, no, like, everyone's going to be fucked if price went this way. So you just gotta wait to see if support and resistances are being made, and where can price potentially go. That's it. Okay. So simple. There's just so many things going on that the simple things slip your mind. Exactly. So you just got to keep things very simple, because the only way you confuse yourself is when price is ranging, or when you start to look at the small time frames. That's the only way you will confuse yourself, especially when price is ranging. So let's go to the next example here. All right. So you can see the candle here is moving up, but what's important to note here as well is that look at this range here. Look at this support. Price formed bullish. Next candle moved up. So now we had this bearish candle forming, right? This could be like a retest. So now look at this. We had this retest. Price created support. But has price moved up? Has price broken this resistance? Right? Even though this bullish candle formed bullish with no wick. So now here's an interesting thing about where would you enter on this example? I wouldn't enter right now. So here's an interesting thing about candles with no wicks. I hope people can take some notes on this. When a candle forms with no wick, let's say it has a wick to the bottom and this is a bullish candle, it doesn't have a wick to the top. If a candle doesn't have a wick to the top, this means that it hasn't really went in those prices, because to the left they're like prices, right? Which this means price hasn't really formed a range for the next candle to go up there. Makes sense? So when there's no wick to the top, I generally say, you know what? I don't want to fuck around with that candle, because when there's no wick to the top, it means that most often than not, price is going to move the opposite way. Right? Because let's take a look right over here too. See, candle formed bullish, no wick. This means no range to go up. Next one went down. Right? Same thing happening here. Very tiny wick, no range. Next candle went down. Same thing happened here on this bullish candle as well. Right? But now we're like trying to consolidate. And now we're starting to move down. So now you can anticipate that, okay, maybe we can move down to the support, or we can continue to go bullish. So you're just keeping in mind that, okay, when is price ranging? Because when price starts to range after there's momentum, then that's the point where you're just silently waiting to see when it's going to break. When it's going to break the support, or when it's going to break resistance too. Because let's say if you miss this move down, right? Let's say if you miss this move down, and then you have, so this is the 1 hour time frame, so you're waiting for this candle to closes bearish, and then the next candle closes bullish, and then the candle after that closes bearish. So now you know that 1 hour candles have formed resistance, right? And when you look left, this is GJ. So, and you're looking at the price, let's say this is 147.350, and then support is down over here, which is 147.100. So 350 minus 100 is what? 250, 25 pips, right? So what's this range? This is a 25 pip range. 25 pip range, right? So if you keep a stop above this candle saying that, okay, we formed support, we've already broken down. So as long as price stays below this level, the next candle should continue moving down to support. When it comes down to support, you take profits and maybe let one run, and that gives you bonus pips to go down. Makes sense? Makes sense. But it's the traffic we're also looking at too. Because you see this clean move up. So when you identify an area that's heading down, you see, okay, if we're going to head down, you constantly look left to see, okay, yeah, okay, maybe this candle here, this support, this is the area where candle might stop. And then this is the bonus move you get when you put stops at break even. But then if you are a trader that is trading off of support and you buy support, and then when you see this move down, you say, oh, this is a stop hunt. But if you're in sells, this isn't a stop hunt. So stop hunts are just excuses of losses, because there was no confirmation that we're going to move up. No confirmation on candles we're going to move up. Okay, go to the next example here. All right. So first of all, we have resistance up here, right? And then we have some sort of a support forming here on the daily. Are we going to see how many positions should we take on a trade? No. No, that's based on risk management. We're going to talk about that in the trading plan. How many positions and risk. So you have daily candles that start to go up. Now the daily candles are approaching resistance here. So I wouldn't want to take a trade at resistance unless we see a clean break up. We're waiting. Price is still ranging. Candle closed with no wick to the bottom. Next one went bullish, but we're still ranging. This price went down. The open, still ranging. Still ranging. Now we continue to move down. Right? So this here was no trade here. There was no trade in this case. My interception of candles with no wicks is I don't trust them. Because let's say if you have a candle and it only has a bottom wick and no top wick, I doubt it that it's going to continue to move up. Because if you look at, but this is daily candle. Yeah, so candles move all the same way. 30-minute and upwards candles, they all respect the same dynamics. So it's the same thing. Because if you look on the daily candle here, this had no wick to the bottom. this had no wick to the bottom, which means it didn't really create a range for the next candle to go down. Because if you look at this candle here, it had a wick to the bottom, so it gave the next candle some range to fill, right? So that's how I look at it. What about bullish candles with no bottom wicks and vice versa? It depends on situation to situation. You know, it depends on situation to situation. Where's my eraser? Because if we look at the current bullish candle, this has no wick to the bottom too, right? So it's heading up, right? So it depends what the candles are, what the time frames are saying, and what the market is at that time. So since this is a daily candle, would you be out of the trade this whole time? No, this is just an example. This is just an example of consolidation. Yeah, this is just a example, like how he's like, if this was the 30-minute chart, this makes no sense to me. So I would stay out of this. So you always have to look at charts in that way. Like if you're looking at the daily and daily looks like this, so then you got to say, okay, if this was a 15-minute chart, I wouldn't really want to trade. So in the same way, if you are a swing trader and you're looking at this mess over here, you're probably saying to yourself, yeah, if this was a 15-minute or the 30-minute, I would stay out of it. So, you know, as a swing trader, you would basically stay out of this. You would wait for a clean breakdown and then take a sell. Yeah. Yeah, no problem. Okay, let's go to the next section here. Next section is, what do we got? We got continuation through zones, and then we got fake ups. All right, continuation through zones. Okay, so continuation happens when there's a lot of momentum in the market, right? When continuation is basically trend trading. Whenever price breaks through the zones, that means the price is trending. Makes sense? Because this is what's going to happen. When you have price moving up and it reaches a zone, right, it's going to start to consolidate. And then there's so much volume, there's so much bullish bias that's going to continue through the zone. So what we're going to look at is through continuation through zones is we're going to look at how to spot confirmations that it's going to continue moving up, right? So again, normally continuations happen when there's a lot of volume in the market, basically when market opens or market closes, or when there's a lot of news, or when Trump says something, someone says that Theresa May is being sacked. So maybe that would also make market move. I know last year, a year and a half, when Kim Jong was dropping bombs, that was also making USDJPY move a lot in the Asian session. I remember that very nicely because I had a big buy open on UJ, and Kim Jong and blasted a bomb like over Japan, and the thing fell and it stopped me out, and I lost a lot of money. So you know, so like that's how like, you know, some continuations happen too, with some news and emergency news. So we're going to go over some examples and continuation through zone. Oh, the music stopped. All right. Let's do this. Okay. Continuation through zones. All right. So what's happening here? We have support. Make sense? We have support. And then you had this candle break below, break this low over here. This was the most, this is the fresh low, right? This is the most recent low. So this would be something I would be personally looking at. It broke the fresh low, and then it broke this low here as well. So this candle closed below, right? So now what do? You wait for a retest, right? But sometimes, you know, what happens is the price does not come back for a retest. It just does not come back for a retest. It continues going. And I think this is what happens over here. Yeah, see, it continues to keep going. So now When this happens, now I know like a lot of people, they get discouraged that, oh, you know, I missed this move. But what you got to realize is that this was the 1 hour zone. So no matter what happens, price has to come back to retest this area or retest close to this area. Maybe there was a confirmation on the 15-minute, 30-minute. Yes, yes, there was a confirmation, but we don't have the chart here now for simplicity, so we're only going to look over here. So now, check this out. So we have some sort of a bearish movement and bullish. So now, okay, check this out. So now, if you're only reading candles, okay, if you're only reading candles and you see that, okay, price over here, it started to go up, and then it formed resistance here. The reason I'm looking so closely at these candles is because this is the 1 hour time frame, right? And 1 hour time frame is very, very important. It's a very, very strong confirmation, and a lot of people don't look at the details on the 1 hour candles. It's very important you look at the details, because if you look at the details here, price started to go up, but look at the body of that bullish candle. It's so small, right? And then the next one rejected it, so it went down. So what happened? Price formed resistance on the 1 hour, and then somehow it broke resistance, and then it came to retest it, right? So when you had this bearish candle, it closed above this resistance it formed. Okay, it's very important you guys follow me here. And then you had the next candle that formed bullish, rejecting this area, right? So now two things happened. Price broke support, you know, came down, and now on the 1 hour you can see that it's trying to go back up because it's got to retest this area, right? So if you can have a stop below the 1 hour bullish candle, which is retesting this broken resistance, let's see what happens next. It's trying to consolidate, goes up for a retest. Break and retest, TP in last broken zone. Yeah, exactly. Alejandro, you're right. So now it came up for a retest. Okay, so now let's check this out. 12 a.m. This is 12 p.m. 12 p.m. Eastern, close to New York, right? And then we got close to Asian Open, right? We got close to Asian Open. Now we're looking at the candles. This candle closed below, this candle closed bearish, and now you have this 1 hour candle heading down. I think that day price did head down to this support area right around 146,600. Yeah, 4 hour retest. So on the 4 hour, this is going to be retest. On the daily candle, now the daily candle here would look something like this. Right? It's going to look something like this, because this is a break, retest, and continue moving down. Right? Makes sense. So price broke this here again, it rejected it. So when price comes here again, it's going to reject it again and continue moving down. So when it continues to move down, you're constantly looking to see that, okay, how far will it move down? So you're constantly looking left, you're looking left, you see, aha, we have support right over here. So maybe this is a good area to maybe take profits and let one position run, anticipating that it might continue to move further down. Makes sense? Pace is good? Okay. Is there a certain amount of candles between the break and retest that you are looking for, like during the red big candle? During that big red candle, if it did retest, would you take it right here? No, I'm not sure. I'm not sure. I probably wouldn't take it. Yeah, I'm probably won't gonna take it, because if you look at the time is 11 p.m. 11 a.m. Eastern, and this is when my stream is off and I'm not trading anymore. So maybe this would be the trade I would take right here. You know, price form resistance, bearish. So maybe this would be the trade I take till the support. Are you waiting for the retest on the 1 hour or the 30-minute? 1 hour and the 30-minute, right? Because now you're looking at where the price is coming up for a retest right here, and it's forming bearish candles. This means that now the candles are rejecting this area. So when candles are rejecting this area, what you're saying is that, okay, if it's heading down, where will your stop loss be? So safe stop loss is going to be above the previous 1 hour candle, because now you have this range to go down to the support. Makes sense? So this is 996. So you have 996, you have 896, 10 pips, 796, 20 pips, 696, 30 pip, 30 pip range, almost 35 pip range right here. What if the last candle closes bullish, something like that? If it closes bullish, we'll look at it. But if it's not closed bullish, right? That way, now that way you can come up with a lot of questions. Let's say you can say, oh, what if this candle closes like this? Then it's going to go up, right? So every situation is different, right? What if situations? There are a lot of those, but we only focus on what we see on the chart, right? Most people, they don't take trades because they have a lot of what if scenarios running in their mind, right? When you have a lot of what ifs running in your mind, then you don't take trades. Because let's say that you do take a sell, right? You do take a sell, and then constantly you're thinking, oh, what if it goes up? What if it hits my stop loss? What if it does this? What if news comes and does this? You know, like people never think that, oh, what if it goes in profits? You will never think that. Man, guys always think, okay, what if it goes against me? That's the only what if that's running in their mind. What if it fucks me? You have to think positive. You know, if it makes sense, just think positive. Always think, what if it goes in profits? You know, think the positive. It's better to always wait for candle to close in our way for the same bullish. Yes, it's always important to wait for candles to close. Yep, always wait for candles to close. Next week when we go live, we're gonna see a lot of live examples. All right, let's go to the next example here. All right, continuation through zones. All right, we have a lot of BS happening here on the 15-minute chart. So we're gonna wait. You see now price is coming up to a zone over here. You see resistance zone, prices, resistance zone. So now price is starting to consolidate. It broke up. See this? Price broke up, right? Price broke up. So now you got to wait to see if price is going to come down for a retest so you can take a trade. See this? Price broke up, came down for a retest, and then it did another retest and continuation. It's going to start to move up again. But now you can see price is starting to range again. Let's see what happens next. I think this was an example of a fake out. Yeah, this was an example of a fake out. So I think we have a higher time frame here as well. Higher time frame. Do we have higher time frame? 38, 410. No, we don't have higher time. Yeah, we do have higher time frame. This is a higher time frame. This is the 30-minute time frame. And then this is the 1 hour time frame. So let's look at the 30-minute time frame. 30-minute time frame makes yeah, goat shit. Very nice. Because the price action was not good at all. There was no good price action. There was a lot of consolidation here. This is very important. Kevo, you've passed this test. Kevo has passed this test because like a lot of people are gonna try to make sense of consolidation when it won't make any sense at all. So it's better to just like stay away and to just, you know, calm down. Because now when you do some analysis on the 30-minute time frame, because the 15-minute looked very, very messy, you see that we had resistance here. And then price broke up and started to do its dirty dance, whatever it was trying to do. And then you had this candle here, it closed back inside the range. So now if you've been following me, if you've seen Twitch, you know that when candle closed back in the range, this means that the move up was a fake out. And then you have this move coming down, and when you're looking left, you see that there were clean moves up. You see that there was no traffic previously. So based on that fact, you can say that, okay, easily we can come down to this support. And then you get this bonus move down. But the idea is that you are being certain that, okay, we're approaching support. So this is where you should put on the brakes. I would probably took a trade directly after the retest. Maybe this is an aggressive entry, yes. What if you are caught in the fake out? Do you cut in reverse or just cut and not enter again? Very good question. So you just cut, right? If you get caught in a trade, you just take the loss and then you just sit tight, right? Never reverse. If you are not experienced enough, I would never recommend you to reverse. That's just a failing plan right there. So you should never reverse from that. Man, we got a lot of examples here. Can this method work on daily and higher time frame only? Yes, because candles move the same way. Candles move the same way in the 15-minute, on the 30-minute, the 1 hour, 4 hour, daily. Candles all move the same way. But the problem with the higher time frame is that you have to wait longer. If you're looking at the daily, you have to wait for 1 or 2 daily candles to close. That's the only issue. The higher the time frame, the longer the wait. Okay. What's this? Okay, this is the same chart. Got nothing but time. Oh, yeah, got nothing but time. It's awesome. All right. This is the 15-minute chart here. So I think this was after the news. This was after the news. So we have basically price had formed resistance here, and then price broke out. Now price is starting to consolidate. It's starting to come down, coming down further. So now it's coming down to the zone, right? So now what you can see is that maybe, like, you know, the body of the bearish candles and the formation of the wicks, it may seem as if that they're exhausting, right? So what's the bias here? The bias here is bullish, and it's coming down to this resistance area. So step 1 is bias. Step 2 is, where will your stop loss be? You have to identify a stop loss area. Maybe it's going to be somewhere below this way here, right? Or it's maybe it would be somewhere even lower. Yep, you waited for the bullish, and now you can say, okay, we have a bullish candle. So maybe now we can have a stop below the bullish candle. JC was right. And then you go next, see what happens, and it starts to move up. Where does it go? It goes up to where it made the high right here, because, you know, now price made a high, it's coming down, it's forming support, and then once it's formed support, there's momentum bullish, it should go up to retest this high. Can you explain a bit about rejection wicks? What does that tell you? Rejection wicks, rejection wicks mean that price is rejecting the area, but after rejection wicks, you need to wait for the opposite candle, which is the bullish candle right here. You need to wait for this candle, because these rejection wicks mean nothing. Because sometimes, you know, you can have a lot of rejection wicks and price can just continue falling. So it's important to wait for a bullish candle. I would say wait for the 30-minute as well, but this is just for like simplicity, just for example's sake. So the bullish confirmation increases the probability of the trade? Yes. Yes, it does. It does. Yeah, so it's just a small indicator. Those rejection wicks and stuff. Okay, let's go to the let's go to the next one here. See this? So this is the 30-minute time. 30-minute did not give you enough, like confirmation. Check this out. It just formed a weak bearish candle, and the next 30-minute it continued to go up because maybe there's a lot of volume in the market. And this was the 1 hour. So you see how there's different information. On the 15-minute, you have some more information where it can give you an idea to enter. But the 30-minute, it's just one straight candle. Yeah, so you have to be really cognizant of all the time frames, how they're forming. It's very, very important. You have to know how all the time frames are forming. Raja, on the USD CAD, better to look for entries on 15-minute than 15-minute, or you possibly miss. Yeah, it depends on what the chart is doing, right? It depends on what the chart is doing. Because if you're going off the bias that, okay, we made a high over here, and if it's making support, so if the support gets respected, price should retest this high right here, right? It doesn't matter if you enter on the 15-minute or 30-minute because your stop loss is going to stay the same. You have the same stop loss and you have the same target. That's the most important thing. Yeah. So on the smaller time frames, the only thing that you're going to see different is going to be a lot of more like extra information. Okay, let's go to the next one. This was a 30-minute. Is it 700 hours transport? What's this? If you would like a trade after that big bullish candle, would you set the stop loss under the R, which becomes support? Under the R, which becomes support? I don't know what that means, Tim. You're under the resistance that becomes support. Oh, this one? Yeah, I would traditionally not do that if I miss it. Because at this time, I'm thinking, okay, might need to have a stop below this 30-minute candle. Because entering here would be very risky. Because if you miss the trade, man, you miss the trade. Because if I wake up in the morning, and if I see price has moved a lot, there have been big candles, I know that, fuck, I've missed the trade. Yeah, and the distance is big too. So it's really important to know when you've missed the trade. Yeah, it's better to miss a trade than to take a loss. I've learned the hard way. So trust me when I say that. All right. Okay, what's going on here? We had resistance, where it's kind of some sort of, it's trying to make some sort of a support right over here. Right? It's trying to make some sort of a support. There is resistance right over here. Okay. Let's see how the next candle goes. Oh, damn, the next candle went up. The next candle went up. So now what are you doing? Now, since you waited for this candle to close, you're looking left, right? Let's take a look left. You're looking left and you see that, okay, maybe now price is coming into an area where it might have problems breaking, because you see how the candles, how this candle rejected this area, how these two candles rejected this area, This candle rejected this area. So now it's not important that price is going to continue moving up, because you're looking left and you see this area as a high traffic area. On the smaller time frames, there's going to be a lot of consolidation here, and this is where I think the price should start to stall. So let's take a look what next candle does. Okay, we have a retracement. We have a retracement down. So what does this mean? Price broke up. The next price is coming down to retest. Waiting. There we go. We have a bullish candle now. So now what do we do? Entry. And where are we keeping the stop loss? Possibly keeping the stop loss down over here, under the candle. Exactly, and then see what happens next. Price starts to go up. Price continues to go up. Entry stop loss reason. Yeah, exactly, right? Because this was a break, and you waited for the retest. Are you going to do quizzes? I think I'm going to do quizzes at the end. At the end. I don't know if this is out of topic. Say you are in a position, example, you entered after the first bullish candle. Enter you after the first bullish candle after the support. You are still in the position as needed. Your stop loss on TP has been hit. And there's an important news coming in. Do you exit before or do you wait for the news? I exit. When there's news in and I'm still in lingo, when my position is still in lingo, I exit, because news, you don't know what's going to do, right? Flow chart, question mark. No, I think it's going to be, I'll try to put in MCQs, but you know, like we'll see what we can come up with, right? So now when price is moving up, you're constantly looking to see what's happening, right? So when you look left, you see, okay, now might be some problem, because you see all these wicks here, right? You see these candles reversing. So this might be an area where you say, okay, you know what, maybe this is the time where I should exit or wait. Because when we look left, oh, price is starting to go up again. And then we're heading down. So now we're heading down. You see this candle close? This candle is closing below these candles here. So this, you can see this should continue moving down. Take move down. What's this? Question. GBP USD, this example in 30 minutes, it made the first bullish candle for confirmation going higher. When on the next 30 minutes would you enter? Will you go in that drawdown or wait for it to go lower than enter? Well, here's the thing. When this candle finished bullish, right? And you know your stop is going to be somewhere over here, below the previous 30-minute candle. So now it's up to you where you want to enter, because you have your stop in place, right? So now when you have your stop in place, what you got to ask yourself is, okay, if I take a buy, what am I risking, right? What's my risk on this trade if I take a buy, right? Is your risk 5%? Is your risk 2% or 3%? Right? That's what you have to come up with your risk. What's your risk? If you want to wait to see if price comes down to take an entry, you can take an entry here, over here, or over here. But you have to know what you're risking, because number one, you know price is doing a break and a retest to go up. Okay, that's done deal. Number two is you need to understand where your stop loss is going to be. Where are you going to place your stop loss? That's what you have to mark down. So number two, stop loss below the previous 30-minute candle. Number three is execution, right? Whether you execute by waiting or whether you execute at the start of the candle. The most important thing is that you have your stop in place. Your stop loss means that if price goes below this level, then your trade is no longer valid. That's a very important concept I want everyone to know. What I noticed on Twitch, sir, after the confirmation candle, we entered, but the candle after the confirmation candle takes a retest for the support. So you entered there to get a better entry. I saw it after candle bullshitting, right? Yes, exactly. Yeah, sometimes, you know, like you could wait when the candle is bearish, you can wait in the anticipation that the candle is going to continue bullish. Like, you know, so that all comes with practice. That all comes with seeing the same, because I've seen the same thing happen over and over and over again, right? If I have seen it, let's say 60, 50 times, someone who's coming new, they have seen this happen maybe 4 or 5 times. So maybe you need to see it happen live over and over again so that you can train your eyes to the movement, or you can train your eyes to the way it moves in that respect. Yeah, right. So most of your practice is going to come with watching things happen over and over again. Okay, so this is the 15-minute chart. This 15-minute chart shows a little bit more information that we did not see in the 30-minute chart. So just for the sake of learning, we're just going to look at the way how the market structure was, right? We had a breakout, you know, 15-minute candle closed bearish, went down. Next one, rejected support. So now the interesting thing to know is that look at how these candles were closing. They were creating support and they were creating these big wicks, which, you know, I remember we talked about this as like a rocket ship. So they started to create this support acting as a rocket ship, and then we continue to go up. We continue to go up, and then when you look left, we're approaching a high traffic area right over here, right? When we're approaching a high traffic area, price starts to consolidate. When price starts to consolidate, this is now beginning to start rejecting this zone because there's a high traffic. It already made its move up, so now it starts to go down. It starts to go down. Now, the most important thing to note is that this was your strong resistance here, right? Which became your strong support, right? And then you had this bearish candle close below the support, and then price started to form resistance again on the 15-minute. So when entering on this retest, I think this bearish candle here was the key. When it rejected resistance. It rejected resistance, and then, you know, when you look left, you see that this is also strong resistance, so price should come back down. Because now maybe this whole move up was a fake out, because price closed back in the range and it started to go back down. Makes sense? So reading candles is very, very important. Your aim should be to be the best at reading candles. I think that's what your aim should be. Okay, so now we're going to go towards a fact about breakouts. See, so this was the 1 hour time frame. Because now if you look on the 1 hour time frame, it looks much, much more simple, because if you had resistance here, see, and then these candles here, they did a retest to go up. They went up. And then now you have clean candles. Now look at this bearish candle. It closed back below this resistance earlier. And then you have a move down. Right? So now when this candle came down to support, see, this was support here, and then you waited for this to close. It closed above support. You waited for this candle to close. It closed above support too. So now you can turn around and say that, okay, now, hey, maybe this support is being respected. So you can turn around and say, okay, maybe the support is being respected, so it might start to go up. So what do you got to do? You got to wait for a bullish candle to form here so that you can take buys for it to go up. But instead of a bullish candle, there's a bearish candle closing back in the range. So when it closes back in the range, you automatically say, okay, yeah, you know, it's not going up now. It's going down because I'm fluid. I'm watching the candles form, and the candles are forming below support resistance, so it should continue moving down. So you enter immediately after a candle closes of 1 hour, or wait to get a better price on the small time frames? we wait for confirmations. Always wait for candles to close in the direction you want. Okay, if it's because, like, you know, like some guys would say, okay, yeah, you know what, the 1 hour candle over here, it closed above support, so I'm going to take buys. But if you're going to take buys, the 1 hour candle hasn't turned bullish yet, so you can't take buys. It's still bearish. And then you have this 1 hour candle go below support and bearish. So now you know, okay, we're going bearish because it formed below support. You look left, you see that we had a clean move up previously. So now if it's heading down, it should head down to this area mirroring this whole move. So if you're biased for long due to your evaluation of 4 hour and daily, yeah, if it's bullish, then you're probably gonna wait for the bullish candle, because if your bias is bullish on the 4 hour and daily, and if you don't see any bullish confirmation on the 1 hour, then you don't trade at all, because you're not getting that bullish confirmation. Then you don't trade, you stay out of it, right? But if you're scalping, then you're looking at candles on the 1 hour and the 30-minute if you're scalping. But if you're on the daily time frame, then you're waiting for the 1 hour and the 4 hour candle, which means that you're waiting longer for your trades. Yeah. So basically, continuation through zones is break and retest. Right? It's very simple. It's just simple break and retest when you have continuation through the zones. Okay, so we got 2 more sections left. We have fake outs. We're going to go over fake outs. We're going to go over breakout candles, and we're going to go over chart traffic, and then we're going to take a little break. So I think maybe another hour before we take another break. It's actually really fun. In those situations where it doesn't come back to retest, do you avoid entering? Yes, you avoid entering. That's the whole thing. You don't enter, because if you're, how long is this class going to last? I think we have 2 more hours, I would say. I would say 2 more hours to go. But this is being recorded too, so if you want to leave, that's okay. You can come back and watch the recording. All right. Let's go towards fake outs. Fake outs. So in very simple terms, fake outs are basically failed break and retests. Okay, so I'm just gonna let you guys absorb that a little bit, right? If a breakout fails, it becomes a fake out setup. Make sense? Let's do this. Let's say you have resistance and then you have support. Price breaks out, does a retest, goes back in, and then continues going down, right? So this breakout failed. This break and retest failed. It became a fake out to the upside, and then, you know, move happened, going down, right? So generally you can wait for the 30-minute candle to close, but you can't really anticipate a fake out unless it already happens, right? Because sometimes, you know, when price breaks resistance, it comes down to, you know, resistance turn support. Some people take aggressive buys, and then price continues to go down, and they're like, oh man, you know, what the fuck? This was a break and retest. But if you waited for the candle to close, you will see that the candle closed back inside the range. So the break and retest, it didn't happen, because when the candle closed back in the range, it's going to continue going up. I learned that the hard way, and when I was like really looking at it, it's just started to make sense to me. I'm like, oh shit, this makes a lot of sense. Yeah. Here's something to think about. When a fake out happens, it's like the price goes right back in the range and comes through the opposite side 70% of the time, right? This means that when price is consolidating, Take a look at this. When price is consolidating, let's say it breaks out to the downside, does a little bit of a retest, continues to go down, but goes back in the range, right? It goes back in the range, does a retest down over here, continues up, and keeps going outside of the opposite side. This happens 70% of the time, right? So we're going to go over some examples here. Bearish fake out. Yeah, exactly. So this was a bearish fake out. Faked out to the bearish side and then continued to move up. Good job, Alejandro. I think Alejandro joined last night or this morning. Okay. All right. There you go. Now, fake outs. I think fake outs are very, very easy setups. How long this webinar been on for? We started around 9:30, 10, 11, 12. We started 4 hours ago. Oh, 4 hours, only 1 5-minute break. Wow, that's pretty good. All right. So let's see. So now you have this candle, it broke out, right? So basically now you're going to look for a bearish candle to do a retest to go up, right? But let's see what happens. Okay, we have a bearish candle here down at support because this resistance becomes support. And then, now we have consolidation happening. But like, if you tried to take a buy based on this candle here, right? Because, it broke out, bearish candle did a retest. So now this bullish candle formed. So now you can say, okay, what we can do is, what's this? Why it passed so fast? I didn't knew it has been 4 hours. Yeah, it's been 4 hours. So now what you can do is, when you see this bullish candle form, you can have a stop below this candle, and you can say, okay, you know what? Break and retest, we're continuing to go up. So now remember, there's a probability of break and retest, right? So now this candle stops you out. So now what do? You just wait. This candle stops you out. You can do two things. Either you wait or you call it a day, right? Because the probability of break and retest not working just happened, because you got stopped out. So now you wait and it starts to go up, right? Starts to go up. What happened here? You got stopped out on your break and retest and price moved up. This happens to some people, right? This happens to me too. But when this happens, I don't try to enter a trade because I already tried and it's got stopped out. So we wait. Now look what happens. Price came and closed back below this resistance, right? Price came and closed back below this resistance. So now ideal entry would be maybe a retest here and continue moving down. That would be the ideal entry, right? So we're going to wait and see if we can get an entry because we want to enter at this newly formed resistance now. Oh, see, look at this. Price came up to do the retest and then it continued moving down. So it should break support here. Yeah, it broke support. It broke support, came up for a retest again, and continued to move down. This would have been a very aggressive entry for a retest, by the way. Make sense? So we tried to take a buy on this candle because it closed bullish above support. We had a stop below the bullish candle, but the next bearish candle stopped us out. Right? But now when you look back in hindsight, you can say, okay, well, it did close above support, actually. It did close above support, and the next candle went up. But then this candle, bearish candle, came back inside the range. Right? It came back inside the range, and now you're saying, okay, it came back inside the range, so now this support becomes resistance here. So then you have a tap up. But I guess if we're looking at the 15-minute time frame, we'd be able to see candles coming up to this resistance. So would you enter here at the top of consolidation and wait for the candle to flip bearish, or would you go to the 15-minute time frame? Yeah, so I'd go to the 15-minute time frame and I'd wait to see if it comes up for me to take a sell from this fake out. Right? So this was 30-minute and this is the 15-minute right here. Wait a minute. Okay. 1250, 12. Okay, yeah. So this is the 15-minute right over here. Right. So now, if we're looking at the 15-minute, this was the resistance formed, and then this is the candle that came back inside the range. You see, came back inside the range. The next 15-minute candle came up to do a retest, and it started to consolidate, and then finally it broke down. This is messy on the 15-minute, but on the 30-minute, it is much, much more clear. And now what we're going to do is we're going to, yeah, so from a double top 2. So now we're going to look at it on the 1 hour time frame, and you're going to see how clean it's on the 1 hour time frame. This is a 1 hour time frame, right? It closed back in the range. You know, we had bearish momentum. This candle broke down, and the next candle broke down and formed support. Once it formed support, you're looking left. See that, okay, we reached some sort of a support. So maybe have a stop below it and then continue to move up in the anticipation of doing a retest. Would it be safe to say that during times of a lot of momentum or after very large candles, you can move down to 15-minute candles to catch moves in your bias for retest? Yes, yeah, you can, but that takes a lot of practice, right? Because when you're going to do that is you're going to start to enter on very aggressive entries, because you're missing the move and you're trying to catch what's left of it on the smaller time frame. So that's going to come out to like very aggressive entries. So I would say that will take some sort of practice. So what's this here on the 15-minute? On the 15-minute chart, isn't that a big rejection? Which one? This one? Is that what you're talking about? The highest candle? Oh, this one? Yeah. Yeah. That one is a rejection. But then what you got to notice is that as price is coming down, right, you have this support to deal with now. Yeah, that happens on fakeouts, right? So now when price comes down, you're dealing with this support. So now basically, either you can wait for this support to break, which it did right here, and continue to move down, or you can take an aggressive entry anticipating it's going to continue to move down. I normally wait for it to break and then try to do a retest. Very tricky fake out. That's a good thing. That's a good thing. But hey, if you can manage your entries, if you can manage your emotions in aggressive entries, then like, you know, if it works, it works. The whole idea is about managing your emotions while you're in trades. All right. We have another fake out over here. We have candle breaking out. Candle broke out. Now what is this is a very simple one. See, we had a candle break out, but it couldn't sustain momentum. So the next bearish candle came back to close in the range. See this? It's closing back in the range. Right over here. Right over here. Starts to go further down. And now what's happening? Right? Now what's happening here? Retest. It broke below in these candles. It's going to go down. Yeah, exactly. So if it's going to go down, and now listen, even if this is a bullish candle, right? Even if this is a bullish candle, it closed below resistance. Even this is a bullish candle, it closed below resistance. You have to look at the closes, right? So now you can say, okay, as long I can have a stop above this candle, it closed below this support turn resistance, this should continue moving down. So you start to move down. So now how far will it start to move down? You start to look left, right? You start to look left, see that, okay, maybe this is support. Maybe I can have my take profit somewhere over here and then let the rest positions run, right? So, I mean, GPCAD doesn't. Yeah, so basically, if you're looking at the price, you're at 170, 600, 607. You got 507 here. That's 10 pips. You got 450 over here. It's like 15 pips, right? So even though if you missed this fake out because it just moved so fast, you can still catch this breakout moving down because you're waiting for the candles to close. Trust me, you have to wait for a candle to show you something perfect, because sometimes, what happens is that when you're seeing price move, what you tend to do is, oh man, you know what, price is moving, so what I'm going to do is I'm going to enter. Even though you should be waiting, you enter, you take a loss, and then 15 or 30 minutes later, you do see your setup. Has this happened to you? Like after some time, you do see your setup. And when you see that setup, you don't enter because you've already taken a loss, right? And because of that loss, your fucking confidence has been dropped down. You're not confident enough to take your trade, which you should be taking, because you took a loss on a dickhead trade, right? And man, like, and most people don't get that encouragement at all. But this is something very important happens to a lot of people, that you have to wait. No matter how fast the chart is moving so that it can entice you to take trades, but you have to wait. But would you enter in that sell even though it closed as bullish candle at resistance? Yes, because it closed below resistance. It did not close above resistance, it closed below resistance. So it's all a matter of taking chances. If it closed below resistance, there's a higher chance it's going to continue moving down. Is it okay to re-enter after you have a clear view of the market after a loss on the same trade? Yes. Yep, that's perfectly fine as long as you have your risk intact. Most people don't know how much they're risking. So that's very important, that you should know exactly how much you're trying to risk, right? Okay, so let's go to the next. I think there's a 30-minute chart after this. Also, you see there's strong big candle and momentum to the downside. Yeah, exactly. There's like strong momentum down to the downside. Big candles. All right, so this was the 5-minute. This was the 5-minute. See now, does this break and retest make sense on the 5-minute? Just yes or no. As you're waiting for the 15-minute to close, because this is a 15-minute close right here. This last 5-minute candle, this is the 15-minute close. This just makes awesome sense. This just shows so much exhaustion. So much exhaustion. Yep. Perfect. Makes sense. This is a 30-minute chart. It's just straight down, 30-minute. It closed below support. See here to the left, closed below support. And the next one created a liquidity wick and then continue down. If my plan is only one trade per day and I already took the loss, still should I enter if I see my setup? Okay, so your plan is one trade a day. You shouldn't even be thinking about entering if your plan is one trade a day. Yep, you guys stick to your plan. Because trust me, when I'm on Twitch or when I'm doing webinars, man, people are calling trades left, right, and center. Man, people send me DMs, hey bro, look at this is a nice trade, but I know my plan and I know myself. Even if I see the trade, I don't take it. I just sit tight. And there are a lot of times, I'm sitting tight and I'm saying, oh, I missed this trade. Oh, which would have taken this trade. But in reality, I've already taken my trade. So it's part of discipline. If you don't follow your plan, if you don't follow your discipline, man, it's going to be very hard for you to come out of the 90% who fail and come to the 10% who don't fail. Sense? Yeah, no problem. It's because the regular steel. I'd rather fail in my analysis. Yeah, exactly. Okay. I'd rather fail in my analysis. Yes, but you also got to fail smartly. You got to be smart in failing too. That's important. And it all comes down to risk. All right, let's go to the next one. Oh, okay. All right. So we have a candle here. What's this? This is a 30-minute chart. We have a candle breakout, but it closed with no wick to the top. What does this mean? Candle closed with no wick. Me personally, if I see a candle close with no wick, man, I don't fuck with that candle at all. I stay far away from that candle. I don't care if it goes up, it goes down. I'm just gonna stay far away from that candle if it closes with no wick. That's a dangerous candle. Even though this is bullish, it seems that it's gonna go up, but it has no wick. You stay away from that shit. Okay, so let's see what happens next. Oh, we close back in the range. See, so now this is the 30-minute time frame. So now you got to pay attention to these things here. We had resistance over here, and we had support right over here on the 30-minute time frame, right? Now you had this candle break up, and then you had this candle close back inside the range, right? So now maybe this move up was a fake out. So now as price comes up, you can take a sell. And I normally take sells with 10 pip stops. That's what I do. That's what I've seen, because when I started to notice fakeouts happening, I was like, okay, you know what? If I can have 10 pip stops, I can probably have profitable fakeout trades. So that's me testing it over 4 or 5 months, right? Watching fakeouts every day. 10 pip stops in GJ, yeah, it could work, but you have to watch them happen. You have to spend a couple of weeks watching fakeouts as they happen live in the market, right? Because I've seen them happen over 4 or 5 months, right? So that's why I have that analogy, and I can kind of like guide you that, okay, this is what you can do, right? But it's better that you watch it happen over and over again so that you create your own bias, so that you can never turn around and say, okay, you know what, he said 10 pip, it didn't work, it's all on him. No, like, so you have to create your own bias as you move into the market, as you see it happen live in front of you, right? That's why we do Twitch streams, so that we can walk people through as price is moving, right? So let's see what happens next here. This candle closed, next candle did a retest, formed bearish. This should continue down to support. Yep, went down to support. So now here's the thing. It came down to support, right? You see this? This was resistance here before. Now it came down to support. This is where you don't anticipate that the support is going to get broken. All right? Makes sense? If it gets broken, awesome. But you don't anticipate that it's going to get broken at all. This move right back up. What does this mean now? What does this mean, this bearish candle? Exactly. Right? Exactly. So it came up back to resistance. Bearish candle at resistance. Maybe you can have a stop right over here. Right? And then anticipate that, okay, we might head back down. It's trying to head back down. And now it's approaching support. There's no need to, like, you know, hold position or do whatever. There's no need. The first one, the first 30 minutes, because 30 minutes and above are good confirmations. 30 minutes and above are good confirmations, man. Trust me. Because let's say you have a father, a mother, and you have an older brother, right? If your older brother tells you to do something and your mother tells you to do something, who's going to have more power? Your mother or your older brother, right? Consider the 30-minute time frame as your mother, right? The 30-minute time frame has going to have more power over the 15-minute time frame. Exactly. And then you have, let's say, your dad, your 1 hour time frame, right? If the 1 hour time frame says we're going down, we're going down. If the 30 minutes says we're going down, but the 15 minutes says we're going up, we're probably going to head down. My dad is weekly time frame. Oh yeah, weekly is my great granddad. Great granddad is my weekly time frame. Yeah. Okay. So let's so this was the 30-minute time frame. Let's look at the 1 hour time frame here. Yeah, this is the 1 hour time frame here. See here, what we're going to do is we're only going to look at we're only going to see how candles are trying to tell stories, right? Because man, I spend hours looking at charts, and I spend like a lot of time looking at charts just to see what kind of stories candles are trying to tell, right? So now this candle tried to go up, but it closed below support. So the next candle went down, then this candle formed support, and then we tried to go up, broke out, did a retest to go up, but then candles came back down. So now this is interesting, right? The bearish candle came back down, and then this bearish candle went right back up to resistance, but then it got rejected after this candle formed. And then the candles went down, and then it formed support, right? So I'm constantly looking at this. So now this bullish candle formed at support. So maybe if I was looking at the charts, I could probably have a stop loss below this bullish candle in the anticipation that, okay, bro, like we formed support, we should be heading back up now. Because now when you look left, let me remove these candles, these arrows. When you look left, you see that there's a clean move that can happen up, which it did happen. And then we had this candle break out of this resistance again. We had the candle break out of this resistance again, and now we're waiting for the next candle to form a bullish candle, but it closes back in the range. So look, it closed back in the range. So what's going to happen? It's probably going to start to move down because it closed back in the range, right? So now check this out. Check this out. Check this bullish candle out with no wick to the bottom, right? There's no range, right? Now look at this breakout candle here with no wick. There's no range, because if a candle has a wick, that means that it has created range for the next candle to follow. Makes sense? I hope guys are taking notes, man. I really hope you guys are taking notes. I really hope, because some people, they don't take notes. They just want to watch, thinking that they will retain all that information, but in reality, they don't retain nothing. So I hope you're taking notes. Now, when you're looking at these candles and you're trying to make sense of it, there's no use to make sense of it. Why? Because look at this. Look at the time. 1 p.m., 2 p.m., 3 p.m. This is consolidation. New York is closing, right? Notice how you have big candles when sessions are open. This is almost like London close. This is 10 a.m. Look at the size of this candle here. And then you have 9 a.m. here, New York open. Look at the size of these candles, big candles, right? This is your trading time. And when trading time ends, you have consolidation. Right? All right. This was the 1 hour. This is the 1 hour on the same chart. All right. Okay, what is this? So, whenever you come to a chart, you try to tell a story, right? whenever you come to the chart, you're like, okay, well, you know, like I guess we had support over here, and this candle broke support. Yeah, probably wait for pullback, and then you had support over here, and then you had maybe resistance over here. Okay, perfect. So now we're gonna wait for a pullback, maybe to sell it, right? To sell it. This is a 15-minute chart. Let's see what happens next. Oh, we have a candle here that formed with no wick to the top. What does this mean? This means we stay. I definitely stay away from it because two things have happened here, right? Two things have happened here. That this candle formed with no wick, and this candle closed back inside the range. Like, you know, if this was to go down, I would want to see a wick over here and have this candle close somewhere over here below this support trend resistance for it to go down. But it closed back in the range with no wick, so I'm just staying away from it. Make sense? So we wait. We're waiting. Oh, nice. So we're starting to go up now, right? So now, what did we learn about fake outs? Right? That there is a 70% chance that if there's a fake out, it's going to continue moving up through the resistance. Right? So maybe if you're trying to enter, you're keeping a stop below support here, or below the previous, like below this 15-minute candle, in the anticipation that, okay, now since we have had a fake out and candle has closed back in the range, so as long as price stays above this candle, we should continue going up. Right? But the candle have tiny wick. Yeah, that's true. The candle has tiny wick, but we're going off what the price is telling us, right? Because if we were only looking at the candle, we would say, okay, you know what? It has a small tiny wick, so the next candle can potentially come down. But this is the 15-minute time frame, right? We're looking at the overall objective of what's happening, because the fake out is structured like this. Okay, price came up over here, broke down, came back up in the range, it's coming up, so there's a high chance it's going to break above the range, right? So we're looking at the overall move instead of what the candle is doing. Let's see what happens here. Oh, see it pushed up. Pushed up to this area here. Because once it starts to push up, you're looking left and you're watching this. So, I mean, if you entered somewhere over here, which is 98800, but you also had a stop, right? The number one thing is you had your bias. The bias was, okay, this is probably a fake out, and 70% of the time it might break out of it, right? And then number two is, where is your stop? So if you're entering at 800, look at this price, 800, your stop is at around, let's say 700, that's a 10 pip stop. You have a 10 pip stop. So now whether price can come down, you can enter, or price can, you know, start to go up, you can enter, but that's all on how you want to do it. Because like generally, I would wait for price to come down to make a wick so I can enter. I would definitely, generally, I would do that. So when you determine stops at 10 pips, you just shoot for 10 pips? No, I generally shoot for like 12 to 15 pips, and then, you know, I take profits and then put like stop loss at break even and let the last one run. But in this case, I wouldn't be taking any entries because price didn't really retrace down for an entry, and that happens sometimes, and you should be okay with that when that happens. So 70% that it will break out of the upper side of the takeout. Yes, exactly. Okay, because I always hear people say saying to get 2-to-1 ratio or 3-to-1, but I feel like that isn't always possible. That's actually a very good statement, David Colombo from Colombo. That's a very good statement, because normally, oh, New Jersey. Yeah, New Jersey. Yeah, because like Normally that's actually not going to happen, because some people say, oh, I caught like 1 1 to 3 and 1 to 4, but like how often are you catching 1 to 4 or 1 to 3 or 1 to 2? How often is that happening? Not often enough, I can tell you that right now. It doesn't happen often enough. So what the best thing I do is I just aim for like 10 12 pips or like 15 maybe, and then I put stops at break even, and then I let price do what it wants to do. What about a buy stop above resistance? Do you use pendings? I don't use pendings. I don't use pendings. I will use pendings if price has been consolidating for a long time on the 1 hour or the 4 hour, then I would use pendings. Because the longer the consolidation, the harder the breakout. At the end of the day, it's just getting pips where you kind of know where the traffic is and take profits if you like. Yes, exactly. At the end of the day, it's like you want to get confident in taking winning trades. At the end of the day, that's it. When you're starting, you want to get confident in getting 1 or 2 winning trades, because if you can get 1 or 2 winning trades, man, you feel good about yourself, right? If you can end the day with one win and 1 loss, you know that, okay, maybe you're at break even, but you did good. You didn't end the day in a loss, right? Or if you end your day with 1 loss or 2 losses, you still should feel good, because you didn't end the day with a significant loss, right? And the only reason you're going to have a significant loss is if you're going to start chasing your losses, right? Let's say you have 2 losses and you feel like, oh fuck, I got to make this back, and you chase the loss, you're going to get another loss. 100%, 80% of the time you're going to get another loss, because now you're trading out of emotion. You're trading out of like, oh no, you know what, fuck you market, I'm going to come take my pips back. But no, the market is going to take the pips away from you all the time. It's like going to the bank, right? You go to the bank and you realize that, okay, you know what? I have 5 minutes in the bank, or like 10 minutes to grab whatever I can. So you grab whatever you can and you head up, right? But if you stay long enough, you're going to get caught. And you know that if you go back again to the bank, you're going to get caught. So same thing here with the market. Yeah, exactly. Yeah, Jalil, that's absolutely right. Okay, so let's go to the next one. So there's a lot of psychology here involved, right? Like you mentioned me saying, take what you can, like, put stops at break even, take profits, always take profits. When price comes to support or resistance, just know that price can bounce. That all comes with psychology, because when price is rushing towards support, it's very normal to think, oh, we're going to break support, fam. This is going to break support. But it's approaching the support, right? It does not mean it's going to break support if it hasn't broken support. When it breaks support, then you can say, okay, it broke support. But it won't happen if it hasn't happened. So let's go towards, what's this? 5-minute chart? Yeah, see, this is a 5-minute chart. On the same, this is a 5-minute chart on the 15-minute example. So now when you look at the 5-minute, you can see some more information. You see this 5-minute candle. This is unnecessary information, but it's really good to be aware, like, in your conscious mind, that, okay, what's happening on the 5-minute chart, so you can catch a move. So you see the 5-minute candle close back in the range, and then you can say that, okay, maybe I can take an entry with the anticipation that the higher time frame is going to continue moving up, right? So sometimes I look at 5-minute just to study market structure. I will never look at the 5-minute to take an entry. I think it's very, very weak confirmations, and I've been burnt a lot doing that. Okay, let's see what's next. We have the 1 hour. Yeah, see, so this is the 1 hour chart. So when on the 15-minute you see a candle going down, a candle going up, on the 1 hour you just see a candle just making a wick, like quick wick down and boom up. Now on the 1 hour, when you look at how the market moved, you see that there was resistance here to the left, candle closed above. The next candle did a retest and it continued moving up. And now when you look at the time, it's very important to look at the time too. Look at the time. It's 12 p.m. This is 1 p.m. here. Volume is starting to die, right? So as we come into dead market hours, this is dead market hour till here. See, price is just consolidating. There's no movement. There's no movement, no trade. And I'm pretty sure a lot of people haven't noticed that this is USD CHF. USD CHF. So when you're looking at these times, USD is closed and CHF is closed. That's why you have a lot of consolidation, because there's no volume. Okay. All right. Let's go to the next one here. All right. So what's happening over here? We have some sort of resistance forming, right? Seems like price broke out of it. This is a 15-minute chart. So let's see how the next candle closes. Oh, next candle closed bearish. Can we take an entry here? Can we take a sell here, or we should wait for a candle to come back in the range and then try to take a sell? Wait, oh, okay, wait. Ah. See, we waited. That was a retest. Exactly. Now this candle has no way. See what's happening now? It's forming resistance. Now it's forming resistance. Now it's trying to come down. So can this be a good entry, or should we wait until price comes below this area here? I think, yeah, I hate waiting for confirmations too, but I think a good trade would be when price comes down here, and then you can potentially ride this move down. Because if price comes down here, it might do a retest and then continue down. Right, so let's see here. See, we had a move down, price broke down, it came back in the range, it's time to come up. See, notice this now. Now, price came down, this candle broke this support right over here, right? And then price came down, it created support, like it created a low, and now it's trying to make some sort of a resistance here to continue moving down, right? So this is where you start asking yourself, okay, is this the point where I should be entering? Where should my stop loss be, right? So now when it does a retest, you can have a nice stop loss, and then you can let the position run down to support. It did a retest over here. So now maybe you look at this candle and you say that, okay, this candle has no wick to the bottom. So, okay, not a problem. It has no wick to the bottom. You wait for the next candle, right? Because, hey, there's a high chance that after this wickless candle, the next candle could turn bullish. So you're like, okay, I'm just going to wait. So you wait for this candle. This candle formed bearish. So now you know, okay, price broke up, came back down under this resistance, made a low, tried to do a retest, did a retest. So now it should be heading down. When you're looking left, you see this clean move. So now you can say, okay, maybe it's going to come down and mirror this move and continue down to support. So it's all about waiting for candles to close. Sometimes you will miss the move, but that's perfect. That's totally okay. Because when you miss the move, you should be taking a note of how you missed the move, because if that's going to happen the next time, then you're going to jump in it because you've seen it happen before. But price action before wicks, right? Momentum is also a part. Yes, exactly. What if after the first large bullish candle that broke out, then the small red candle closed bullish above resistance? Would you take in the buy? closed above resistance. Okay, hold on. So you're talking about this candle. If this closed bullish, yes, I would take a buy, but then I wouldn't know where it's going to go because I can't see too far left. Yeah, you know, because I can't see too far left. If I wait a little bit longer, because check this out, right? Because check this out. So this move up happened. Look at the time, 3:30, London time, right? London Open, and then you have around 4 a.m. This is still an hour after London Open. So these you had big moves happen, right? Big moves happen. So when you're looking at these moves, you see big candles. In my mind, I'm saying, okay, I've missed these big moves. Okay, awesome, no problem. I've missed these big moves, so now market has to consolidate a little bit. It has to like kind of take a breather because it's moved a lot. So now it needs to take a breather. It needs to kind of slow down. So this is why it starts to consolidate. So while it's consolidating, and you have your zones drawn, you automatically know that okay, you know what, this was your support. No, resistance, price from support went up, and now you're waiting to see what price does when it approaches the support, right? This is a very, very good idea that now you are waiting to see what candles do as it comes towards support, right? So it breaks right through it. It breaks, and then you're waiting for price to do a retest. It does a retest. You look at the time, it's around 7 a.m. Eastern, right? It's pre-New York, so this is when the volume starts to come in the market. And then with momentum and volume in the market, you know that, okay, you will get the move that you were looking for. Possible that there's a higher time frame resistance. Yeah, let's take a look here. Let's see if there's a 1 hour chart. Okay, we got the 30-minute chart here. Perfect. Yeah, so see, so now on the 30-minute chart, you have some more information. This was your resistance. This candle broke up. The next candle, the 30-minute, see how it's important to look at the 30-minute and not the 15-minute, because 30-minute you see clean moves, you see clean candles, you don't see any bullshit. It's just straight to the point. Because look, 30-minute candle closed with no wick, and okay, closed with no wick, I don't fuck with these candles. And looking left, now you see that we have some resistance here, right? So now you waited, candle came down, closed below resistance here to the left, and then a 30-minute candle did a retest, right? So now when this 30-minute candle formed bearish, did a retest, so now okay, we formed resistance on the 30-minute. The 30-minute candle finished bearish. So now if it's heading down, how far will it go down? So you start to look left, you say, okay, well, there was a nice clean move here going up earlier. So now momentum is bearish. We close below resistance. Maybe if we have a stop above the 30-minute candle, we can maybe cash the move down towards support. And when the price comes to support, you take profits, you let 1 or 2 run, because hey, if support breaks, that's bonus pips, right? Because 70% of the time, fake out should go the opposite way, right? But hey, it didn't, oh well, you still got your pips. And then when you move towards, this is 12 p.m. now, price starts to consolidate because, momentum is down. Makes sense. So it's really important to try to tell stories on what the candles are doing. All right, I think this is the last example for fake outs. Okay. So we have a break, we have support here, and we have some sort of a resistance right over here, okay? Because this resistance is based on, so this is the 1 hour time frame, candles reversed over here, so this is resistance, price formed support here. So this is now a good area here. So let's see how price works around here. Okay, we have a breakout. Candle closed back in. Right, so this was the breakout candle, right? And then you needed this candle here to confirm a breakout by closing above this area. But what happened? It closed back inside the range. So now theoretically, it should continue moving down. Come up for a retest and then continue moving down. Now, there's a fake out at the bottom too. Yes, good point. Good point, Shamrez. This was a fake out too. Because if this was support right here, you had this candle close back in the range. And see, the only time price starts to consolidate is this time here. 1 p.m., 12 to 1 p.m., consolidation time. There's no trade in this area. Yeah, exactly. A lot of goat shit here. But look where the volume is. Look where the action is. 6 a.m. Eastern, 9 a.m. Eastern, New York Open. Here, 2, 4 a.m. London Open. Lots of volume. When you get into dead zone, there's no volume, no trades, no fun. Make sense? Okay. So what we're going to do now is we're going to take a little break. We're going to take a little break, and then we're going to talk about some gladiator candles. We're going to talk about chart traffic, and then we're going to talk about EMAs, and then we'll have that trading plan. You are right, Raja. After the fake out, I want to the opposite side and broke support to the downside. Yeah, exactly. But there's still a probability that it might or might not happen, right? That's why there's always it's always a good idea to just take what you can. How long is the break? The break is going to be 5 minutes, 5 to 7 minutes. Guest speakers, I had 2 people, but they didn't really come through. So I guess it's just me and you guys. Okay, perfect. So what we're gonna do is we're gonna take a break here. What do you think of M's and W's? I don't know. I don't look at M's and W's at all. I only look at how candles are moving, how candles are forming. What about success stories? Will we have some? I'm not sure. I asked people to come on. Some said yes, and they haven't showed up. So, what can you do? Yeah. So, by the end of it, if some people do come on, that's awesome. We'll have them here. But if not, we still hear some success stories on Twitch too. Hey Raj, estimate what time this session will end. We're gonna take a 5-minute break here, and I think we got 1 more hour left after this. Yeah, we have 1 more hour left after this. Okay, awesome. So we're gonna take a break here. It's 2:07. Oh yeah, perfect. JR Bliss. Yeah, we're gonna have you on then. Back at 2:15. So 7 minutes, 8 minutes. Okay, we're gonna go on mute. This has been a long session. Holy. All right. So yeah, so we're gonna be back here pretty soon. Hello, everybody. We are back. Just gonna make sure it's still being recorded. All right, still being recorded. Awesome. Okay, so what are we gonna do here? We're gonna do this. All right. Let's keep going here. There's no time to waste. Next, we have chart traffic. Okay. Chart traffic is like, now you got to look at charts as like highways, right? Sometimes, like, you know, when you're looking left or when you're looking at the charts, you see like the candles are congested, right? There's a lot of consolidation happening. That's when there's a lot of traffic there in the charts, and it's really hard to trade because like, you know, the candles aren't going anywhere. But then sometimes the chart is as clear as the autobahn. So autobahn is like that's the fastest highway in, I think, Germany. So that's when I say, like, when you look left and there are clean candles to the left. I think we've talked about a lot of those in previous examples too. So when there are when there's clean candles to the left, you know that, okay, there's probably a cleaner move in that direction as well. So looking left can basically give you a very good idea how far the candles can actually move, right? So let's go on with some examples here. Okay. So we have something like this happening, right? So what's the number one thing that you can do it? So this is a 30-minute time frame. What we want to do is we want to see that if there's any support being created, which is right over here, right? So now there are two things that can happen, right? Now we have support being created right over here, and we have a resistance being created right over here. So now the number one thing is that once we break out here and you look left, you see this clean move down, there's a very, very high chance that the price can continue to go up. Or if it breaks below support, you know that there's a very, very high chance that price can continue to go down. Make sense? But now we got to find out that, okay, where can we take an entry knowing that price is going to continue to go up? So let's wait for the next candle here. There we go. We see a bullish candle. So what does this mean? This means that, okay, maybe we have found support, right? And now we can continue to go up. Make sense? Let's do that again. So when you're trying to tell stories that, okay, we have support, you have this bearish candle forming wherever it is, right? And then you have this bullish candle. So now this is confirming that, okay, maybe this is an area which is important as support. But then you have this next candle, which came all the way down, and then it closed somewhere like over here. So now you know that, okay, this support area is very, very strong. And then you have the bullish close right over here. Right? So as we talked about, you have a bullish close 30-minute, but if you zoom in, you'll see that this candle closed higher than these two candles. So now basically you can say, okay, as long as price stays above the low of the 30-minute candle, it should continue moving up. Let's do this. So, you know, it started to move up. So now if you entered, you would know that, okay, maybe you could have stops at break even, or you could let one position run or whatnot. Because now when you look left, you approach this resistance area. This candle is also approaching this clean area over here. So now if some of you guys, you use, what's they called, trailing stops, what I try to do is when the 30-minute candles are moving where I want them to move, and as long as they're still closing bullish, or let's say as long as they're closing bearish in the direction I want them to move, I keep reducing my stop loss. Like, let's say if I had my stop loss down over here, I'm gonna bring it up and bring it up below this 30-minute candle, right? That way, I'm not only securing profits, but I'm also anticipating that, okay, as long as the 30-minute candle is closing bullish, it should continue to move up, right? And now, now we have this candle with no wick, so we're not sure where it's going to go, but hey, it went bullish. Okay, Rakil, this is where chart traffic confuses me sometimes. Look at that giant bearish erection red candle in the middle. Why did it go down smoothly when looking left? There is no traffic. Hold on. Okay. Look at that giant bearish erection candle in the middle. Which one? This one? Why did it go down smoothly looking left when there's no traffic? That could have been some news. Could have been some impulsive news. Because if it's heading down, because you see this? Yeah, this could have been news, because look, this is around like 7 a.m. and this is Euro JPY, so maybe Euro JPY had some news at 7 a.m. because usually that's the time when Euro JPY has some news. Because if you look at this candle, it wicked above the previous 30-minute candle, and as it started to go down, this was the support where it should have come to, but it blasted right through the support. So when you're looking left now, you see, okay, where's the next area it should come down to? So you see this consolidation box here. And then you see price came up here, tapped it, and then started to move back up. Yeah, exactly. So some people here are mentioning that this was a fake out. That's exactly right. But essentially, what we're focusing on is this area right over here. That you had a move to the downside, price started to go up, and then it started to consolidate. Right, started to consolidate, and then we recognize that, okay, now bullish candles have been forming, so this might be a move back up, because there was no confirmation that price is going to start to continue moving down now, because the way the 30-minute candles started to form bullish. I would generally keep it a few pips below the wick, because you're right, that does happen, that candle wicks below it. So just to not happen that, I generally keep it below a few wicks, because even if you look at it from a pip perspective, let's look at this here. Okay, let's look at this. So this is 125,400. So if it's just below the 30-minute candle, this is going to be what? This is not even 10 pips. This is way less than 10 pips, 7 pips. So as long as it's even like 10 pips, 125,300. Not only that, it's fulfilling your stop loss criteria, but it's also below the 30-minute candle, right? So when guys say, hey, I had a tight stop loss, 6 pip stop loss, and it was below the candle, I still got stopped out, I would say, hey man, your stop loss was way too tight. Make sense? Because in my mind, in my trading plan, I know my stop is always going to be 10 pips in my mind. It's always going to be 10 pips. And then it has to be at a logical position. Because if it starts to go up, and let's say you catch this candle, this comes to like 550, you got 15 pips. Yeah, man. 5 pips. Yeah, 5 pips is too tight. 5 pips is too tight. I don't know what can you get out of 5 pips. 5 pip stop loss is too tight. If you use the 5 pip stop, man, you're inviting the price to stop you out. That's how I feel about 5 pip stops. Like you're telling the price, hey man, look, here's my stop, come take it. No, and price is going to take your stop. If a stop loss is 10 pips, what's your TP? My TP is going to be like, if I'm trading Euro JPY, it's basically like you're measuring how far it can go, right? Because let's say you entered somewhere over here and you kept your stop down over here, and now you're looking left and you see all this range here to the left. You see all this move you can catch. So you measure that move, right? You measure that move and you see, okay, how big is this move? Let's take a look here. So you measure this move. So let's say you entered at 400 and you see that it tops out at around, let's say 700. So that's 30 pips. So now you have a 30 pip range. This is a 30 pip range. So now it's up to you. Where do you want to take profits? You have the 30 pip range. You can catch, you can secure 15 pips and you can let one run with stop loss at break even, or you can close everything at 550, which is going to be 15 pips, or you can that's all up to you. But you need to have a range. You need to know that there's enough range the price can cover, right? Because if you're taking buys, you need to know how far can price potentially go. And then it's not always necessary that price is going to go all the way up there. Sometimes price is going to go halfway, man, and then it's going to reverse. So if you're holding positions with nothing at break even, you're going to end up in a net loss, because you'll say, oh man, I expect the price to go all the way up there, but it reversed, this doesn't work. No, trading does work. You just need not to be greedy, because sometimes price will not go where you want it to go. It's going to go halfway there and it's going to reverse back. Because, man, like a lot of times my positions get stopped at break even. I'd say 6 out of 10 times they get stopped at break even. 6 out of 10 times. But before they get stopped at break even, I always secure some profits and I let 1 or 2 positions run. Right, let's go forward. How long would you let that 1 position run? That's all up to me. That's all up to me. Like if it gets to where I thought price would go, I would close it out. But if I feel like, hey, maybe it won't go there, then I might, let it run. So because that last one you let run, that's a risk-free trade, man. That's a risk-free trade. Even if it goes to 100 pips, awesome. Or if you get stopped out at break even, what's there to lose? Nothing. It's a risk-free trade. So this is the 1 hour time frame. So see how clean the 1 hour is. Before we had the 30 minutes, so we had this little messy thing here, but this is the 1 hour time frame now. See how clean this is, the 1 hour time frame. You had support formed, and then you had this support form, this candle closed with no wick to the top, but look at this exhaustion here. And then you had this candle here form exhaustion too. So when you're only looking at, let's see this. So when you are only looking at this information, right? This information would tell me that, hey man, we're gonna start heading up. But looking at the 30-minute or the smaller time frames, you'll see a lot of information. Now let's look at the 15-minute time frame. Yeah, see, this is the 15-minute time frame. This is where that 1 hour started to form and it started to continue up. So now if you look at how the market structure is forming, we had a movement up and then price started to consolidate. See here? Price started to consolidate. You had the bearish candle, then you had the bullish candle. So 15-minute created support for further movement up. So that's how you look at the smaller time frames. And then you start to realize, oh, okay, this makes sense. This can potentially continue moving up, and which it did. But on the 1 hour time frame, you won't be able to see it because it's just one solid candle. All right, so what do we got over here? What do we got over here? We have a bullish candle forming on the 30-minute time frame, right? So when you look left, you see that it's coming into some sort of a potentially rangy area somewhere over here. So we wait for the next candle. There you go. We got a bearish candle here. So now what's going to happen? This has the potential to continue moving down because it reached some sort of a resistance. Bearish candle closed with no wick to the top. Tiny, tiny, tiny wick, right? So it didn't really even attempt to go up. I usually let it run until the next zone if it has momentum during the session. Yeah, that's pretty good. So, you know, it had no range to the top, which means it didn't even try to go up. So it tried to go down more. So maybe having a stop above this 30-minute can be a great idea because now you're expecting this wick to fill and then continue down to the support. We have support right down over here. This, now we're starting to come down. So now we're starting to come down. As it starts to come down in this consolidation box, you're thinking to yourself, okay, now there are two things going to happen. It's going to come down, and there's a very, very high chance that it's going to start to go up. And there's a very less chance that it's going to break down. It's not going to break down unless we don't see a candle break down. If no candle breaks down, then we're breaking up. Makes sense? So let's go forward. Oh, we have this weird candle close here. It's 30-minute chart. There we go. There's the next candle. So could this be a trade? What kind of trade could this be? Okay. Why can't it be a sell? Okay, Matt Lopez wants to wait. Why can't it be a sell? Wait for a retest. Retest of what? What's the price saying? What's the candle saying? There we go, Santana. There we go, Santana. Santana said it. Santana said it. So look at this. This candle came down. This candle came down. It couldn't go further down, so it closed here. And then this 30-minute candle closed bullish. So we're at support, right? So a stop loss below the 30-minute candle. And then now if you're saying, okay, if it's going to head up, where it's going to head up to? You look left, you see this clean move down. Maybe it's going to go up till here. Ah, Santana was right. Because 30-minute forms support, right? And the second step is you put your stop loss to stop below the 30-minute candle. And then whatever happens, happens, right? Because you took your one trade. Because now look at the time. Keep looking at the time. Look at this. This is 12 p.m. Eastern now. Consolidation time is about to start. Down, see this? So now it's, oh, what's happening over here? What is happening over here? So it formed resistance. This candle was bearish. This candle was bearish. This candle was bearish, but it rejected. And then this candle tried to go up, but it closed below this candle. Yeah, seems like more consolidation, exactly. You stay out of it. Oh, start to go down. Starting to go more down. Oh, I see consolidation now. So this area here, this was the trade for the day. What is this? This is started at 700, 147, 700, and the top of the range was 148, 200. So 50 pip range. What time was that? This was 10:30, before London closed. Wouldn't you trade the top as a fake out? I wouldn't, because you know, at this time I'm not even looking at the charts. Look at this time, 1:30 p.m. Yeah, but if it happens when I'm trading, then I would take this as a fake out. I'm glad you mentioned it, because I put this here to see if someone mentions it. So it's just the time. So see, this, even this is a fake out setup, it's out of my time frame to trade. It's not in a time when I should be trading. So I'm always, so I'm not even looking at it. Yeah, always keep in mind the time you're trading, your trading time. Okay. This is the 15-minute. Now you see more information on the 15-minute. See, we had a 15-minute, we had resistance here, its price came down, started to, you know, do a little retest and continued to move down. Then this move down was a move on the 30-minute. This was the 30-minute close, and then the price started to move back up on the 30-minute. But then 15-minute, this looks like more, this is more confusing. But in the 30-minute, it was way cleaner. It was very easy. Okay, see the difference. This is the 30-minute. Look at this candle here. And this is the 15-minute. These candles here. Such a big difference, right? Huge difference. All right. So we have support formed here again. Yeah, 15-minute and low time frames, man, they're just, you're just calling for trouble. I don't like them at all. They're just calling for trouble, you know. So we have support formed here on the 30-minute. So now two things can happen, right? Either price is going to continue up to this level. Don't worry, this line here, this is from like with, and then if price breaks down, it's going to probably come down to this support, right? So what are we doing now? We are identifying where price can go. If price breaks down, it can go down to here. If price starts to break up, it can maybe go up till here. Okay, let's see what happens. Let's see what we get. All right, what is this? What is this candle? See, now this is going to be a booby trap candle here. A booby trap candle is a fake kangaroo tail, like this candle. This would say that, okay, we're going back down, but if you look left at this area, you will find that this candle closed above here, and this candle also closed above it. It doesn't matter what the candle closed like, it matters where the candle closed. It closed above that area, right? It closed above that area. Wait, next candle. Okay. Yeah, let's wait for next candle. See, fill the range. So stop loss here would have been perfect. Stop loss below the breakout candle. But hey, if you're waiting, you missed the move, that's okay, you missed the move. That's perfectly fine. Where I would have entered at this candle having a stop loss below this breakout candle, the 30-minute candle. Yeah, that was a very weak bearish close. Yeah, I would have missed the move too. But now let's see what happens. Oh, it's starting to go down. Maybe it's going to start to consolidate here. But also, check this out. It reached resistance and it formed a bearish candle. So maybe having a stop above the 30-minute candle and expect The next candle to maybe retrace up and take sells and then go down would be a good idea. London push. Yeah, this was a London push, you're right. Let's see how far does it go. Now you see the size of these candles. The size of these candles, they show that that price is in momentum now. So the momentum is down. So when momentum is down, you're constantly looking left, right? So when we're looking left, you see, okay, if it's heading down, maybe it should come down to the support here, right? Because this is the support, and this is where it should have some issues. Came down to support, take profits, and then you let the price whatever it wants to do. So now we're coming into pre-New York. I hope people are looking at the time. We're coming into pre-New York. Let's see what happens. Oh, we have some sort of consolidation, but looks what happened. 7:30 a.m. pre-New York time. So what's happening now? We formed support. This bullish candle, it closed above this candle and this candle. Make sense? Yep. Engulfing candle suggests change in direction. So having a stop, yeah, having a stop below the 30-minute candle, and you can anticipate a move up. Right? So now if it's moving up, you're looking left to see how far will it go, right? Maybe till here, maybe till here. A greedy person will say all the way up to the range, but a smart trader will say, well, maybe halfway, and then maybe let one run wherever it wants to go. It's just going to start to consolidate. Okay. I'm greedy, we're going to be smart. Yeah, see, so now this, another thing here. From support, 30-minute. 30-minute is higher confirmation and it starts to go up. But I guess by now, you guys get the point. That it's really important to read candles. Yeah, that's fine. That's fine. You could stay out. That's what I said. It will take time. It will take time for you to really identify that, okay, what candles are trying to say. Plus also you gotta realize is that we're doing analysis on different pairs as well. Like we moved from GJ to GU to UJ, EJ, this is USD CAD. Right? So let's go to the next chart. So this is the 1 hour chart here. So you see how cleaner 1 hour chart is? That you see this candle came down, this formed support, bullish candle. So next one you can say that, okay, you know what, we're probably going to move up. Mirroring moves here. Even this on the 1 hour too. So the point is, all you got to do is you just got to wait for price to form supports on the 30-minute or the 1 hour, like support or resistance, And then let's go to the, I'm actually having lots of fun. I'm having lots of fun over here. So we're going to move to the next one here. Let's move to the next one. Oh, wow. Okay. What's happening here? All right. Interesting. Okay. So this is the 30-minute time frame. Price broke down. What are we doing here? What are we doing here? I guess we're just waiting. Do you use trend line sometimes? No, I didn't use trend lines at all. We're probably going to wait over here. Probably waiting. Price is starting to move up. Move up. So now when price is starting to move up, what you're trying to do is you're always trying to see that, okay, if price is moving up, you're waiting to see, okay, it broke this support, right? It broke this entire area. So now maybe for price to come down, yeah, exactly, right? So it needs to fill this void, right? It needs to do a retest somewhere here to continue moving down. So let's see. Okay, so we got this candle here. The candles are starting to close in. So basically, you can still say that we will try to go up. So now you see this. See this exhaustion candles and this exhaustion here as well, right? So now look at this. This was 7:30. This was 8 a.m. 8:30. This is 9:30, right? So if we look on the smaller time frames, this move is consolidation, right? This is just consolidation. And when you are a retail trader and you're looking to see that, okay, you know what, this is probably going to come down right now, but what you don't realize is that look at these exhaustion wicks here to the bottom. These are all exhaustion wicks to the bottom. There is no indication that it's starting to go down. Look at EJ right now. EJ right now, market is closed. So, this should continue pushing up to fill the range. Next candle. And then let's go to the next one. So, see? So now, haven't we seen this a lot now? Let's look at this candle here. See this area? This candle closed with no wick to the top. It closed at resistance, closed bearish, right? So isn't there a big chance that can continue moving down? Those were booby trap candles from everyone who wanted to sell. Yeah, exactly. Yep. So now you can say, okay, if it's going to come down, now it has the ability to come down because it's rejecting this area. Slowly but surely. You catch a pips, put a stop above the candle, and then you let it run. No wick candles in zones are also a great indication that the next candle will go in the opposite direction. Yes, that's absolutely true. Sell on the small 30-minute candle close? Yes, because if you're selling on the 30-minute candle close, even right here, now you're anticipating this wick to get filled, right? And this is GU, and so GU gives some pips too. We're gonna look at it here in a bit. Let's see if it starts. So it came down to support. Perfect. See, so if you're looking at this price 31400, then this is 31300. So it's 10 pips. And if you're waiting for the bottom of the wick, this is 31000. So it's almost like 40 pips. And then, as you move towards 12 p.m. and 1 p.m., you start to see consolidation, and we stay out of this. Well, a booby trap candle is just the name of a candle that will try to throw you off from your trade. Like, let's say sometimes what happens is that you have a bullish candle like this, you have a bullish candle like this, and then out of nowhere, you're going to have a bearish candle like this, right? And then what's going to happen is, so now what this would mean is that, okay, we close right over here. So now this bearish candle formed. So this bearish candle could not close below the bullish candle. So we're still bullish. So now sometimes people get caught in these moves because the next candle, what happens is that it starts to form something like this. And then, and then it starts to go up further. So this candle, this bearish candle would be a booby trap candle. How would you explain a double top or a double bottom? Well, a double top is when price comes to a resistance and it rejects it, basically, right? Because this can be a double top here, because if this was news, the price came up, right? Went higher up in the range, but closed down here. So if you look left, this is a consolidation area. So in terms, this is also resistance. The price went down, came up again, tapped into resistance again. So now you have a double top. And double bottoms are the same thing. Like if price made us support here, somewhere down the line, if price comes down to support, it's going to bounce from it too, because it bounced from it once. So there's a very high chance it's going to bounce from it again. So then you can say, okay, you know what? Okay, now we formed a double top. We formed a double bottom. Let's move to the next. Okay, so this is the 15-minute. Okay, let's go to the next one. All right. Oh, okay. What's happening over here? All right. So basically, okay, I'll let someone do analysis on this. Possible fake out? No, this is the 15-minute. So you have, first off, we have resistance here. Okay. And then we have support here. Okay. Possible fake out. JC said fake out. Would say is a fake out. Price to go down. Stop loss on top of the 15. TP bottom of the range. Yep, absolutely right. So you can take a stop loss right here, because if you're saying this is a fake out, then there's a very high chance that it can break down. So once it breaks down, you're looking left to see how far is it going to go. Make sense? Oh, nope. Oh, why does it make sense? Practical tips. Why does it make sense? Practical tips. There was no retest. For what? To go down? Okay. No, that's fine. But what we're talking about here is, let me just read. There are two things that you can do, right? You had resistance, price broke out. You agree? 15-minute was right over here. But now you're also looking at the time. See, 7 a.m., 8 a.m. And then when you came to charts, you're seeing this 15-minute candle closing back under resistance. So now, technically speaking, it closed back in the range, right? But now, if you're still being cautious, you know, if you're a very cautious trader, that's fine. You just wait. So now, oh, okay. So now you see this kind of form down. So if you're looking left, you notice how this candle is closing below all the other candles. Yeah, so maybe this is the time where candle will continue falling down. Came up. Do some sort of like a move to break even. Perfect. Yeah, see, guys are following. They're all new guys. Continue moving down, and then we still have this range to fill, and then move down. But whoever mentioned that this was a fake out from the top, that was perfect. Because this way you entered price super early from the top. Yeah, exactly, and you're posted on the ground. Should have increased my lot size. Yeah, exactly. You know, so you enter from the top anticipating a fake out, and then 70% of the time, if it's a fake out, it's going to continue the opposite way, and that's what happened. Okay. Okay, let's go next here. Can you explain booby trap candle, please? Yeah, booby trap candle. It's just a name I made to better, like better relate things to myself. I mean, on the higher time frames, those are just retest candles. Because if you look at this candle here, this closed below all these candles here to the left, and then this was a retest candle, right? So if it's a retest candle, it basically means that the candle after that will continue going the opposite way. All this explains why I'm trading stuff. Oh, practical pips is a troll. Okay. Yeah, that's why I didn't want to post it in everywhere else. Right. Yeah. So when a retest candle like that happens, it just means that it's an opposite way candle, because the candle after that will continue moving where it wants to go. So really understanding booby trap handles and breakout handles, it all depends that you need to see it happen over and over again. Do you just kick? Yeah, 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 because I don't want any distractions, right? Like people paid good money, and I want to make sure everything is done correctly. So I don't need any distractions. So that's the thing. Most of the concepts you will see here, you will understand them way better once you see them happen live in the market over and over again. Trust me, when I first saw breakouts or when I first saw breakouts, I watched them happen maybe like 2-3 weeks in a row, and then I realized, oh, you know what? This is worth writing about, or this is worth teaching about, because it does work, right? So that's all gonna it's just the first day. It's just the first day of the webinar, and maybe joining a group too, so it will take some time. What strategy do you use? I just wait for fake outs, or I'd wait for a breakout. So it's like a correction in one candle on higher time frames of more candles on lower time frame. Yes, exactly. It's a correction on the higher time frame, but if you look on the smaller one, on the lower time frame, you will see candles going up and then coming back down. So it's basically a retest on the smaller time frames, but it's a correction on the higher time frame. That's, I think, the best way to put it. Okay, okay, this was the same example here. Time for a break? No, we already took a break. Is there any indicator for more confirmation you use? No. There is no indicator for more confirmation. Sometimes, I would use EMAs, but sometimes I use EMAs, but not a lot, right? Like I only use EMAs if, it's going with the trend. So we're going to talk about some EMAs here as well now. Yeah, breakouts and fake outs, because technically they make sense, and I don't think there's any other way, because breakouts are basically you're trading the trend. Breakouts you can also catch on swing trades when you're trading like based off the daily time frame, the 4-hour time frame, the weekly time frame. Fibonacci's, I don't use Fibonacci's. I used to use them, but then at the end of the day, what was happening was that they were really contradicting my original analysis. So I stopped using Fibonacci's. I have a love and hate relationship with Fibonacci's. Yeah, so the less indicators you use, the better your confirmations are going to be, because then there's going to be very less things that will contradict your analysis. Yeah. Okay. EMAs. This is very optional. If someone wants to learn about it, perfect. If you don't want to learn about it, that's totally fine too. But these are very optional. I wouldn't really stress a lot on EMAs. EMAs are just there to provide you confluence with where the market can go, right? So basically, the EMAs used is 14, 50, and 200 EMAs. You don't have to use them always. Just make sure that price action makes sense first, because price action comes first. Indicators come in the end, right? We're going to talk about that here later. During breakout and continuation retest, you will notice 14 EMA playing key roles as a wow factor, you know. The 200, now, when people, they start to use EMAs, if you do start to use them, you have to realize that, okay, the 14 EMA is going to act as a mini support or mini resistance. 50 EMA is going to act as a stronger support or resistance. 200 is going to act like the strongest support or resistance, right? I wouldn't really recommend new guys to really focus on these, because they do take a lot of practice, right? And sometimes when price is ranging and you see 14 EMA, like, you know, guiding price, that can really throw you off, because when price hasn't broken out, there is no trade. But sometimes the EMAs are going to come up in a way that it will make you think that it's a trade. So that's why I wouldn't really recommend for new guys to use EMAs right now. So let's go forward. Okay, so 14 EMA acts as a dynamic support resistance. This is just for your information. If it's going bullish, the candles have to be closing above it, right? So if candles are going bullish, if the momentum is bullish, and if they're closing above the 14 EMA, I hope you guys are making notes. If the candles are closing above the 14 EMA, let's say on the 30-minute or the 1 hour, then there's a very, very high chance that it can continue to go up, provided that there is enough range to fill. Makes sense? Let's say price made a high, price came down, made a support, just like we talked about earlier, and starts to go up. Now, what you're going to notice is that 14 EMA is going to start to trail up. Now, as long as there is range to fill, it will continue moving up. I see. Now, you will know this move based on price action itself, right? But then you're going to have the 14 EMA here, just like kind of like guiding you. Hey, man, yeah, we're going up, keep going up. You know, same thing happens when price starts to go bearish, right? So we're going to look at a lot of examples here too, based on that, just so that, you know, we can make it more relevant. Oh, just want to get it down. Okay. All right. EMAs with market structure. All right. What's happening here? This is the 15-minute chart. Okay. This is the 15-minute chart, right? Price was making support here. Now we're just trying to tell a story, right? Price was making a support. Candle broke down. Next candle went up, right? Next candle went up. And then price started to make some sort of resistance. And then price came down, and then it came back at the support and finished the bullish candle. Based on what we've seen is that this should be a good indication that will continue to go up. Yeah, exactly. But then again, you have to look at the time. This is PM here, so we won't be really so sure. Makes sense? Just look at this time. This was a trick example. Another one. See, now we're going to bring on the EMAs. Boom. We got EMAs in. This back. Boom. EMAs. So you always got to be cautious about the time. No one really said, oh, it's not the time for me to trade. You should look at the time. All right. EMAs with market structure. The next candle. All right. So 15-minute time frame. Let's see here. So first of all, what we're going to do is we're going to see if, okay, so we have resistance somewhere here, okay? And we have support somewhere down here, right? So now two things can happen. Either price can continue to go up and it can continue moving up towards this resistance, or somehow the next candle can go bearish and then we can just sell towards support, right? See what happens. Oh, this is perfect. So what does this mean? What can someone tell me? What does this mean? You only have to say up or down. That's it. You need to get into practice of saying up or down. There's no buts. There's no ifs. It's only up or down. If it's up, you have to know where your stop loss is going to be, where you're going to put your stop loss. Right? Because check this out. So if you are trying to, like, read the candles, look at this. 15-minute form support, this broke down, this came back up, and then this candle, it looks like it closed back in the range here. Make sense? Yeah, so the stop will be below this candle here. Let's see. Oh, look, yeah, we came up. And then it started to range because look at the time, it started to range now. Yeah, but in volatile times, it will continue to go further up, right? So now let me bring on the 14 EMA here, and you see what I was meaning here. It's 14 EMA. See this candle closed above the 14 EMA. This candle closed above the 14 EMA. 14 EMA acted as dynamic support, right? So you guys are right. Stop below the 15-minute candle and then continue to move up. Oh, I would love to stay. Oh, take care, Kyo. Kyo. Is that how you say it? Kyo? Yeah, so it's going to be it's going to be recorded. Well, actually, it is recording. It's going to be up in the drive. I'm not sure how big it's going to be. Yep. So let's go to the next example here. All right. Very good example here. Okay, let's see what happened here. So price has, let's see, this is the 1 hour chart. This is the 1 hour chart. So we formed resistance. And then we're trying to form some sort of a resistance here again. Right? Oh, okay. Now we're waiting. Okay, see, now this makes much more sense. Now we formed more resistances here. And now if you look at the time, this time is coming on to 6 a.m. Look at this time. 6 a.m. we are coming on to. 6 a.m. means this is pre-New York, right? Pre-New York. Oh, and we got the bullish candle here on the 1 hour. 6 a.m. What's happening here? Retest so far. That bull candle is a retest. Okay. So are we heading down based on this candle, or are we heading up? Up. Okay, perfect. So is this candle enough to tell us, okay, if we're heading up, where can we have our stop loss if we're heading up? Below the candle. Perfect. 1 hour candle. Below the wick. Perfect. Let's go forward. Yeah, perfect. That's the trade. This trade is done. This is New York session trade. Right? And let's go forward. See this? See this fuck you candle? This is a fuck you wick right here. If you take profits, you let one run with stop loss at break even, you got stopped out. but you already took profits. Yeah, you get 5 pips on Eugene. That's true. Oh, actually, it was let's see, how many pips was this? Let's see, we entered at 112.50. Yeah, almost 10 pips, barely 10 pips. Okay, so let's bring on the EMAs here. The EMAs, look at this magic, man. It looks so cool. Look at this. Man, so cool. See? So now notice how this 1 hour candle closed above the 14 EMA, right? This red one is the 14 EMA. Look at it. It closed above the 14 EMA. Yeah, and the crossover too, it pushed up. So now look at this 1 hour candle. It came down to the 14 EMA, tapped it, and went right back up. And then this one here as well, it tapped the 14 EMA and went right back up. Yep, confidences. Okay, we have a couple more examples here. I hope so far this has been making a lot of sense for a lot of people here. Okay, let's go to the next one. All right, what's happening over here? What's happening here? This is the 1 hour chart. This is the 1 hour chart. Price fell all the way down. What did price do here? If not using EMA, the bullish candle closing above support would have been the confirmation for buys, right? Yes. Yep. Exactly. That would have been the confidence to take buys. Okay, so this is the support right here on the left that price broke. Price came down. I think it's starting to make support here on the 1 hour. Now, yeah, exactly. Oh, you're right. It needs a retest. It needs a retest to take sells. But I know a lot of cowboys, they would like to take buys here because the 1 hour closed bullish and they take a buy with the stop loss below a 30-minute candle. I call bottoms, I'm a cowboy. Yeah, but you waited for a confirmation. Okay, perfect. Look at this. We're trying to move up. We're trying to do a retest here to go further down. But where are we entering? Where are you entering? You're waiting for the confirmations. I'd wait for a bearish candle. Yeah, it makes sense. Oh, look. Is this your entry? This bearish candle? Where will your stop loss be? Where would the stop loss be? Yes, above the 60. You know, and now, if you're looking left, you see that this was a clean move up, right? So it only makes sense that there would be a clean move down too, because, you know, there's less traffic here. Yep, continue to move down, maybe do a little retest, and then continue moving down. That was perfect. But guess how the EMAs look here? You were just surprised how EMAs look here. Does this make sense with EMAs now? Because you're looking at price action first. We're looking at price action before we're looking at the EMAs. Because the price action says, okay, we're heading down, and then you look at the EMAs. Because indicators come in the very end. Yep. See, price action made sense first. All right. We got this fun time happening over here. Price is ranging. price is ranging. And yeah, it's a shitty chart basically. It's a very shitty chart. Oh, bullish candle. Broke up. Yep, resistance broken. And continue moving up. There's a resistance broken on a dotted line. Right here? Yeah, but this is very aggressive. Yeah, this is very aggressive. So maybe this is coming down for a retest. Yep. This could be, yeah, back to breakout, retest and up. So yeah, this would make up for a nice retest candle. Oh shit. Yeah. So if you look at the time, this is 3 a.m. This is London session. London session has these wild moves, 3 a.m., 2 a.m., 3:30. Yeah, that wick would have been a very aggressive buy. And then look, it starts to like do another retest and it continues to go up. Yeah, that's London session. Where are we now? Right at the bottom there when you look left. Let's look left. Where? Are you talking about right here? Right here? No? Oh, right over here. No, I wouldn't say that because it's a 15-minute time frame. Right? It's a 15-minute time frame because there's not much confirmation here on the 15-minute time frame. Let's see what we can get on the 30-minute. We have one. Oh yeah, look at this. Look at the EMA confluence here. At this bearish candle came down, tapped the 14 EMA, but closed above it, right? So remember when we were talking about that 14 EMA being like a strong support, 50 being like a stronger support, and 200 being an even stronger support. So this candle closed above all the EMAs, right? It broke out, made a high, closed above all the EMAs, closed above this resistance. So there's a very, very high chance it's going to continue moving up. But this was a very aggressive trade. I think the higher time frame is going to give us more simpler information here. Oh yeah, there we go. Yep, so this candle was the confirmation. Yeah, this fake out. This 30-minute candle was the confirmation. Stop below support, formed support. And then, as you look that we're coming towards the volatile time of the market. Right here, like this one. No. For a fake out, the price needs to range, price needs to have like a bigger range like this. It needs to have a range so that it can fake out, try to go down, but it comes back up and then goes up. So it needs to have a bigger range than this because this is just, I think, way too small. Yeah, no problem, Scott. Have a good day. If you get 15-minute close bullish, do we have to wait for the 30-minute close too? I would definitely wait for the 30-minute close candle because from what I've seen, 30-minute closes, they give the best confirmations, 30-minute closes. Because sometimes, let's say if there's still 15 minutes left for the 30-minute candle to close, that thing can just reverse all the way down, right? That thing can just close in a way where you're like, oh man, now what? So that's why it's really important to wait for the 30-minute candle to close. Gives you really good confirmations, gives you really good confluences, right? So now if you were just following price action on the 30-minute, you could have entered right here saying, oh, look, we formed support and, you know, we're going up now. And then while you're waiting, so now, but in the other spectrum, if you're waiting for the EMAs, you're catching a late entry, right? Because indicators are always lagging, right? They will tell you things that are supposed to happen after they've already happened, right? That's why they say always follow price action, because price action will kind of like, you know, hint towards things that are about to happen like that in the now. But EMAs, they're always lagging. All right, what's happening here? We got the 15-minute chart. Let's see. All right, appreciate a lot, fam. Thanks, man. Rob. Oh, I'll talk to you later. Best is to skip EMA and go naked. Just confusing now. Yeah, exactly, right? So we're gonna keep it very, very naked here. We keep it very simple. Let's go and see if we have any confirmation. Okay, so we have a move up here. We have a move up. Let's draw resistance. Price broke this resistance. Wait for a retest. Oh, price went up further. No retest, no trade, right? No retest, no trade. Oh, price trying to come down. Candle closed with no wick. So, you know, when candle closes with no wick, I don't fuck around with those candles. There's a high chance that the next candle can go up. And there's a less chance that that next candle can come down. Oh, see, the candle came down. So now, this would be a very aggressive entry. This would be a very aggressive entry for buys. Because, oh, this is Euro USD as well. So this could be a very aggressive entry for a buy. I do think this would be a retest to go further up. I wouldn't buy it. Yeah. That's fine. See, sometimes the retests are not as clear as you want them to be, but that's totally fine. That happens. Where would you have entered? Me personally, I wouldn't have entered. I would have maybe taken a risky entry because basically I want to see a bullish candle close somewhere over here so that the next one can continue moving up, and that next one would be my confirmation to go up. But as this candle moved up, it's just, you just missed it. You know, sometimes it happens. You miss entries. But the times when you miss entries or when you miss trades, that's the time when you just want to, like, you know, sit back, relax, and just like say that, okay, you know what, maybe this wasn't the trade for me. And now we got the EMAs. I generally never look at EMAs, really. Only sometimes, very, very sometimes. All right. This is interesting chart. This is interesting chart. Let's see here. Gotcha. Exactly. Perfect. Consolidating. Oh, you guys are catching up nice. You got consolidation here. See, arranging. No reason to make sense out of it if it makes no sense. See, still gotcha. Oh. There you go. We got the breakdown, right? We got the breakdown. So now we gotta wait for a retest. See this? So see these candles here? This candle broke below than all these recent candles. We got the retest. So even though this is a bullish candle, okay, this is very important. Even though this is a bullish candle, you got to see where it's closing, right? It closed below this resistance. Yep. It closed below this resistance. So this should be, well, this could be like a retest candle too. Moving down and moving down, oh, and then moving up, right? So if in case, let's say people miss this move down, right? Yeah, if you've missed it, yes, exactly, William Chandra, you would have caught in the fake out. Because if you've missed it, you waited, and then the candle closed back in the range, then you know, okay, this move down was a fake out. And then the 70% of the time, what happens? The price will continue going the opposite way. And it went the opposite way. Yeah, I like fake outs better than breakouts too. So now let's bring on our friends EMAs here, and you know, if people trade on EMAs, look how, yeah, see, they didn't help you here at all. There's no help with the EMAs here at all. Yeah, exactly. You missed the move, wait for the retest, and then you know you're like, oh shit, you know, call it a day. Yep. All right. So what do we got next here? We have, ooh, we have break time. But since we don't have much left, so we're just gonna go through everything what's left here now. Those were the examples. Those are the examples. I made sure that the examples were pretty extensive. What's left? Basically, there's trading plan left. There's a little bit of mindset things left. There is something called like how to track your growth. That's left a little bit. So maybe like half an hour or something. Maybe like half an hour or something. Okay. Mindset and statistical probability. So now we went through some strategies, right? We went through breakouts, we went through fake outs, we went through like, let's say you have a breakout candle and then you got to wait for a retest for the move to continue, right? All these strategies work, right? Let's say if someone trades harmonics, they work too, but every strategy has a statistical probability of working. Like, let's say if you only trade breakouts, you will know that 60 or 70% of the breakouts, they will always work, right? But the thing is, what would you do if your breakout trade fails, right? If let's say you trade 10 breakouts, and after let's say 2 or 3 successful breakout trades, you have a losing trade. What would you do now? If you have a losing trade, would you just accept that as a statistical loss, or would you take that loss personally, right? Taking that as a statistical loss, it means that you accept the loss. Yeah, exactly. You accept it. You accepted that this loss was supposed to come. It's a part of your plan. Because if losses are not a part of your plan, man, after that loss, you're gonna start revenge trading, and then you're gonna fuck up your whole like your strategy. Because here's what happens. Let's say if you take a trade and you lose the trade, right? And let's say you're doing let's say you're only trading fake outs, right? And you lose a trade. Now, when you lose a trade, you get mad. You're like, oh man, fuck this. Why did I lose a trade? So now you try to revenge that trade, right? So now when you try to revenge that trade with something else, what's happening? You are not letting your probability play out, because now you're moving from a fake out to something else. So now your probability of having a loss greatly increases. Rather than waiting for another fake out in the next day, you're going to start to force another trade just to make up for that loss. And that's the wrong mindset to start with. Makes sense. So whenever I lose a trade, like sometimes you guys would see me on Twitch, I would take a trade, I would lose it, and then I would take the same setup again, and then I would win it with more pips. That's just because, you know, if I lose it, I'm like, yeah, okay, whatever, you know, like I would take a trade every day. Like this type of trade, I'll take it all day. You know, if it's a loss, that's okay, because the next time it's going to be a win. And then you change strategies from jump. Yeah, exactly. And then what happens is you jump from one mentor to another mentor. Because trust me, I've only had one mentor, and that's been Ted. And we have worked together for the past 3 years in trying to simplify trading for not even ourselves, but for people who come to us to learn. Right? So that's the thing. That also goes with discipline too. Like if you only stick with just one method, it will work in the long term, right? But you just cannot let your emotions come in between it. You cannot let your greed come in between it. Even, you know, guys who start small accounts, let's say someone starts with a $200 account or a $500 account, you know, like in the start, you won't see the money come in, but your main focus should be on getting and securing wins. Because if you can secure wins on a $500 account, then slowly, you know, like, you know, that over maybe 2, 3, 4, 5 months, that 500 can grow to a 2,000 or $3,000. Because guys, trust me, when you start making $100 a week, that $100 a week turns to $300 a week real quick, and that $300 turns to 500, and then $1,000 a week really fast, right? And once you get to $1,000 a week, man, I remember, like, when I started making $1,000 a week in maybe a month and a half, that thousand it came to 3,500 a week. How do you handle all the money? Give it to my wife. She doesn't spend it. She keeps it. That's what I do. Yeah. You know, so it's just about staying consistent, you know, staying consistent with what you know, and really understand that this is all what it's going to take. My first mentor was Invictus FX. Invictus FX first mentor was me. He joined me first. It's all about possibilities, as you say. Let's say Ted, he is doing very well, and I think he has below average losses. It's because he is very, very, very good at reading candles. Do you know his key? What I noticed on Twitch speaks a lot of big time frames, the weekly and a daily. Yeah. So basically, Ted, what he does is he's basically going to say that, okay, let's say that the daily candles have formed like this, you know, and then current daily candle is forming kind of like this. So he's going to say, okay, well, since the daily candles are bullish, there's still room to go up on the daily candles, right? So let's say this room to go up is 40 pips. So then what he's going to do is he's going to go to the 15-minute time frame, and he's going to look to see if it's time to make supports, just like what we looked at here in examples. Because if price is time to make supports on the 15 and the 30-minute, then we can say, okay, if there's a 40 pip range, I can cash like 25 to 30 pips out of it. That's it. See, so it's not that hard. Raja, off-topic question: IC markets or traders domain? Well, if you can go with IC markets, go with IC markets. If you can go with traders domain, you can go with them too. Like, I've been with IC markets. IC markets stopped operating in Canada, so I had to go to traders domain. So that's why I'm with traders domain, because IC markets stopped working here, and my friend had a brokerage, which is TED, so I joined him. So basically, he's doing the same, sir. Yeah, exactly. He's doing the very same, because that's how you trade, right? You figure out how far price can move, and then you enter based on that movement. That's it. You just look at if there's enough room for price to go in that direction, and then you go with it. Maybe that comes with, like, let's say if price is consolidating, you wait for a breakout. Or let's say if a breakout doesn't work, and if you're looking for fake outs, then you can work with that too, right? But it's very important that for the first week and a half, you guys just watch the market and see how price is forming on your pair, right? So we're going to talk about let's see here. What's this? Demand. Is there enough room? The trend the time, one strat. What? Oh yeah. Is there enough room? How's the trend? How's the time? You know, one strategy. I've made like 15 pages of notes. Oh god damn. But there is doing so. Oh, this is okay. But trade is doing so much money. He starts a big amount, or how does all the money come? Stupid but interesting question. You know, man, the money comes with you compounding. Like, you know, when someone starts a business, I'll give you an example. When we came to Canada, my dad, like, we have a family leather business, right? So when we started, we opened our first store here in Toronto, and our first retail store here, I think the whole year, our sales were $11,000. The full year sale. The business made $11,000 the first year, right? Our rent for the whole year was around $24,000. So we were in negative the first year, you know. The second year was better. The third year was better. Now, last year was our ninth year. And in ninth year, we did around, I'd say like $280,000 sales this ninth year, right? So when I started Forex, I wanted to make money quickly, you know. So in the first year, I lost a lot of money. And then I realized, man, hey, wait a minute. I'm like, okay, yo, wait a minute. Like, this is just like a business. Like, you know, it's going to take time. It's going to take time to run things up, you know, but slowly and surely it worked. Like, Berner is a really good example. Like, he has an account running on Traders Domain. I think he's up 700% in like, what, 2 months, almost 2 months. So trading, man, you got to give it time. You got to give it time. People start with $500 or $200. You got to go slow. You gotta get confident in winning trades, because once you get confident in winning trades, then you can start risking more, because you've seen the things happen over and over again. Raja, I hope it's not too personal question, but where did you get 100K for your first account? No, I never had 100K. I started with $700, and I ran that up to 5,500 in the first 2 weeks when I joined TED, and then I lost it all. And then I deposited $10,000, and then I lost it in the next month. And then I was like, okay, you know what? I can trade now. And then I started on demo. On demo, I ran $1,000 up to 50K in a week. So I was like, okay, perfect. So I deposited $20,000 more, and then obviously I had the mindset of demo. So I deposited $20,000. I lost that in 3 weeks, and and then I started losing money. So I almost lost all my savings, and then I realized, okay, you know what? This is just I just gotta relax. I talked to Ted, and Ted's like, hey man, like, how to trade. You just gotta just take it slow. Just take it slow. That's when I was looking at my trades, on my losing trades, and that's when Wicks Don't Lie was born, because I was looking at the charts, and I was looking at the wicks, and I'm like, wait a minute, these fucking 4-hour wicks, they get filled when prices in momentum. And that's when I started to realize, okay, you know what? This happens systematically when there's momentum in the market. So I started to look back. I'm like, okay, like, you know what? There's momentum in the market when there's New York session. There's momentum. So if I can only trade New York session, if I can only trade 4-hour wick fills or the 1 hour, I can probably get better, and then that's it. That was the start of making trading simple day after day. Where you had most, my most of my losses came from overtrading and over risking. That's it. Chasing losses was like you take a loss, you take another trade, you take another loss, you take another trade, and then you take a trade and you remove your stop loss. What's going to happen? You're going to blow your account, or you're going to lose big time. So how much do you make around at the moment in a month? Well, it varies. Like some months when I'm really busy, like this month I was busy with prepping for mentorships. I think with trading I did around maybe $7,000, but it depends from like month to month. Like I try to make my bills first. Once my bills are made, and then the rest is just on top of that. All right. Let's go towards trading plan. Yeah, man. all your losses are going to come from overtrading and over risking. That's it. There's no other reason you will have losses. Trust me. You guys can write this down, and I'm going to ask you this in 2 weeks. Okay, so let's go towards trading plan. All right. So this is what your trading plan should consist of, right? The first thing you should have in your trading plan is what pairs are you going to trade, right? You can start with USD/JPY. You can start with GBP/JPY, like Euro/JPY. You can start with gold, like whatever. But you need to choose your pair, what pair you're going to trade, right? That's the most important, and you have to stick to that pair. Because, man, pairs, currency pairs are like women, right? You need to spend a lot of time with one of them to really get to know them. And once you get to know them, they get really easy to deal with. Make sense? So you need to focus on a pair. You recommend one only? Well, you can use two. I'm pretty sure a lot of people here are somewhat experienced. So I would say, yeah, you can choose two as well, but I would recommend just one pair. Because in the start, when we started trading, I was, yeah, 3 pairs, that's too much, man. GJ, EJ, USD CAD, that's just too much. You got to choose one pair. Because when I first started trading, I started with we started with USD CAD. We traded in groups. Like when we started, because our group was maybe 30 people, and we only traded one pair USD CAD. And then we slowly switched to USD/JPY, and we started trading USD/JPY. And then we started to look at gold, and then we started to trade gold. I'll give you an example. I recently started trading GBP CAD, but before trading GBP CAD, I sat and watched GBP CAD for a month in New York session. I just watched it move. I just watched it do its thing at like 7 a.m., 8 a.m. I just watched it. And to me, it was like, oh man, this moves a lot. Maybe one day I can catch a trade on it. And then, after a month, I think I had enough experience in it. So then I started to trade GBP CAD. What pair do you recommend, or just a decision to make? What pair you recommend to trade at the beginning of advantage? I think USD/JPY is good. Euro/JPY is good. They move pretty clean. GJ, there's a lot of uncertainty with GJ, with Brexit and all that. And sometimes GJ can really, run around with a dildo in its hand. So, I mean, GJ could get pretty messy. But USD/JPY, I think it's really good. Euro/JPY and USD CAD is really good too. Gold is really harsh to trade. I agree with that. I stopped trading gold. That's why I stopped trading gold. Ted only trades gold. He's been trading it for like years, so I can't trade gold. Maybe because I haven't watched it enough. So okay, what time to trade? This is also very, very important, that you should really know what time you should be trading, right? What time you should be trading. So UJ, EJ, USD CAD. No, choose one pair, man. One pair, Tim. One pair. Remember, you're in it for the long term. You're not in it to make money in the next month, in it for the long term. Because if you look at all the successful traders, what you will read about them is that they only trade one instrument, which means they only trade, let's say, either oil, they only trade GBP USD, or they only trade, let's say, something like gold, right? And they're really good at it. So you got to be really good at what you do. Because if you focus on more than 2 pairs, you're going to be average. You're not going to be good. And you want to be the best at your pair. You want to be the kind of person who someone goes to and says, hey, man, this guy is a master on Euro/JPY. Let me ask him what's happening. Like Burner, man. Burner trades this retarded pair called Euro/AUD. Euro/AUD, like, never even in my dreams I would have thought I'd be trading Euro/AUD, but he's been trading that for a long, long time. Yeah, he's been trading for a long, long time. So whenever I want to trade Euro/AUD, I message him. I'm like, hey, what do you think about this pair? Or where do you think it's going to go? Because he has that down, right? Which is best to start with? It's up to you. It's up to you. What do you think is best to start with? It's up to you. Which one has treated you the best? You choose that one. And then You just focus on mastering that one. It's going to take you a long time, but you have to keep at it, man. Remember, Rolls Royce is built in 6 months. You want a Civic? A Civic can be built in 6 hours. Yeah. EJ in Asian, yeah, it's pretty good. Okay, so that's so everyone who's new, I expect you to come up with a trading plan, which would have your pair, which would have the time you want to trade. It would have your risk per day. Risk per day means, like, let's say if you're starting with $1,000, you should know that your time is between 7 a.m. to 9 a.m. Yeah, that's perfectly fine. 7 a.m. to 9 a.m. is perfectly fine. Risk per day means that you should know exactly how much you are willing to lose in that day. Right? If you start with $1,000, you should know how much you're willing to lose. Are you willing to lose $50 that day? Like, your risk is $50. Let's say if you hit your risk, if you lost $50, that's it. You're done for the day. That's what happens when you trade with the banks, or when you trade in hedge funds, right? They give you a percentage. Recommended percentage is what you are willing to lose, right? Let's say if you're a rich guy and you have $10,000, right? But only deposit money that you are willing to lose, that you're okay to lose that, because there's a big chance you're going to lose that, right? Because the one thing is, you have to maintain your risk. Like, let's say on $1,000, 2% risk is $20. So if you're willing to risk 2% a day, that's fine. But let's say if you're willing to risk $100 on $1,000, that's 10%, right? So you only have 10 chances with 10% risk. Make sense? So you really need to come up with what risk you would want to take. Raja, when it comes to risk per day, if you risk 2% per trade and you're only allowing yourself to take 2 losses that session, your daily risk would be 4%? Yes, it would be 4%. You're right. For example, 4% risk is including commission or without. It's just what you're willing to lose with trades, because commission is like a drop in a bucket in the overall, spectrum. Can I make risk prepaid to per what? Per day to per trade? Yeah, you can do that too. Like normally I risk per trade. Like every trade I take, I'll probably put on 2% risk. So if I lose one trade, that's 2% gone. So basically I'm working with maybe 4 to 5% risk per day, but everyone is different. Everyone is different. Before coming up with your risk, I would say that aim to be confident in taking trades, right? That's what you want to be. You want to be confident in taking winning trades. And then you can increase your risk or decrease your risk based on how your discipline is, right? Because if your discipline is bad, your risk, even if your risk is 1%, man, with bad discipline, that 1% is going to add up if you keep taking trades after trades after trades. Yeah. Next, take profit and stop loss. I'm not sure why I have this here, but take profit and stop loss, like it's like the same thing, like stop loss, like you should know your risk. And take profit, you should always know when to take your profits and when to let positions run. It's very important. All right. If someone doesn't have access to the Forex Family platform, I'm gonna give you access later on today. There's a trading plan folder on the platform that I think some of you guys will find really, really helpful when you try to make your trading plan. So I would really encourage everyone to give that a quick read. Those are 2 documents there. Okay, keeping track and growth. In the Google Drive, we have this document. This document is your, it's a customized table for growth, right? This is going to track your growth and how you're going to focus on the long term. The drive for the material and FX family will be handled later. Yes, Alejandro. So since you were late, I'm probably gonna add you there like in maybe tonight, because I'm gonna take a break after this webinar. But by tomorrow, you're gonna have all the access by tomorrow. So what's happening here is now, think about it. If you are only working on 3% a day, right? You start with $1,000. Now look on the long term, right? Look on the long term. Look in 30 days. In 30 days, it's grown to 2,500, right? It didn't happen in a week. It didn't happen in 2 weeks. It happened in 4 weeks, right? In 4 weeks. Same thing here. If you start with 5% growth, which is very, very, very aggressive, in 33 days, it grew to 4,700. Now, 10% growth a day, this is never, like, just disregard this. I don't know why they even put it on. Just regard this. This is unrealistic. It's possible, but it's very, very unrealistic. Like, you need to be very disciplined to get there. The recommendation that tactic goes to that's any help. Yeah. So I would say start with 2 to 3% and just see how disciplined you are. Because discipline is the only thing that's going to stand between you and the dreams you have with Forex. Trust me on that. Because it takes time. Also important question, when we start growing our accounts, what percentage of profits for the week you should suggest withdrawing? So this question, I would go back to the first slide we had in the morning. I would say that start withdrawing something that can pay for your little bill or something like that, right? I always say that. Like, let's say if you have a $500 account and in a month you grew 500 to, let's say, 650, I would say, hey, even maybe withdraw like $50 and, you know, take your someone out for coffee or something like that and say, okay, you know what, this is from Forex. I'm treating myself with at least something. You know, because the worst thing is when you start growing your account, you don't withdraw, then one day, you know, God forbid, you lose it. So it's very important to keep on withdrawing at least something so that it's real. Because, you know, money in the trading account feels different when it's in your hand. You guys agree with that? Like, let's say $1,000 in a trading account seems very, very low when you have $1,000 in your hand or in your bank. You know, it has a different feel to it. On this customized table, yeah, so it's in the Google Drive. You can find it there, and like, you know, in the Google Drive, yeah, you can customize this too. You feel detached from the money when it's on the screen. Yeah, exactly. You know, you feel detached from it because once you lose $100 or $200 on your trading, you're like, you know what, I'll make it back. But if you lose 100, 200 in real life, you lose like 2 bills, you're losing your mind. You're like, oh man, I lost $200. You know, so you got to keep track of your growth. But first of all, you got to keep track of yourself when you're trading. Trust me, the biggest enemy you have in trading is yourself. If you cannot stop yourself from overtrading, trading isn't for you. So you need to figure out a way that when you take a loss, how you react to that loss. My first step is the only reason I started to do Twitch streams was that if I know that if I can take a loss, I can, you know, tell it to everybody. Hey man, I took a loss and now I'm just gonna call it a day. But there are people who take losses silently. You know, they just stay quiet, they take losses silently, they don't tell nobody, and that's where they go in big problems, man. Big problems. Because then after a month they message someone, hey man, I lost my account, I don't know what to do, you know. So when you take a loss, just tell the group. You know, go in the group chat, just say, hey guys, I took a loss, this is a trade I take. Like, how could I have taken the better trade? Simple. Just own up to it. Take care, Tim. Take care, Tim. Yeah, you know, so that's because the big thing is when people take wins, they tell it to everybody, hey man, we took a win. But when they take losses, they don't tell people. So you gotta tell at least your group. You gotta be honest with yourself. When you take a loss, tell the group you took a loss. Because when you tell a group you took a loss, that's gonna keep you from overtrading. That's gonna keep you from chasing that loss. Trust me. Because guys are gonna message you, hey man, did you chase that loss? And then you'll say, yeah, I did, and then you're gonna start getting roasting. Guys are gonna start to roast you, and that's good. Yeah, no problem, Ricardo. So yeah, so we're gonna move on to the next section here. Question time. I'm pretty sure I answered a lot of questions along the way, but still, the slide was pretty important with Dwight on it. So Raja, you want to do trade? How do you start? Which factors you see first? How do you go on that? Okay. How do you go on factors? Okay, well, first of all, you see if price is consolidating or not. If price is consolidating, you wait for a breakout. That's it. Once you have a breakout, you look left to see if there is enough range to fill. And then you execute based on that. So, oh shit, okay. So realistic percentage goal is never more than 5% a day. Like I've heard you guys say, if you hit your weekly goal, go out and have fun. But what would the weekly goal? Well, weekly goal depends on you, right? It depends on your expectations and what you really want. So I mean, if you're aiming for 2% and you hit 5%, well, that means you can take the next day pretty easy because now you've made 2 days worth of gains in one day. Right? So that's totally up to you how you manage that. Okay. Oh man, so many questions coming up. Hold on. Do you have a weekly, daily, monthly target? Yeah, my weekly target is around 10 to 15%. That's my weekly target. Because I gotta go slow, So weekly target is 10 to 15%. Because the bank only gives 1.3% a year, What time frame would you check when you open your chart fresh and start drawing support resistance? Good question. I would look at the 4-hour. I would start with the 4-hour and daily. I'll start with the 4-hour support resistance and the daily support resistance. 25% per month is realistic. Well, 25% a month. Okay, let's do some quick math here. Let's see here. So we got 25% a month. So 25 divided by 4. What is that? 25 divided by 4 is, let's say, 6.13%. Right? So now you're saying 6.13% per week. Okay? So now 6.13 divided by 5. It's going to be 1.05% per day. See what I did here? We broke down your 25% per month goal into daily goal. So now your daily goal is 1%, 1.05% if you want to get to 25% per month. Hey, Raja, doesn't know if you already answered the question. When do we get access to the simulation so we can practice? I'm going to give out the codes on Monday. Monday, I'm going to give the codes out. So Monday sometime, during the day, you're going to get I'm going to start asking people. So check your emails. I'm going to send out emails with the codes. Would you suggest us getting into account management once we become consistent? No. Well, that's totally up to you, because it's another thing to trade your money and it's a whole other thing to trade someone else's money. Trust me. Simulation is like practicing, it's like practicing on the account. Simulation is like when you practice on the account. So it's like simulation trading, just like you have a flight simulator when you learn to fly. This is like when you learn to trade, so you can simulate previous charts. So that's about it. Oh man, we've been on here for a while. 9:30, 9, 10, 11, 12, 1, 2, 3, 4, ooh, almost 5.5 hours. No, 6.5, 7 hours. All right. Perfect. Yeah, it's a full day shift. Full day shift, man. In this time, I've taken a total 10-minute break. 10-minute break. Holy, I can't believe it. I made it. But yeah, man, like I was really excited for this webinar. You know, like I did. There was no slacking around. None of that. So I hope everyone found this useful. The recording is going to be in the Forex Family platform in a couple of hours because this is going to be a pretty big file here. So we're going to get that done later. How can I send some food as an appreciation? You can send it in the mail. Send some sweets. Send some sweets. Mithaiyan, you know, send some mithaiyan. Mithai are good. All right, guys. Have a good day. Be safe. We'll see you tomorrow. We'll see you tomorrow in New York session. Take care, everybody. Oh, the WhatsApp group is there to say. That's going to be our main communication channel. Thanks, guys. Have a great day.